Thank you so much. Thank you to the organizers for including us in the program. I'm going to be talking about the cross-asset limit allocation of trading desks. This is joint work with Falk and Wenshin, and we're at the Boston Fed, so the usual disclaimer applies. So the broad question that we're trying to answer is, how do dealer banks allocate capital? Now, I don't need to tell everybody in this room that the intermediation of financial markets is crucial for efficient market functioning and price discovery. And yet, the same large dealer banks intermediate multiple asset markets. So when I say asset market, think treasuries, think equities, think exchange rates. Now, depending on how these dealer banks allocate capital, shocks to one asset class may have implications for other asset classes. So what do we do in this paper? We provide evidence that dealers operate hierarchical capital markets within their trading division. We show that trading desk limits respond endogenously to intermediation profits. And we trace out how an increase in limits in one asset class leads to a decrease in limits in other asset classes at the same bank. We do so using granular supervisory data on desk-level trading limits and usage. So just to get us all on the same page about what I mean by the hierarchical structure of limit allocation, I just wanted to provide a quick illustration. Banks have capital in business unit. The trading business unit then allocates capital to the different asset classes within the unit. And here the 7 asset classes we consider are asset-backed securities, commodities, corporate bonds, equities, exchange rates, government bonds, and municipal bonds. And then each asset class can allocate capital to the desks within that asset class, which might specialize in something specific in that asset, or they might differ in terms of their location or something like that. Now, what we focus on in this paper is this middle level. So how the trading business allocates capital between the asset classes. We contribute to a few strands of the literature. There's a large literature to which a lot of you have contributed on the impact of constrained intermediaries on prices and liquidity. And we see a natural follow-up question: what in turn determines dealer constraints? We contribute to the literature on bank constraints and the returns of multiple asset classes. And here we seek a sharper identification in measuring spillovers, and we provide direct micro-evidence behind the mechanism. We also contribute to the literature on internal capital markets and banking organizations, and we make the point that interlinkages from resource constraints on banks' trading business are also key for asset market intermediation. And finally, we contribute to this small but growing literature, which we've written on in the past, of papers that use this supervisory data. Okay, so just to talk about where I'm going to go, I'm going to start by talking about the data. I'm then going to present a few stylized facts that we learned from the data. I'm then going to give a parsimonious model just to get us all on the same page in terms of the mechanism that we're really thinking about. I'm then going to turn to the main empirical analysis of the paper. First, I'm going to start about about the dynamic response within an asset class. I'm then going to turn to limit reallocation between asset classes, and that's where the causal identification scheme is going to lie. And finally, I'll have something to say about arbitrage spreads. Okay, so we use the VV1 data. This is collected under the Volcker Rule of the Dodd-Frank Act. The Volcker Rule basically says that trading desks cannot be hedge funds. They cannot take unlimited risk. And as part of this rule, the Federal Reserve collects data on the risk limits of trading desks. It covers over 90% of US-based trading activity, and our sample covers 2016 to 2023. It gives us daily information for over 1,000 market-making desks across 16 banks, and we categorize each desk into one of the 7 asset classes I mentioned using textual descriptive data about each desk. The key variables in the data that we have on a daily level are first the limits. We have the 99 value at risk limit, or VAR limit, and the usage of that limit. We have the profit and loss, which an economist might better understand as income, but this is income net of fees, separately reported for both new positions or intraday positions and existing positions. This is an important distinction. The income on new positions includes bid-ask spread and commission income made over that day, whereas the income made on existing positions includes returns held on previous positions. From the income and the limit variables, we can calculate a modified Sharpe ratio, which gives us a sense of normalized income. This is just the P&L, or the income, divided by the 99% VIR. We also have the positions, so we have the market value of long and short securities and derivatives, and we have the turnover. This is delivered to us as a 30-day rolling sum. This is one of the reasons why a lot of our analysis is at the monthly level. And this is the gross market values of transactions done by the desk. Okay, so turning to facts. First, before we even delve into the VV1 data, this just looks at the consolidated statements of the banks. I just want to note that bank trading revenue is sizable. So on the left, we see trading revenue over gross income on a yearly basis. You can see trading revenue represents about 10% of total gross income. And on the right, this is total trading revenue broken down by asset class. You can see all key asset classes are meaningful revenue contributors. Turning to the VV1 data, desks make the majority of their profit from intraday trading. Make the majority of their profit from intraday trading. So this implies that profits primarily come from bid-ask spreads and commission income rather than market gains. This graph shows the average monthly income per desk split between the income made on new positions. Remember, this includes the bid-ask spread and the commission income, and the existing positions. So this is just returns on previously held positions. And you can see that the income from the new positions is much, much larger consistently. You can do this a few different ways, and you get the same picture. Fact 3, desks tend to operate with a healthy value at risk buffer. So this is a histogram. It's Windsorized at the 5 and 95%. That's why you get that large bar at the end. But the median desk uses only 25% of allocated value at risk limit. That said, over 5% of desk months use over 2/3 of their limit. And I do want to note that desks can be constrained even when they're not at the limit. For example, if they maintain some sort of buffer just so that they don't hit the limit, or if hitting the limit is very, very costly. Anecdotally, we've heard that some banks fire traders if they hit their limit. Fact 4, risk limits adjust infrequently. So here we graph the percent of monthly limit changes that are positive, negative, or 0. In the vast majority of months, limits do not change. This is not the case if I were to do the same graph for limit use, percent utilization, and desk profitability, so the modified Sharpe ratio. We can rationalize this with adjustment costs and time to build considerations, but most specifically for here, limit changes require managerial approval, and this takes time, and so limits don't change every day. Bank time dimension is a key source. Is there a way to get rid of this black box? Thank you. The bank time dimension is a key source of risk limit variation. So here we do a variance decomposition where we add in various fixed effects. In the first column, we have time, bank, and asset fixed effects separately, and you can see that this explains very little of the variation. When we add in bank time fixed effects in the second column, now we're explaining about 1/3 of variation in limit changes. And so this suggests that bank level factors, for example, equity capital, are key drivers of limit changes. When we instead add in asset time fixed effects in column 3, you can also see we're not explaining so much of the limit variation, but when we have asset time, bank times asset times time fixed effects in the last column, this gives us another 10 percentage points. So this suggests that asset level limit allocation decisions tend to be bank specific and don't depend solely on market conditions. So now I want to turn to a model to talk about the key mechanisms we have in mind. Okay, so just to set the model environment, I index dealers with B, asset markets with A. This is a 2-period discrete time model, so time is in time 0 or time 1. Dealers earn revenue by charging a bid-ask spread S on turnover Y. This is motivated by the facts I just showed, while facing value at risk limits V bar that constrain their value at risk usage V. We link turnover to value at risk usage via the order imbalance ratio phi. Phi varies from 0 to 1, When it's 1, then turnover results in dealers having to take a lot of positions because the orders are very imbalanced. When fee is 0, then dealers can do buying, selling, buying, selling, buying, selling, and they don't have to take as much risk themselves. Financial market participants have CES preferences across dealers with elasticity sigma. This gives us this inverse demand, which importantly gives us the stochastic demand shifter C, which evolves such that C in period 1 is C in period 0 plus eta, where eta's a random shock. So this is the randomness that's in the model. And just to be able to solve things, we link our two demand quantities, the order flow and balance ratio and the demand shifter, such that when there's a lot of demand, demand also tends to be more imbalanced. Okay, so the model timing. At time 0, the dealer observes demand that period. They choose turnover to maximize W, which is the within period profit, taking V bar, or their value at risk limit, as given. In that same period, they choose the value at risk limit for the next period. Then the shock is realized, and in T1, they see the shock, they see the demand and the nature of that demand, and then they choose their turnover that period to maximize that period's within period profit, taking the limits as given that were set the previous period. So we can see the dealer has 2 decisions, the within period decision, the across period decision. Within period, as I said, they choose turnover to maximize their within period profit. So this is just, they sum across asset classes, it's revenue minus costs. Revenue, as I said, is just the spread times turnover, and cost penalizes them as they get closer to the limit. Now across periods, dealer sets limits for the next period by choosing this difference, delta, between the limit today and the limit tomorrow. They maximize the discounted expected value of their profit next period, minus some adjustment cost, subject to this budget constraint. And this is the key. The budget constraint says that total value at risk is fixed at the bank level across assets. And this gives us this important first order condition where dealers reallocate towards markets with above average expected value at risk shadow value, which we can also think of in this context as above average modified Sharpe ratios. So the model gives 3 important predictions. 1, the own market within period prediction. A higher demand in market A leads to increased turnover in that market, increased value at risk usage, increased utilization, or like percent VAR use, increased modified Sharpe ratio. 2nd, limit reallocation. A higher demand in market A leads to an increased limit in that market in the next period, but a decreased limit in other asset classes in the next period. And finally, there's this cross-market spillover effect, which comes from this decreased limit, where a higher demand in market A leads to spillovers for other asset markets next period. It leads to decreased turnover, decreased value at risk usage, decreased percent VAR use, and an increase in the modified Sharpe ratio because of that decrease in the value at risk usage. So we can test this. First, we're going to start by looking at the own market dynamic response, which has to do with predictions 1 and 2, and then I'm going to turn to the cross-market spillovers. Okay, so first, we just asked the question, does desk profitability translate into higher limit? So remember, trading desks make the majority of their income from commissions and bid-ask spreads, and so an increase in demand for intermediation or volume should increase marginal revenue for the desk. Therefore, we can proxy the demand shift with the VIX. We do local projections for weekly horizons. This is to get a sense of the dynamics of key variables. And remember, because this is the weekly horizon, we're going to get some funny behavior in terms of the turnover, because remember, that's a 30-day moving average. Okay. So what happens when there's an increase in the VIX? Turnover increases, positions increase, the value at risk usage increases initially and then continues to increase. Same with the percent limit usage, increases initially, continues to increase. The Sharpe ratio increases initially, But the limits, which do not increase initially, increase gradually and persistently. And then this increase in the limit coincides with the decrease in the Sharpe ratio over the next 3 to 4 weeks. So what does this mean about limit reallocation between asset classes? Here we use a causal identification scheme where we look at desk closures. We exploit exogenous desk closures at other banks. So this is the thought experiment. Imagine that Bank A exits the municipal bond business, just as an high-level strategic decision. Bank B's municipal bond desk now sees higher profitability from less competition. Our hypothesis is that Bank B will increase limits to the municipal bond business, and this will come at the cost, they'll reduce limits in other asset classes, for example, corporate bonds. And so the idea is that this is an exogenous shock to Bank B's corporate bond business. In order to measure this, we construct a leave one out measure for each Bank B asset A time T, which we call the value at risk, or the VAR, of closed desks, and this is the sum of the change in limits at other banks where those change in limits are only due to desk closures. We normalize this by the total limit available in the asset class across all banks last period, and we standardize it to have unit variance just for interpretability. Now, anecdotally, desk closures are often high-level management decisions that are typically part of bank-specific strategy overhaul. Because of the confidential nature of our data, we can't do like a systematic narrative analysis, but we do go through news articles based on where we see these desk closures, and we do see that they coincide with these high-level reshufflings. Okay, so first, we find that desk dropouts increase turnover, increase positions, increase the modified Sharpe ratios at that asset class at other banks. Just to help you interpret these coefficients, for example, you can see that in response to a 1 standard deviation increase in dropped value at risk, turnover at remaining desks increases by 5% at other banks. We see that desk dropouts increase other banks' risk limits in that asset class at the expense of other asset classes. And so in response to a 1 standard deviation increase in dropped value at risk limits in unaffected banks increase 15% and decrease 14% in other asset classes. So then the question is, well, what happens in those other asset classes? And we can see that they see a fall in intermediation ability. Turnover falls, position falls, limit use falls, and the Sharpe ratio goes up because the limit use falls. Okay, so in my last couple minutes, I just want to touch on arbitrage spreads. So the question is, do the pairwise correlations of asset-level arbitrage spreads relate to the pairwise correlation of limits? And so intermediaries contain segmented trading desks, as we've discussed, that specialize in different assets. When trading desks of 2 different asset classes receive the same shock on their limits, their ability to arbitrage also moves in tandem. When limits tend to be reallocated between 2 asset classes, so from one to the other, arbitrage spreads in those asset classes should also exhibit negative correlation. And this is related to the varying correlations of arbitrage spreads in a recent paper by Melody and Jonathan. So we can test this. We can test whether pairwise correlations of arbitrage spreads and limits are related. First, we compute the pairwise correlations of the absolute value of monthly arbitrage spreads for different asset categories. And for limits, we do something similar, except we do it in regression form so that we can have bank fixed effects. This gives us 2 coefficients, beta AA prime and beta A prime A. And we average those 2 into 1 coefficient per asset pair, and we can graph the arbitrage spread correlation versus the limit correlation, which I'll show on the next slide. We can see that asset pairs with higher correlations in their arbitrage spreads tend to be allocated higher or lower limits at the same time. Okay, so to conclude, we find that limit allocation follows a hierarchical structure where the trading unit allocates to individual asset classes. We show limits respond endogenously to risk-adjusted intermediation income, and we trace out how a limit increase in one asset class leads to a decrease in other asset classes. This is a novel channel linking asset markets through the internal capital allocation of dealer banks. We see this as policy relevant for a few reasons. First, market concentration in dealer intermediation creates linkages. Second, regulatory capital requirements affect multiple markets simultaneously. And third, asset-specific developments may have cross-market effects. Thank you.
Great. Thank you very much for inviting me to discuss this really interesting paper. I very much enjoyed reading it, and let me start by stating what I think are the two key findings of this paper. First, risk limits at bank dealer desks respond to intermediation income. Second, risk limits are reallocated across dealer bank desks within a bank. Together, these findings provide very nice evidence that banks operate active internal capital markets, and that scarce risk capacity is devoted to where it is most valuable. I really like this, and it's the kind of insight that's only possible when amazing supervisory data is paired with very careful data work. The findings also have implications for asset pricing. If intermediaries matter for asset prices, then so should their constraints. Risk limits could form a type of constraints. And so while what this paper is showing us is that shocks to one asset's risk limit spills over to other assets' risk limit, what it really illustrates is a very natural channel that shocks to one asset's constraint could affect the prices of other assets. To help us all to better appreciate this implication, I'd like to use my discussion today to reflect on a question whose answer we too often take for granted. Why do banks matter for asset prices? Asset pricing has always been about P equals to EMX. What has evolved over time is whose SDF belongs in that equation. The representative agent model would say it's the owner's SDF. Intermediary asset pricing says that it's the marginal agent's SDF. By now, we have pretty convincing empirical support that this notion of intermediaries being the marginal agent has a kernel of truth, as intermediary-specific constraints, for example, the regulatory shadow cost of capital, these constraints are priced across assets. But what makes intermediary the marginal investor in the first place? One answer is delegated management. Households own the wealth, but intermediaries allocate. Because of principal-agent frictions, in particular the incentive to steal, the marginal value of that on wealth by that intermediary may differ from the marginal value on wealth by the household, and that wedge enters into asset prices. This idea is increasingly relevant today as enormous amounts of capital is delegated to hedge funds, to private equity, to private credit, so on and so forth. Yet, most of the empirical work on intermediary asset pricing studies banks, in particular, bank dealers. And dealer banks aren't primarily delegated asset managers. So what makes these intermediaries marginal? Let's think this through with one asset, two households. Household A owns the asset initially. Household B owns the asset eventually. Ownership transfers directly between households. The owner remains the marginal investor throughout. Naturally, the owner's SDF prices the asset. In fact, if this were a representative agent model, we wouldn't even care who bought from whom. That transfer of ownership is just absorbed in the change of the household's SDF. Now introduce intermediary. The ownership is still transferred from A to B at the end, but frictions separate ultimate ownership from present marginality. You see, before the asset finds its way to household B, the intermediary has to temporarily bear inventory risk. So during that period, it is the marginal agent, and its SDF prices assets. How long is that period? It could be a second, a day, a week, a month. The length may not matter because the brevity doesn't detract from the importance. This could be the crisis period. Eventually, though, inventory unwinds, and that ends the intermediary's role as the marginal agent. Ultimately, household bears the risk in the long run. And so if this were the whole story, households SDF ultimately prices assets. Unless that inventory never disappears. Suppose demand is segmented. Preferred habitat bond investors only want a particular maturity, nothing else. International investors want foreign assets, but only up to a point. After all the households have chosen their desired portfolio, there is still net demand left over that has to be absorbed by someone other than the household. That someone is the intermediary. Now the intermediary is no longer simply warehousing inventory, it's continuously absorbing that residual demand. And so intermediaries SDF persistently prices assets. Now whether you care about prices during the transition or prices in the long run, the lesson is the same. Intermediary asset pricing is not merely about intermediaries standing in the middle. It is about intermediaries being unable to step out of the middle. And that means who bears the risk matters. Is it households? Is it intermediaries? Who bears the risk is the marginal agent. That also means that shocks to that residual demand now matter, because intermediaries may have limited risk-bearing capacity. And so prices now move not only to information changes, but it could also move because the marginal intermediary is asked to absorb more or less risks. Finally, and this is the point that I'm going to build on next, when I say a shock, the relevant quantity here is not positions. It's the risks that these positions create. Indeed, we all know that risk premium compensates investors for bearing risk. When there's only one asset in the economy, that distinction is not important. You double the position, you double the risk. But those two things come apart when you've got multiple assets. Consider the following two assets. Asset A pays you $1 if Spain wins the World Cup on Sunday. Asset B pays you $1 if Argentina wins. You've got 1 million units of both. Your position is enormous. Your risk is 0. So what matters? Well, portfolio theory gives us a very clean answer. It's the non-diversifiable risk that should be priced. Combining that with intermediary asset pricing, then we've got that the cross-asset price movement, which this paper is ultimately about. This cross-asset price movement should reflect changes in the aggregate risks borne by the intermediary and can no longer be diversified away. This is actually great news, because in the data, what we observe are positions and prices, and things look hopelessly complicated. Every single asset position can affect every single asset price. But now we know that there's actually some structure underneath this complexity. Individual positions should matter only to the extent that they change the aggregate risk borne by intermediaries. When the amount of that aggregate risk changes, the price of risk changes. And it's that change that then feeds through to the price of every single asset. It's an extremely elegant view of cross-asset pricing. Is this how the market works? My work with Yuan offers one empirical test. We use observed positions and prices to recover what is the aggregate non-diversifiable risk borne by intermediaries, following exactly the mapping that the previous slide would suggest. And then we ask whether shocks to these risks can explain cross-currency price movements. Of course, theory is clean, reality is not. Two empirical challenges arise immediately. First, in practice, there's more than one source of risk. And when there are multiple risks and shocks to one risk can affect the prices of all the other risks, the transmission mechanism is still fiendishly complicated. And second, position changes often reflect information. But if prices are responding to information, then we're no longer learning about intermediaries absorbing risk. So we can overcome these challenges by constructing totally orthogonal aggregate risks and using an instrument for non-informational demand. The results are encouraging. The cross-currency responses predicted by this risk-based framework line up pretty well with the realized responses following a rare, known, non-informational shock. To me, that's evidence that cross-asset price movements do reflect the pricing of aggregate, non-diversifiable risk borne by intermediaries. So what are the key ideas that intermediary asset pricing has taught us? First, intermediaries matter because they're marginal. And second, in many of the models that we study, they become marginal by bearing aggregate non-diversifiable risk arising from absorbing residual demand. And this aggregate risk is really important even if it's not directly observable from positions. And so with these ideas in mind, I'd like to come back to today's paper and reflect on two questions. First, the paper uses these very neat desk closure shocks to ultimately shed light on cross-asset price dynamics. Do these closures change banks' aggregate ability to bear risk? And second, we've come to see banks as being synonymous with the marginal risk bearers in our model. Are they still? Let me start with the first one. The paper uses a neat test to ask, how do risk limits adjust across assets? Here's a simple illustration of it. Two banks, each with 3 dealer desks, one for each asset. Initially, every single desk has the same risk limit. So if you were to sum across the desk risk limits, you've got 2/3 per asset. Here comes a shock. Bank X closes its desk for asset A. And we observe in response that Bank Y sees this opportunity, expands its risk limit for A, but because it has a limited risk limit overall, it shrinks the risk limit for assets B and C. And so now we see that if we were to sum across these desks, the risk limits for assets B and C goes down. And this is exactly the mechanism that the paper underscores. That shocks originating from one asset can spill over to other assets because of bank's internal reallocation. Beautiful. Though I do wonder, what does Bank X do following the closure of that asset A? The paper gives convincing evidence that these closures have nothing to do with the asset itself or even the bank. It's really about banks reorienting its resources to desks that align better with the firm's priority. If so, it's probably likely that Bank X's overall risk limit is unchanged. And if so, does it redistribute the capacity that used to belong to asset A to now assets B and C? And could it be that the reduction in risk limits by Bank Y is actually offset by the risk limit increase of Bank X? In other words, the paper has clearly demonstrated how within some banks, the internal risk limits have adjusted. But when we look across all banks, do the total risk limits, have they really changed? Stepping back one level, even if we were able to trace out the action of every single bank, it's still not totally clear to me if we're then able to say something about the aggregate risk-bearing capacity. Because you see, banks set risk limits relative to their own portfolio. That means what constitutes an additional unit of risk for a bank depends on how the rest of the balance sheet looks. And so, how can we think about the risk limits for assets across banks and go from there to the aggregate risk-bearing capacity of the banking sector? Because of course, the latter might be the relevant constraint when we're thinking about asset pricing. Moreover, the constraint to bear risk only matters if risks are only borne, And that brings me to my second question. Much of the empirical intermediary asset pricing literature studies dealer banks, for good reasons. Episodes like the GFC clearly point to a central role for banks in asset pricing. Moreover, banks are becoming increasingly observable because of rich regulatory, supervisory data made available. This paper is a great example. Yet, dealer banking has changed in the 20 years since the GFC. Today, there are narratives that dealer banks are more like toll collectors benefiting from customer flows rather than risk takers absorbing residual demand. And so, are banks still the marginal risk bearers that our models tell us that we should care about? I think this paper can really help shed light on this question. Here are some really interesting summary statistics. We see from this that dealer banks have enormous turnover, gargantuan gross position, very small net position. From here, you might be tempted to conclude that they don't bear much risk. But recognizing that positions are not risks, the paper rightfully goes beyond position and studies VAR. And so from these summary statistics, we can see that on average, a desk's VAR is about $6 billion. That's informative. Though VAR, just like risk limits, are also portfolio specific. And so without more information, it's still hard to understand what is the aggregate amount of risk borne by banks. It's almost certainly not the product of the average desk VAR and the number of desks. Thankfully, the authors have more information than just these summary statistics. And so I wonder, could the regulatory data help us to answer this central question in asset pricing? Do banks still bear meaningful amount of aggregate risk? I think there's reason to hope that the answer is yes. This figure is from the paper that I mentioned earlier, where you and I show there's persistent, cumulative, non-bank demand for distinct FX risks. By construction, banks take the other side. And because these are risks that are no longer diversifiable from their perspective, this is evidence that banks do have large exposure to non-diversifiable risk. The question is, who are these banks that our data vendor have thus classified? Are they hedge funds trading through their prime brokers? Are they dealer banks? Or could they still be other parts of the bank balance sheet? I think this paper and the data that the authors have can really help us make progress on this question. And so let me conclude. Intermediary asset pricing is ultimately about identifying the marginal risk bearer. In many of the settings that we study, that marginality comes from absorbing residual demand and bearing the resulting aggregate, non-diversifiable risk. So the open empirical question is, do today's banks still bear that risk? This paper brings exactly the right kind of data that can not only help us answer whether or not banks reallocate risks internally, but also help us answer who today is unable to step out of the middle. Thank you.
Let's turn the floor over to questions. If you can come up to the mic when you ask your question, that'd be great.
Thank you very much. I enjoy the paper. I'd like to supplement the institutional feature the authors may consider. So under the Basel's new market risk measure, the model approval has shifted from the bank level to the desk level. So before, you only approve on the bank level, or the desk, you can do the internal allocation. But now, the regulator directly design at the risk level. That means this is no longer internal management. The regulators co-design the desk. It's probably good things for your paper is this is currently not binded in the United States. However, all the dealers you consider, they have international desk, like Japan, Switzerland, Singapore. They already have this desk level. If you give them more VAR allocation, actually it's higher probability they're going to face their day by day this regulator stress test. So I want you to take that institutional feature into your consideration. Thank you.
All right, super interesting. I was just wondering whether you could, as a big picture question, whether you could bring it back to the elusive mean variance investor. What I take away is one of the big things that you find is that there is allocation from one desk to another, and of course value at risk loads on the tail of asset returns. But, you know, abstracting from that, maybe if things are actually normally distributed, is there something to say about what's the underlying wealth portfolio, and is there a way to map that back into these sorts of frameworks? At a certain horizon, you could probably speak about, you know, at what horizon do these things matter? Or
Great data. If you look at the 10Ks of major banks, they disclose their VERs for the trading desk. And for example, my understanding they are very, very small. JP Morgan has like in the order of like millions of dollars when they have like a very large balance sheet. You could like comment, you guys look at reconciling the numbers that you have with this data from 10Ks. That would be, thank you. Just to follow up also with what Alan's saying. So looks, I mean, it seems like what you're saying, what it looks like is that this is it's market making, so these positions are one-day positions mostly. So I don't see how this is, touches too much on the level of asset prices more than the bid-ask spread, which is fine. It's like, seems people sometimes extrapolate from this as being very important for level of prices, and I don't see that.
Okay, I'm going to start with these, if that's okay. Okay, thank you. Thank you all for the comments, Amy, for the discussion. I want to start with Amy's points that you raised. Thank you so much. So firstly, you mentioned that position is not risk if multiple assets are priced. That is something that I abstracted from during this presentation, and when we have the data, we don't know the underlying holdings of each desk, while we do have descriptions about the desks, and so it is hard to aggregate. We do so in a linear level, or in a linear way. That said, we have in the paper a verification where we add up the value at risk across the different desks, and we compare it to the value at risk from, we use Pillar 3 disclosures, and it's actually, it's very, the patterns are very similar. The levels are, I think about half, so it seems like value at risk can sit in parts of the bank that aren't necessarily just the trading desks we have, but it is sort of broadly in line, which we thought was, reassuring. Are banks marginal risk bearers? This is a really interesting question and something I've thought a lot about. So we don't tackle pricing in this paper directly, and this speaks to the question I just got. We do show in previous work, we look specifically at the exchange rate market, we look specifically at the treasury market, and we show that shocks to these risk limits actually impact prices in those markets. Falk and I are working with a new paper on Wenshin where we look at the corporate bond market, so stay tuned, but it does seem as if these risk limits do actually impact overall asset prices. You made a really good point about showing statistics on overall turnover across banks. A lot of work, both ours and others, has shown that liquidity measures and turnover matter for prices and matter for asset prices, so we sort of stop here mostly at turnover. But you're right that we don't currently include anything where we look at aggregate turnover, and I think that would be very useful, so thank you. In terms of our bank's marginal, we argue that they're important because they intermediate so much of these different markets. The vast majority of trading in all these different markets goes through the same big dealer banks that we have data on. Does that mean they're always the marginal buyer? No. I think there was an interesting paper in a session the other day. Rohan and Moritz had a paper on the marginal dollar pricer who looks quite different than our bank. And so I think there's different ways in which these are important and different ways in which are they always sort of the marginal buyer of each of these asset markets. Not necessarily. So I think it's interesting to think about that holistically. Institutional features with regulation at the desk level. So this is interesting. The Volcker rule says that desks can't be hedge funds, so it puts a limit on the desk, but we actually see this as important in terms of reporting. So, for example, treasuries are actually not subject to the Volcker rule. That said, we showed in this previous work that the limits on treasuries at the desk level actually matter for treasury markets, and that means that there must be internal risk aversion that's putting risk limits on these desks, which is more binding than sort of the non-existent regulatory limit. And so I think that's interesting. This also brings up an important point about the data. This is obviously US data, but for US banks, we have their worldwide desks. In practice, I think it's easier for banks just to report all their data. So for some non-US banks, we also have all their desks worldwide. The mean variance investor, this I think has to do with this idea of, is it one asset class, is it two asset classes, how do you sort of aggregate across asset classes? You know, if you just have one asset, then you can model it as a mean variance investor, you can model it as having a constraint, and it ends up being the same thing. Once you think of value at risk in terms of having correlation across different asset classes, this is a little different. I think this is worth us thinking a little more about. Yes, I'd be happy to take more questions if we have time.
On this point about prices versus spread levels, I'd love if you had anything in the paper that could give a sense as to how much is pure market making versus supplying leverage to other intermediaries that may be taking risk in this market. Right? So if you think of an arbitrage spread as a price of leveraged borrowing in these markets, and risk limits are shocking the supply of leverage to these markets, that may be a channel where it may matter more for price levels than just bid-ask spreads. But this is a question of quantities and size.
Yeah, we don't have data on who the customers, this isn't transaction level data. We can split things in terms of what's inter-dealer or what goes to customers. I think it's an interesting point about arbitrage spreads. I think a lot of the literature has focused on bank regulation and specific bank constraints. In terms of the emergence of these arbitrage spreads, and so I think for there actually the banks are quite important, but this again gets at, you know, are the banks truly the marginal demand, or are they just sitting in the middle of all this marginal demand? I think both makes it important, and we can't necessarily distinguish it here.
A very low-level question. When you see a bank eliminate the trading desk and therefore eliminate X units of risk-bearing capacity, do you see the other banks step up to expand by X, half X, 2X? What's the number? Yeah,
so far we've looked at the desk closures as a shock. We haven't, and then we look across asset classes within a bank. We haven't just done, we must have at some point, I can't remember the endogenous regressions that we did between banks, but I think that's worth showing as well. Thank you.
Related to that, your model says there's sort of a direct multiplier on the aggregate VAR constraint.
Yes.
It seemed like the moving across of desks and reallocation should tell you something about the size of that direct multiplier.
Yes. Yeah, we should be able to back that up.
Interesting
Yeah.
to figure out and then connect it to the broader question about what is the cost of bank capital.
Yeah. Thank you.
If there are no more questions, we're going to break and we'll restart at 9:45.
Thank you.
us. I know.
Can I sit here? Yeah. I drink so much coffee. Oh my god.
When it's NBER, especially.
Yeah.
One of the things I came from Michigan, so I still on East Coast inside of that makes it
What were you doing there?
We had a cottage there for 12 years. Yeah. So ever since I was living out in Connecticut, I worked at that hedge fund, and then I got a bonus, and then and my parents retired there.
Okay, let's get started again.
Lake House. So but it's like middle America, not just.
That's refreshing though. I like that. I like Middle America. Yeah.
The next paper, dissecting the aggregate market elasticity, 20 minutes. Take it away.
All right, thank you so much. I'd like to thank the organizers for putting the paper in the program. In this paper, we revisit this classic question, right? So where the market volatility comes from, or we know that stock prices are more volatile than fundamentals. Many of our classic answers rely on features that are usually very hard to measure, something that we convention to call dark matter. And Ralph and Xavier, they propose an alternative view that these fluctuations are actually driven by small portfolio flows that can lead to large movements in prices, right? So they document that a $1 flow from bonds to stocks move values by roughly $5. So you see that just large price movements with relatively modest flows, right? So what this plot here is basically showing is this ratio of volatility to flows that convey the idea that you need a lot of price impact to be able to explain the level of fluctuations that we see in the data, given their relatively modest size of these flows. But of course, this by itself does not answer the question, just kick the can down the road. If you're trying to understand why the stock market is so volatile, to say that the markets have this large price impact begs the question is, well, why price impact is so large? Right? And again, in their work, they provide a very precise answer to that question by saying that the investors have low price elasticity, therefore the small flows will lead to large price reactions. And they study this in a natural starting point that gives you like very tractable environment where interest rates are constant. However, if you want to push this idea of the inelastic market hypothesis forward, let's say you want to think about the implications for monetary policy or other macro questions, it's very natural to try to extend that to settings where the interest rate is allowed to react, right? So when you consider flows between bonds to stock, you would imagine that both interest rates and the price of stocks are both allowed to react. And that's what we do in this paper. We study this aggregate market elasticity when interest rates respond to flows. And to be very precise, when I say this aggregate market elasticity, I'm essentially defining as the inverse of price impact. I've used this to essentially intertangentially here. And then we're going to try to relate this aggregate market elasticity to investors' individual demand elasticities. I'm going to study this in the model with heterogeneous investors, passive demand, and leverage constraints. And the paper does two main contributions. First is an analytic characterization of this aggregate market elasticity on this dynamic setting, and we propose a new method to characterize price impact in dynamic demand models that we believe is potentially useful even beyond the particular application that we consider. Second, we provide a quantitative evaluation of the mechanism in this continuous time general equilibrium setting, and we show that the model actually matches price impact and asset pricing movements when these flows are disciplined by what we see in the data. And crucially, when we allow these interest rate movements to occur, it changes fundamentally the determination of the aggregate market elasticity, or this price impact. For instance, due to general equilibrium forces, we show there are examples where markets can be infinitely elastic, and by that I mean there's essentially no price impact to flows, even when individual investors themselves can be very inelastic. So there's this disconnect between what is the aggregate market elasticity and the individual market elasticity. And it goes beyond this special cases where we get this sort of neutrality, and we show that matching a price impact of roughly 5 requires essentially 3 main ingredients. First, this requires some kind of risk misallocation. If you consider small flows around an economy that's initially efficient, we're going to get this kind of infinity elastic result. However, if you consider flows in economies with frictions where assets are not efficiently allocated to begin with, then we're going to get this finite elasticity that we see in the data. Second feature that I found was actually quite important is that we should model the equity claim instead of just look at the aggregate endowment. Sometimes we just write down our models and look at the aggregate endowment and treat that as the stock market. It turns out that the implications for the price impact or market elasticity, they're actually quantitatively very different if you look at the aggregate claim or if you look at a levered dividend claim like the equity market. And finally, the aggregate market elasticity will depend on the degree of risk-bearing capacity of these active investors, or how much they can react. This is going to give rise to state-dependent effects from both wealth movements and also this occasionally binding constraints. And you find like both things seem to be pretty important. Okay? So like the punchline is in some sense that this large price impact tends to point to some form of risk misallocation or assets not being at their efficient levels, not just to inelastic markets. So try to get an idea about how this aggregated market elasticity is determined. We consider first like a simple model, like the simple model we could think of, where we allow both the price of the risky asset and the riskless assets to react. So this is going to be a 2 by 2 by 2 economy, an economy of 2 periods, 2 agents. We're going to have active investors and passive investors, and 2 assets, a risky claim and a riskless bond. Right? So here we have the demand for these 2 types of investors. And we're going to assume that active investors, their demand depends on the risk premium. And the risk premium here is nothing but something that depends on the relative price of the risk and riskless asset. It depends on the log price of the risky asset and the log interest rate. And if the demand depends on the risk premium, therefore we can write it equivalently in terms of an elasticity that depends on the price, but also cross elasticity that depends on the interest rate. So this just comes from the fact that we're assuming that investors care about risk premium. We're also going to assume that we're going to have some passive investors. So passive investors, you can imagine that they don't have this cross elasticity here, but they have a shifter here, this F. Right? So the F is going to be 0 for active guys, but they're not going to give a shock to the demand of the passive investors. So this is the portfolio flow shock that we're going to study here. Okay? We have 2 prices. So we need 2 market clearing conditions. So I also need to specify the consumption savings decision of these investors, right? So here, I simply postulate that the consumption wealth ratio for these investors is a function of the total return of this risky asset. That's something that's going to emerge naturally from the continuous time model I'm going to show you later. So this is the market clearing condition for goods that you can write down as the wealth-weighted consumption wealth ratio matches the dividend yield in this economy. Let me first consider the case where the interest rate is fixed, so we can forget about the savings decision. So in that case, we can think of this as the market clearing condition as being the demand from active investors equals the net supply, the total supply minus whatever the passive investors are holding. Therefore, if the passive investors decide to hold more of this risky asset for whatever reason, this effectively shifts the net supply of risky assets that the active investor must hold. That's what we see here. They'll lead to change in the price of this risky asset. By how much? Well, the magnitude of the response to these flows depends on this inverse market elasticity here, which is just the average price elasticity of each investor. Right? Very intuitive, and that's in a nutshell like the basic idea behind Xavier and Ralph's work there. So this aggregated market elasticity depends on how elastic these investors are. Okay. So what's the challenge in our setting is that if the price changes, so for instance the stock price goes up, we do not clear the goods market anymore. Intuitively, imagine what you do if everyone in the economy becomes richer. Well, they would want to consume more, right? So, and given the fixed supply of goods in the economy, the markets would not clear. Therefore, the interest rate would adjust until we have clearing the goods market. And because of this cross elasticity, this change in interest rates, we're going to affect the demand for the risky asset. And effectively, it's going to bring the price back to this original level. So now markets for goods clear, and the price goes back to what it was before. So this is a case where flows generate no price impact, and basically because the risk premium is offset by changes in the interest rate. Right? This generalizes an intuition that emerges very naturally under log utility models. We know that under log utility models, the price generation is essentially pinned down by preferences, and then reallocation risks in that environment will lead to offsetting movements in interest rates and risk premium. Here, this holds more generally as long as this portfolio flow shock does not affect your consumption wealth ratio. So what this is saying is that in this setting, we have this infinity elastic market, meaning zero price impact, regardless of how elastic or inelastic investors are, right? So notice that I can make investors arbitrarily inelastic and make this zeta p very, very small. And as long as this zeta r is not zero, I have some reaction on this cross elasticity margin, these forces would generate this no price impact infinite elasticity result. Okay. Crucially, this result comes from the fact that this average consumption wealth ratio doesn't move, right? This model here, I've just postulated this function. So what we need a micro-founded model that tells us when these flow shocks may actually generate this type of impact. So that's what we could do next. We consider a dynamic model with heterogeneous investors, passive demand, leverage constraints, and the two clients that I mentioned before. So here's the model. It's going to have an aggregate endowment that follow a geometric Brownian motion. We're going to have like three types of shocks in this economy. The first shock is going to be the fundamental shock, the aggregate endowment shock. It's going to be important for the quantitative results that we separate actually the dividend client and a corporate client. And because of this share ST here is stochastic, it's going to make the leveraged client riskier than aggregate output. So what about investors? Investors are going to have sizing preferences with a common EIS and different risk aversion. We're going to have passive investors that hold an exogenous share of wealth in a market index fund that splits between stocks and corporate bonds according to market weights. But the total amount invested in this market index fluctuates exogenously according to this process. Right? You can think of this second entry as capturing these pure flow shocks, and the first entry capturing some correlation between flows and fundamentals. Active investors, in contrast, they can continuously rebalance their portfolios. And we're going to have two types of these active investors. We're going to have unconstrained investors with higher risk aversion. And we're going to have constrained investors with lower risk aversion, but they face a type of VAR limits that we saw like in the previous paper. So the states in this economy are going to be the wealth distribution, the portfolio share of passive investors, and the share of dividends in this economy. And you can show that the volatility in here depends on the sensitivity of the price to generation ratio to the state variables. And in particular, you're going to see that the flow-driven volatility comes from the interaction of two things. First, how inelastic markets are, this elasticity of respect to these changes in portfolio of the passive investors, and the magnitude of these flow shocks. If you have the markets to be, even if they are potentially very inelastic, if you don't have these flow shocks in the model, we're not going to have flow-driven volatility. What we want to do is characterize this object, and this price in equilibrium solves like a high-dimensional PDA. This tends to be a very challenging problem. So what we're going to do, we're going to use this technique that we call this state global perturbation. It's a way of getting analytical characterizations, even this is a fully dynamic demand-based model. So the idea is we're going to perturb around the efficient economy, meaning we're going to consider a family of economies indexed by a parameter epsilon. When this parameter epsilon is equals to 0, we shut down all preference heterogeneity. Passive investors are fully invested in the risky asset. And when there's no preference for heterogeneity, that's exactly what they would want to do. All investors would be fully invested in a risky asset. And you also have to scale the leverage limit so that the demand for leverage is commensurate with the leverage limit. What we're going to do with this, we want to characterize now these objects. It depends on the state variables, but also in which economy you are. And we look at the neighborhood of this economy. So I want to solve for these functions right here. Even though characterizing this object is very complicated, it turns out we can characterize these objects on the right by hand, right? So that's what we're going to do. So this builds on a now old idea by Kogan and Upal, and we have used elsewhere. One interesting thing is if you take the first order approximation of this demand system, what you get is exactly the same demand system that we saw in the simple model. We got this linear demand system with cross elasticities, but now the elasticities are connected to fundamental parameters here, structural parameters of this economy. And you have the same kind of like a flow of shocks entering here for the passive investors. And you get a consumption wealth ratio that satisfies the property that I showed at the beginning. Because the first order system is essentially has the same shape as the simple model, the conclusions of the simple model also appear. Meaning that this same general equilibrium mechanism in the simple model here implies the markets are infinitely elastic. In logic is because you're perturbing around this efficient allocation. If you're starting from the efficient allocation and consider a small deviation from that, there's essentially no price impact. What we're going to do next is consider like a second order perturbation that allows us to consider further away from the optimal and also the interactions among the different frictions that we have been talking about. And what you get this very nice formula full of colors here. So the first term that enters is what we call the risk misallocation. It's the gap between passive investors' actual portfolio share, and this alpha P optimal is what they would choose if they were active. They could actually choose their portfolio. This gap here affects crucially your aggregate market elasticity. This also depends on where you're going, right? So this controls the persistence of these demand shocks. And this is the gap between the optimal and the long run level of your portfolio. And this also depends on the presence of these demand shocks, and in particular, how correlated they are with fundamentals, right? All of these three forces, they govern here this aggregate market elasticity, and these are modulated by essentially these two elements. First, the EIS matters. In this general equilibrium setting, again, this is very natural. If I started with a unit EIS setting, I know that essentially the price earnings ratio would be pinged down again, and I can reallocate assets as much as I like, and it still would get no price impact. Interest rates would perfectly offset risk premium movements. So we need to move away from that. So just like in Bansal and On, here we're going to work in cases where the EIS is greater than 1. The second important feature is that this is modulated by the active wealth share, the total amount of wealth that's in the hands of active investors. Right? So the markets become more inelastic, have bigger price impact, exactly when these active investors are undercapitalized, as perhaps they would imagine. Right? So notice that all these things, they're going to lead to this state-dependent effect on the elasticity. So this is the characterization of the aggregate endowment elasticity. And I mentioned that the distinction with the dividend claim was important. And the reason is, consider a case where the aggregate endowment elasticity is essentially infinite. There's no price impact there. We're on that neutral case. What's going on there is the interest rate is exactly offsetting the risk premium movements for the endowment. However, dividends are riskier than the endowment. So the interest rate cannot offset movements in risk premium for the dividend claim. Therefore, even when the aggregate endowment has no price impact, you would see something for a riskier claim, right? So that's why it's important to distinguish between the two. So what the formula shows is the aggregate price impact for the dividend claim is the price impact for the endowment claim plus an additional effect that depends on the levered beta of the dividend claim and the risk premium response to flows. Okay? So the punchline is that the equity claim has larger price impact than endowment claim. So finally, let me show you the quantitative results. So the question is, can the same frictions here match the price impact, volatility, and balance sheets? We're going to try to discipline the model. First, to match the asset shares that we see in the flow of funds for the different sectors. There's a lot of work here of following the literature on how to aggregate this into these three automated sectors. We're going to discipline flows to match volatility, persistence, quarterly actual flows that we see in the data, the matched dividend data as well. Preferences are relatively standard. And now we're going to solve them all globally to get the quantitative implications. And the punchline is that this price impact is around 5. The model generates a significant risk premium, large return volatility, especially this is for the equity claim, a smaller but still significant price impact for an endowment claim. And these frictions, they're all important. So if here you have like counterfactors where essentially we turn off some of the frictions kind of one at a time. Right? So for instance, if I shut down leverage constraints, the price impact is substantially lower. If shut down profits were generated, the same thing. If I make the passive investors hold a higher amount, so basically there's smaller misallocation, also this weakens the price impact. The same thing if I turn off the correlation between flows and fundamentals, some kind of like performance chasing flows. So there's some cool state dependence and return availability effects that I don't have time to talk about. And let me conclude. We saw that in frictionless economies, aggregate markets are infinity elastic. Finite elasticity emerges when risk is misallocated. The price impact depends on whether we're talking about the equity claim. We find a high price impact versus the endowment claim. And the model is quantitative discipline using the flow data. Thank you.
The discussant is Val Haddock.
Thank you. Thank you for asking me to discuss this paper. This summer I've been watching Star Wars with my daughter for the first time. And as I was reading this paper, I couldn't help but think that there's something to our field that's a little bit like Star Wars. So when you, as a kid, you first hear about Star Wars, you learn about like spaceships and droids and laser guns. But then somebody explains to you, say, well, no, none of that is important. All that matters is the force, the dark side, the bright side. And that's all it's about. And I think not so long ago in our field, it was a little bit like that. You thought you were going to learn finance about how people trade, investors, and so on. And you were told, no, none of this matters. All that matters is the representative agent and aggregate consumption. That's all we should focus about. And we spent a lot of time focusing on this and making progress on this. So we were studying kind of like several dynamics of the economy, several features of preferences. There was hedging demands, habit, Epstein-Zinn, long-run risks. I'm not going to try to tell you which one is the dark side and the bright side on this one. We learned a lot by doing this, but somehow we steered a little bit away from focusing on those ideas for a variety of reasons. In part, I think this was getting more and more abstract, and things that we had a harder time connecting to very concrete features of reality. In part, it was getting technically more and more complex, and it was hard to really understand even how our models work. And maybe most importantly, in 2008, the world came to us with questions, and we had virtually no answers. So somehow we kind of switched gears and we went back to the droids and the spaceships and all this stuff. And we focused on what I like to call kind of the macrostructure of the financial sector. So early on, it looked mostly about intermediaries, ideas of regulation, constraints, and so on, a little bit like we discussed in the first paper. These days, there's a lot of renewed focus, in part thanks to Ralph, Xavier, and Moto, on kind of inelastic investors, passive investors, and of course, there's also a lot of work on central banks that are big players in those markets. So we try to understand what do those investors do, how do they behave, how do they make decisions, and so on. There's also been a shift in how we kind of do it, in the sense that we are much less focused on having this kind of like force that's behind everything, a model of everything, and instead we've been focusing more, I think, on trying to understand the actual mechanisms and what's going on. If I'm caricaturing a little bit, we've been doing a little bit less moment matching and more causal inference. Okay. So the paper arrives under this background, and the way I would think about it is that, well, let's take all these forces from all these dimensions of the macrostructure, and let's put it in a kind of old school model, so a quantitative, dynamic, general equilibrium asset pricing model with all the bells and whistles of fancy dynamics and preferences and so on. And they find 3 results, and I'm going to describe them a little bit differently than Dejania, but these are the same results, I believe. So first, this model does pretty well quantitatively. So you can match pretty well the volatility, the risk premium of the economy. You can also match quantity. So they're trying to fit the model to shares of different investors in the data. The main mechanism from kind of simple macrostructure that seem to ignore all those details, they survive, and actually they play a central role in this model. There's just one caveat, that's the one that Dejania emphasized, that consumption kind of strikes back. So if you look at the claim to total wealth, so you think about like total assets in the economy or the wealth of the representative agent, that one seems to not react to flow at all. So what I want to do in my discussion is three things. I first want to kind of review for you this kind of simple mechanism of intermediaries, passive investors, and so on. And I'm going to try to kind of like float between the classical language, the more intermediary and passive investor language, and then this elasticity language, and to try to tell you like this is kind of all the same, like it's just different labels on all the same thing. Then I want to zoom in on this G kind of elasticity mystery. You know, it's like people can be elastic and elastic, but in G everything becomes infinitely elastic. And I would say it's not that much of a mystery actually. And if you understand demand for multiple goods, it kind of goes away. And I want to think about what to make of this mystery in this prediction for the real world. Okay. So let's start from risk premium economics. The simplest one is kind of Markowitz, Merton. You know, we all know this formula. So your share in risky asset, if there's only one risky and one risk-free, is the expected excess return divided by risk aversions times volatility variance. So. And if you solve an equilibrium model, people have to hold all the risky assets. So you set alpha to 1, and you're going to get that the risk premium is gamma sigma squared. So more risk aversion is more risk premium. That's the one in Sound model. And in Sound model, we did a lot of effort to try to make this fit the data. So we thought about, you know, this risk aversion is time varying. You worry not only about the risk of the assets now, but the long run risk of the assets. You also have hedging demand. Your opportunity set varies over time, and you adjust for this. So this was the times of the force. If you just look at this formula already, it should start to tell you that, you know, actually I've written towards inelasticity that quantities can matter a lot. So the way you can start to think about it just by looking at this is say, well, let's say I would want to sustain an equilibrium where investors hold a little bit more stocks. For now, I'm not telling you why, but let's do this as a starting point. So I want to increase alpha. Well, the effect on the risk premium will be the same as increasing variance by 10%. And so if you believe that risk matters a lot for risk premium, you kind of have to believe that quantity would matter similarly in those frameworks. So there's no reason to believe, you know, markets are perfectly elastic in terms of risk premium at the aggregate level. There's no reason. This is not some efficient market thing or anything. It's just there's lots of risk to bear. If you have more, you demand a bigger risk. So to go kind of towards those quantities, at first people started to doing intermediaries. So you can write it in many ways. I did the most stylized way you can. We say, well, we have a bunch of institutions that are really good at bearing risk, so they have low risk aversion. I'm going to call them gamma I, their risk aversion. And you have households that are more afraid of risk. And I'm going to call omega and 1 minus omega the wealth share of those two agents. Well, you just add up those two demand, and you clear the market. You're going to get a risk premium like this. Nothing that surprising happens. So if intermediaries get in trouble, they're going to lose risk-bearing capacity. So this gamma I is going to go down, and the risk premium is going to increase. What happens is kind of, again, this supply-demand. These intermediaries are going to sell their positions. They have to be absorbed by households who are less willing to hold them. So that's why we get this premium that increase. Of course, you can do this better than I did it. You could, when the intermediaries are actually being owned by household as opposed to separate. There are many, many foundations for intermediaries, and a lot of the interesting work on this is actually trying to understand what moves this gamma I, where does this come from, and so on. You can do something similar with inelastic or passive investors. So inelastic investors or passive, you would say, well, their portfolio share does not respond to prices. Because they're not re-optimizing, they're not optimizing. I know wrote a paper on this a while ago with a different name. I forgot how they were called then. But you get a similar equilibrium. And you can think again about what happens if there's a little flow. So for example, some passive investors want a bit more risky assets. Well, it has to be provided by the active one in equilibrium, and the risk premium is going to increase. Here a key insight is the increase in risk premium, it comes from the ones absorbing the risk or providing the risk. So the less of them we are, the bigger the risk premium movement need to be to sustain this equilibrium. It's not quite the same as the high and low risk aversion of my intermediary models before, in that here we're kind of separating the level of holdings to the slope of holdings. So meaning those passive investors, they hold a lot of assets. I think that was one of the key insights from this literature is we have many investors who hold a lot of assets, they just don't respond that much to the price. If you're familiar with this kind of new macro model, the Hank model, this is kind of the causings of the wealthy and to Mars. We have many people who are rich but constrained. Okay. Now let me kind of translate this in demand for us. Demand is just saying investor maximize utility given prices. So I have an optimal position given prices. depends on the risk premium and some other stuff, risk aversion, like constraints. And so in change, you can just write it like that. You take the derivative. So you have an elasticity times the change in risk premium plus other things. This is when volatility changes, other things changes. And if you solve the equilibrium in that world, you say, well, the market always has to clear, so the total demand in the market cannot change. So you just say the sum of change in demand is 0, and you get immediately that the change in risk premium is minus 1 over the sum of elasticity, the total elasticity of investors, times the sum of demand shock. So kind of no matter what, how risk premium move is related to the total elasticity in this market and the magnitude of those demand shocks. This is just a convenient language across models. Just all the mechanisms I told you before, the demand shocks or the shift in volatility, when I change intermediary risk capacity, the passive share, the elasticity was for our Merton investors was 1 over gamma sigma square, was 0 for inelastic. To me, part of the value of writing things this way is you don't have to embrace this model. You could entertain richer models. So for example, something that traditional models have struggled with is risk premium are not that related with risk empirically. So this idea that it's all about risk that we discussed a little bit this morning is not so obvious that it is relevant. Here you can start to do stuff without embracing this view necessarily. Of course, you will have to explain why at some point, but at least we can get started. Okay. I want to make one last point on those things that is going to be a little bit important for some of those results. So you could ask yourself, well, how do you clear the market now if everybody is passive? So nobody is responding to prices. There's no elasticity in the market at all. And there's an insight that I learned from Ralph and Xavier's paper, actually, which in hindsight is pretty clear, is, well, the wealth share also depends on asset prices. So even though your portfolio share does not depend on prices, your wealth depends on prices because you're endowed with assets. You show up every day with assets in your pocket. And so in equilibrium, prices can adjust to clear the market. So even if people are inelastic in the sense that they don't adjust their portfolio share, there is still some elasticity from those investors because their wealth responds to prices. So, market elasticity being non-zero despite perfectly inelastic investors, that's not true. It's just they are actually elastic. And if you want kind of the fancy way to say that, or the basic way to say that, depending how you look at it, is this is really Hicksian demand that matters here. It's not Marshallian demand. Okay. So then, okay, so that's this basic idea. So to me, there are strong ideas. There's a lot of literature, empirical, theoretical, showing how those frictions kind of move risk premium. And that's what the literature has been built around. What they do here is they embed this in the GE model. So continuous time economy, stock and bonds, constraint for intermediary, Epstein's in preferences, etc., etc. And we're still in a sci-fi movie. So it's state global perturbation method, deep neural network with vectorized automatic differentiation. Jokes aside, this is good. Like we are making progress. I remember, when Arvin and Marcus were doing their models, it was hard. It was very painful, and it seemed like the moment you're going to add something to your model, everything is going to blow up, your computer is going to blow up, your brain is going to blow up. And now we have much better ability to handle those models, and I think, I'm not going to talk much about this in the paper, but this is actually some value of the paper to teach us how to do this. But then, of course, the key question is, well, you bring the force back, GE, dynamics, does that take over microstructure? And here, the paper has two answers. One is mostly no for risk premium. So if you look just at the risk premium for various claims, everything I said before kind of goes through. And even if you want to apply this to the price of what we call high-risk assets, which are kind of like more risky than the total economy, that works fine. So you get more stuff, a little bit more stuff in those GE model because there's endogenous dynamics and so on, but at first order, that works fine. So that's what Dejanier showed us. You can get pretty realistic volatility of the stock market, pretty realistic risk premium. As a side point, the macroelasticity moves a lot across those things, and the volatility is always kind of the same. So it's not so clear the relation between macroelasticity and volatility in there. But they say yes, the force takes over microstructure for one thing, which is the price of the total wealth claim. There they find that there's almost zero, a small or zero response to wealth shock. So I want to dig a little bit into this. So the sentence from the paper, I think that Dejanier on his side is, the macroelasticity of the endowment claim is infinite, regardless of how price inelastic individual investors are. So it kind of blew my mind a little bit in the sense that I just showed you it's completely general. The aggregate elasticity is the sum of the elasticity. This is G. That's the end of G. So what's going on? Well, what's going on is really when you have multiple assets, the correct definition of elasticity is multivariate. Is how do I demand of one asset, depends on the price of every asset, how do I demand of another asset, corresponds to the price of every other asset. So here, you could think there are kind of like two or three goods depending on how you count. So there's a risky asset, a risk-free asset, and you have consumption. There's Valras law always, so you can always remove one good. So you have two assets, two prices, the risk premium and the risk-free rate, and you have a system. So the equations I wrote with demand, some elasticity and prices, it's really, now it's with a matrix. And so if you want to talk about infinite elasticity, you have to tell me there's infinite stuff in this matrix. And I'm going to say, no, there's no infinite stuff. I'm going to try to explain to you with some hand waving that really the reason you get no response is not infinite elasticity, it's about the shocks to demand. In this model, a flow shock is passive investors wanting a higher portfolio share. What that means exactly, that means they wake up one morning, they want to buy more stocks, they want to sell exactly the same amount of bonds. So you have two demand shocks really. Those two impact price, all the prices in equilibrium, and it turns out that for the total wealth claim, under some setting, those two forces cancel out. It's not an infinite elasticity at all. It's, in a way to say that there's no aggregate shock. A flow shock is a relative shock for stock versus bond. It's not an aggregate shock to demand for all assets. So you can actually show that. So just to be clear, what I'm saying is there's no elasticity that's infinite in this model at all. There's no G magic. It's just the demand shocks cancel out. So a way you can do is kind of rotate the asset space. So everything I showed you is linear, so you can kind of reorganize assets and prices. And I'm not going to do the proof, but that's kind of how the paper works. You can rotate things to a diagonal system. So you could think, well, really you're choosing two things. You're choosing so your total quantity in the wealth portfolio, and then you're choosing deviations from that. Do you want to tilt towards risk-free? Do you want to tilt towards more risky? So you're choosing position the long-short, risky minus risk-free. Okay. And you have two prices, the expected return on the total wealth portfolio and the risk premium. And if you write things this way, what you get is that the position in the long-short of risky minus risk-free, it only depends on the risk premium. These were all the simple economics I showed you at the beginning of the discussion. We know those formulas. This is just what's going on, even with dynamics and all this stuff. But your position in total wealth portfolio is really consumption versus savings. And that one, it only depends on the total expected return. Why? There's some sort of argument, actually. So it's about an envelope condition. That is, when you save, you're indifferent between saving a little bit more in risk-free asset and risky asset. And you need homogeneity. So these are the bigger formula that Dejanier showed us. But the idea is to say, well, this system is kind of diagonal. So what I mean by that is, if you shock things in this long-short portfolio, you're shocking the price of the long-short portfolio. If you shock consumption-saving decision, you're going to shock the total price of wealth. But no, there's no cross effect. What happens with the flow shock? The flow shock is going to hit the first system, because it's going to do some relative shock of risky, risk-free. It's not going to shock your total demand for savings. Our passive investors, they don't want to save more, they don't want to buy more assets, they just want to change which assets they buy. So that's why it has no effect. It is, like, I don't mean to say this is not an interesting result, I just mean to say it's not about infinite elasticity at all, it's just relative asset shock versus total demand for assets. Okay, so the last thing I want to briefly talk about is, I kind of knew all the insights from this macrostructure stuff, so, for me, this is not that new. I hope you're all learning this. What I thought was new was really this new property of the wealth claim does not respond to a flow shock. And then I started to think, well, okay, what do I see in the real world that looks like that? So a first prediction would be to say, well, we see offsetting response of risk-free rate to flow shocks. All these shocks that increase the risk premium, we see the risk-free rate move in offsetting way. My measures of risk premium don't correlate that much with the risk-free rate, the ones I've looked at. Maybe there's something, but at least I think it would be worth exploring a little bit if we want to think that those mechanisms are relevant. The other thing that kind of bugged me, is more coming from theory, is this zero result is really about kind of consumption savings decision. And the way I describe you those models, intermediary, passive investors, and so on, is coming because we have a lot of insight on how they make risky decisions, how they choose among assets. I don't think we know that much about how they make optimal consumption decision. To make this concrete is like, how do passive investors compared to active investors make consumption decisions differently? Do they optimize these decisions, the passive one, or do they also not optimize? What does that mean? And those details will change the model quite a bit on this front, and I'm not sure we know much about this. If I go to the intermediaries in the model, it starts to sound just crazy. Like, it's like, you know, I think that's a Stavros joke, actually. It's like, what's the IES of Goldman Sachs? I'm not sure. The last thing is, and this, I don't know the answer to that question, actually, but I would be curious to know, you know, is there something for which this a counterfactual or mechanism for which this claim plays a central role? Are there kind of economic questions, maybe for our colleagues who are macroeconomists and so on, that you need to understand this claim very well? Because in a way, you know, a lot of that literature is interested with, like, you know, why stock market crash, why bond markets crash, why they move, and it seems like we're doing pretty well. So what do we need from this? Okay, so let me conclude. When you grow up a little bit more and keep thinking about Star Wars, I think what you realize is the magic is really, it's not the Force or the droids, it's kind of like all of it together. It's like when Luke is, you know, is like piloting his X-Wing and he uses the Force to beat the Death Star. And this paper is kind of doing this. It's trying to bring those things together. I think it's good. It's telling us, you know, our field is exciting and kind of like coming together. I think it's good to have a clear quantitative benchmark of where these ideas of heterogeneity in financial markets matter. And I think I don't want to downplay this kind of new computational tool that is, you know, part of why the literature went to simpler things is because it was just getting too complicated and not transparent enough. And I think there's hope with these new methods to get better at doing all of this together. Thank you.
Greg, I think it's a very nice paper. Just in terms of philosophy or where to go, I think the main change is you need to check. So here we are aggressively changing the demand for assets, but here we're keeping the consumption demand fairly rational with that definition. So I think so. In the paper we write, there's a obscure sections 5 where you general equilibrium, etc. And you wrestle with how to keep the interest rate constant. And then we decide to bridge the agent. We think it's schizophrenic. So you have an investor who trades animal spirits for flows and stuff like that. And you have a consumer, the same investor. The consumer doesn't really believe the stock market signal, etc. And looks just at fundamentals, like just dividends, but not fluctuations in equity premium. And there's a fairly rich micro evidence on that, more in the household finance stuff. There's an early paper by Stefan actually, and Baker and Webler, where people react to changes in dividends because they see that as stable in their consumption, but not just to changes in PE ratios. And so maybe that's what people do. They say if there's a fundamental change in the stock market, then I do consume more, but it's a change in just this volatile PE ratio. I don't really trust it for my consumption. That would be a way to, like Valentin was saying, to make the consumer more realistic, like agree to this micro. And then you can solve these issues, and then you can get a completely stable interest rate.
Cool paper, great discussion. I wanted to ask you a question alluding to something that Val said, which is to give you an opportunity to connect a bit to Genco and Lustig. The model in particular seems quite related, and so I think it's certainly valuable to revisit those types of models with the modern language of aggregate price elasticities. But if you could also speak about whether the particular frictions, the set of agents you have, how they're related to that paper, where they're different, and to what extent that's important for matching the aggregate moments.
I find Val's discussion on thinking about this as a 2-by-2 substitution between risky asset and a safe asset is a very important way of thinking about this question. I think that enlightens that there are two forces that work here. One is how willingly people substitute between stocks and the safe asset. I think, when I sell a stock, probably I would park the money in my bank or put it into a money market funds. And then the second question is how elastic is the interest rate to a flow in that money market. So I think both of the two would determine the equilibrium elasticity in the stock market. Now, the first one might depend on some behavioral frictions. The second one actually depends on monetary policy implementation. Because once the short rate moves, the Fed gets anxious. And then they might want to control a tight corridor. And also we know the T-bill market is extremely elastic. If you throw $100 billion, it barely moves. So these two forces would be useful, if you unpack these two forces and how that shape your result.
Yeah, so really exciting paper. I think is, yeah, I'm blown away. Can I just, so I think Valentin made a very good point about the rotation of the asset space. I'd like to suggest an organizing principle for this debate, which is basically separating what macro people care about, which is essentially the effect of allocations, and that's going to be, I think it's just the price of the stock relative to consumption. That would be the one to watch for this sort of, there was an old debate with, Talarini and so forth about like when the risk premium goes up, does investment go up or down? And that's exactly the same question, I think. The second question is who gets rich or poor, and that's what we tend to focus on. And there, I think the answer is a little bit more complicated.
Why don't you take these questions and then we can come back to the floor.
All right, so let me try to start with Xavier. I think it's absolutely, I think for us, the idea was, let's give a first pass where we try to understand this question with an interest rate determination that is as standard as we could make in some sense. So that's kind of what we wanted to understand first, because I think this is particularly important when you want to extend this to other dimensions. So when Hal mentioned monetary policy, in the paper we have an extension where we show that this connects beautifully with like a model with monetary policy, and you can start to think the interactions between inelastic markets and monetary policy reactions, and how that affects like the natural rates and things like that. So that's, I think, it's important, I think, to have like a benchmark. In terms of evidence, and I think it's also connected to some of that Val mentioned, I think that thinking about some of the frictions on the consumption side, that's also particularly important. For instance, having some hand-to-mouth consumers. My impression is if you make it passive, guys, hand-to-mouth, would not necessarily change much of the story that we're telling here. And in terms of evidence, I think the basic idea that we have is something like Gabe, Charles Hyde, and Alp have emphasized of the wealth effects of the stock market. The idea that this movement in the stock market somehow have like these real implications, and that's a bit like at the heart of what we're doing. I think think of this last of a defense of the standard determination of the interest rates. It's like, this is the benchmark where we start, and we're fully on board on, we need like richer and better models of that for sure, right? So, who's the next?
Yeah, and Rohan's point about Hono's paper, you obviously cite Hono's paper, and it just relates to misallocation of risk, right? So you have like intermittent rebalancing, so people can't rebalance, and basically leads to misallocation, and then directly at Bayesian ratio relates to the inelasticity the way we define it. So that's Rohan's point.
In some sense, to be very clear, we see ourselves as following Hano.
Yeah.
That's basically, it's really about making this rebalancing frictions like central and very important, and we think this is actually crucial to understand this aggregated market elasticity. It's just like the application is slightly different, but it's pushing the importance of these frictions for macrofinance in general. I think that's absolutely on point. Right? It was like,
because Wenho's point was, yeah, the 2x2 points taken. So you asked about the monetary policy. So we have a whole extension about monetary policy in the paper. So you might think, oh, Fed is going to control. So we have a production economy with Fed, the monetary policy rule, Taylor rule that has, inflation targeting, and we show that this is actually exactly what a monetary policy would implement. So we have monetary policy as an appendix, which we didn't have time to talk about.
and Tarek on the, I like the idea of like emphasizing like what's the macro people care about and what I guess the people here in this room care about. Part of the point is when you're asking a question about flows between the bond and the stock market, some of these forces that we think more like the macro side, they become first order. I think like that's a bit of the question. If you're, I guess when you're talking about the micro elasticity of stocks or substitution between Apple and Amazon, these things are kind of like probably second order and you don't need to think about them so much. But when the question is really about the interactions between bond market and the stock market, this becomes crucial. And also I think like another thing on the question on, is this elasticity with respect of the interest rate to flows like big or small? I think the fact that the markets are inelastic is an indication that this elasticity in equilibrium, it cannot be that large, right? So because otherwise we wouldn't see it, right? The interest rate would have set. So in equilibrium, this is very small. But part of the point is, if you force it to be smaller zero is one thing, to endogenously getting it to be smaller zero is a different thing, right? So the point is allowing it for it and trying to understand why this flows actually don't affect interest rate so much is important, I think, germane to this question.
Let's take a few more. We got Barry.
Is it on now? Okay, it's on now. Really fascinating paper. Something that this sort of canceling that you guys point out really smacks you in the face with is this idea of, maybe the notion of elasticity we have in mind, especially on the consumption savings margin. There's a really big difference between the short run elasticity and the long run elasticity. If the Fed goes out and changes interest rates by 2 percentage points during this meeting, none of us are going to do anything probably for months. And so there's kind of this, you can also see this in 401k plans where people, even really high income people, like 200K and above, 20% of them aren't even picking up 100 cent on the dollar matching rule. And so we kind of know that these consumption frictions are pretty real and important. Pat Adams had a nice job market paper showing some of these effects. So could that be part of what's going on, is just no one's really doing the wealth consumption ratio equal, being equal like that at every instant, like what's happening in the model, and that could be driving a lot of these extra effects?
Right, so you have this infinite elasticity for the aggregate market in a finite one for the claim to equity, okay? And the key difference between them is this S process, okay? And I didn't hear you talk much about the dynamics of that S process and why they're reasonable. So how do I know you aren't picking your kappa S to get the results you want? What is pinning it down? And also, if you want to talk about the economics of that, to me it sounds like it's a corporate leverage story, because you are interpreting the B as a corporate bond. So why don't you talk about aggregate leverage dynamics? And that might help you justify the choice you're making for your kappa S.
Any other questions from the floor?
Really interesting paper. I have a follow-up question to Val's points about the nature of the shock that you're investigating. Going over there? Yeah, sure. The nature of the shock that you're investigating in terms of the, what exactly happens when this flow shock occurs. It's both in terms of the across assets, what is the nature there, where does the flow go out and in, but then also to think about the dynamics of that flow shock, right? Because if, depending on what that flow shock does in terms of resolution or further build up in the future, that further affects how things look. And so, just talking about a flow shock is not quite to the point. We really need to understand when we have an empirical setting, what exactly are the dynamic and cross-sectional features of that flow shock. And so that is then matching that flow shock property to the empirical result is really the key. And so I would like you to comment on that. Thank you.
Okay, back to you guys.
Yeah, so let me try and go in reverse order. Absolutely important. If you look at that formula that I show, we're full of colors in there. One of the things that enter in that thing is exactly the persistence of the shock. So this is a fully dynamic model, forward-looking, and exactly the thing that you're talking about matters. If I make the shock very transitory, this goes away. If you go to that model and you take the limit where this, what I call a kappa P, captures the how fast this mean reversion is, make the thing go to infinity, so the shock is super, super transitory, everything goes away. So are you absolutely right? This is crucial. This actually has had some implication to some of the things that Val was talking about before. That even that thing on the mapping the aggregate price impact to the inverse of the matrix, that works beautifully on this static demand systems. Things that are a lot more complicated when you have dynamics. Right? So I have actually a different paper just looking on that. But here, because this is actually fluid dynamic, in the simple model, that's perfect, everything works beautifully. On the more dynamic model, things are more complicated. It's not just even inverting the contemporaneous response. You have to take into account all this dynamics. So this is absolutely first order for us. Harjwat, you're absolutely correct. So that's one of the things that we learn here is that it seems that this leverage dynamics or how risky it is actually of first order. So right now for the quantitative, like at the end, we're not being super simple. We're basically, for the quantitative, we're actually basically killing the dynamics of S for the dividend claim, just making it the dividend riskier than the endowment claim, but make it a dramatic Brown emotion. Think about signing it on or like able type of things. Right? It's just that it's imperfectly correlated. It's not like quite able. But I think doing a more careful investigation of that, I think it's actually quite important. On Larry, I also super sympathetic to that. The only thing that I want to emphasize is one is heterogeneity on this thing, right? So again, the same way that we talked about of hand to mouth, I think it's this inertia forces I think are very important. If we can learn that elsewhere, some of these forces they kick in, and I think that's some of the lessons of many of our Hank models. Once you have these hand-to-mouth guys, or guys with inertia and frictions, and some other guys that maybe like may react a bit more. But I'm very sympathetic to the idea that again we want to go beyond this standard very neoclassical interest rate determination to reach your models of that. But the lesson is this matters even for this question.
Okay. Yeah. So I think Rajani covered most of the points. Just to touch on Harjot's point. In the end, in the quantitative calibration, we do Bansal-Yaron calibration, where the dividend volatility and the correlation between dividends and endowments are basically what they have in the paper.
All right. Thanks, everyone.
Maybe got a break now? No. Wow. Okay. Cool. Some more coffee.
Very nice.
Thank you. Thank you.
Hey, how are you doing? Nice to see you. Nice to see you.
That was also probably very exciting.
Yeah, I mean, you could just
Oh,
Yeah.
I was asking Claude.
Okay, great. Firstly, thank you so much for having us on the program. I think the paper today morning and the discussion by Amy, I think really helped set up this paper. So this paper is joint work with Julie Fu and Jane Lee, and I'm Manav Chowdhury. So let me start with the picture. So here I'm plotting the spread between the 5-year Treasury yield and the 5-year OIS spread. So under no arbitrage, the spread should be 0, but what we saw in March of 2020 is the spread considerably widened. And the Fed, seeing this, was concerned that markets were dysfunctioning, so they decided to aggressively intervene, initially announcing $500 billion of Treasury purchases, which they then extended to being unlimited until the spread finally came down. Now, the reason I want to highlight this is because today, both in the academic literature and policy circles, these arbitrage spreads like the Treasury OIS, cash future basis, CIP deviations, are increasingly used as a gauge for intermediary capacity. And the logic for this, I think, is quite intuitive. You know, intermediaries like hedge funds and dealers should be actively arbitraging these spreads down to 0. So if you're seeing these spreads widen, well, it means arbitrage is breaking down, and hence intermediary capacity is scarce in some sense. Now, we think this logic is incomplete, while useful, is incomplete in a couple of ways. Well, firstly, in practice, there are many different types of intermediary frictions out there, and not all of them are necessarily going to be impeding spread arbitrage, even if they're limiting capacity. So at least these frictions may not be showing up in spreads. And I think second, and arguably more conceptually importantly, the intermediate frictions we really care about are not those that drive spreads, but the ones that drive yields and price levels, because it's really these that pin down things like firm borrowing costs, discount rates, the transmission of monetary policy. And so I think completing this logic is really the goal of the paper. And so specifically what we try to answer here is which intermediate frictions drive yields, which ones drive spreads, and what does one reveal about the other. So to answer this question in this paper, we're going to do 3 things. The first is we develop a model in which intermediation costs jointly price levels and spreads. And I think this helps bridge your traditional intermediary asset pricing theories that are usually about the price level to a lot of the empirical evidence that's used to support it that tends to come from these arbitrage spreads. Now, specifically in the paper, we've got 2 types of balance sheet costs. The first one are risk-based costs. These penalize the risk of the portfolio. And we show these are the ones that disproportionately matter for moving yields. The second type of cost are gross position costs. These penalize the size of the balance sheet, regardless of the amount of risk. And since arbitraging spreads has less risk but takes balance sheet space, these are the ones that disproportionately end up moving spreads. Now this sort of heterogeneity is really the key tension with the standard using spreads as a gauge for yield distortions logic. Now if you're in a gross cost dominant world, well then spreads do work well as a gauge. However, if you're in a risk cost dominant world, you can have a situation that yields are relatively quite volatile, even though spreads at least appear quite calm. And so to really understand which of these two costs are dominating in the data, the second thing we do is we develop a sufficient statistic to separate these two costs out. The economic idea behind the statistic is that when the demand shocks in the economy, well, the intermediary has to use costly balance sheet space to absorb these, and since they're the marginal agent, prices in the economy have to adjust to compensate them for these costs. And so it turns out in a pretty large class of asset pricing models, including ours, the price dynamics following a demand shock can help reveal the structure of these intermediation costs. So with the sufficient statistic in hand, we then apply it to the Treasury and OAS market. Specifically, we use demand shocks using high-frequency windows around Treasury auction result announcements. And the key finding is that the key intermediation cost relevant for yields is really risk costs. So in other words, we live in a risk cost dominant economy. Now it's true that during crises, consistent with spreads widening, position costs do become higher, but even then risk costs still play an important role. In fact, when we calibrate a model to the COVID episode, so the first figure I showed you, we find the spreads, if anything, overstated the rise in yield distortions. Now, the key takeaway of the paper is that spreads may not be informative about yield distortions because risk costs are the dominant cost facing intermediaries. Okay, so let me sketch out the model. So at a high level, the model has two assets. There's a cash asset and a synthetic asset. Think like treasuries, and for the synthetic, think a derivative like swaps. Both are claims on the same fundamental value, so under no arbitrage, they should have the same price. Now, the three agents that trade this asset, the first are noise traders. These are the source of exogenous demand shocks that hit the two economies, two markets. And our second agent then are intermediaries, sort of the key people we really want to study. They function as cross-asset arbitrageurs, connecting the prices in these two markets together, and they're really the first responders to these demand shocks, absorbing them on their balance sheets. And then the third set of agents are institutional investors. They're price elastic, and importantly, they adjust their position slowly. And so they function as slow-moving capital. They're mostly here as a modeling device to generate sort of meaningful empirical dynamics that have been documented elsewhere. Exactly what generates those dynamics is not too important for what's going to follow. Now, the costs we want to study sit within these intermediaries. So what do they actually look like? So these intermediaries choose positions in this cash market and the synthetic market, and the goal is to maximize the expected return on their wealth. And they're going to do this net of two costs. So one is going to be risk costs that are going to increase in the variance of their wealth, and the second are gross position costs that are increasing in the size of their position squared. So you might be asking, well, why these two costs in particular? Well, it turns out any constraint you might write down up to at least a second order approximation is going to impact intermediary behavior by imposing a combination of these two costs. So as I said at the start, risk-based costs, they penalize the composition of the balance sheet, so i.e. risk. And so regulations like stress tests or constraints like value at risk limits predominantly function through this channel. Whereas gross position costs, these penalize the size of the balance sheet regardless of the composition. And so regulations like the supplementary leverage ratio or the fact that you put up margins when you trade for each leg of the trade, they predominantly work through this channel. Now intermediaries, as I said, they connect these two markets. They specifically do that by trading against mispricing. And there are two types of mispricing that are relevant in this economy. The first one's level mispricing. So this is when the cash and synthetic prices deviate from the fundamental value V. And the second is relative mispricing. This is when the cash and synthetic prices are not equal to each other. And which of the two balance sheet costs bite depends on which of the mispricing these intermediaries are trading against. Now to see this, it's helpful to rotate this problem into a space of the positions necessary to trade against the mispricing. So specifically, if you want to trade against level mispricing, you take what we call market positions. So essentially, you're going to go long both assets, you're going to short both of them. Now, of course, this takes balance sheet space, but also because the positions are pointing in the same direction, it means there's still a lot of risk left on your balance sheet. And so both costs end up biting for market positions. On the other hand, when you're trying to do trading against relative mispricing, you have to take what we call hedge positions. So you're going to go long one asset and you're going to short the other one. Now, this does take balance sheet space, but importantly, because the positions point in opposite directions, a lot of the risk nets out. And in equilibrium, cash and synthetic assets end up being quite highly correlated. So the convergence risk is quite small, so it's predominantly the gross position cost that really bites over here. Now in equilibrium, the intermediary is the marginal agent, so the price and spread dynamics need to adjust to compensate intermediaries for these two costs. And so we find that the expected return on the level is equal to the marginal cost coming from market positions, so the ones relevant for level mispricing, times the size of the market positions these guys take. And the expected return on spread returns, the expected spread return, is driven by the marginal cost on hedge positions, which is predominantly gross position costs, and the size of these hedge positions they take. Now, this connection between returns and costs is what drives the key propositions of the paper. So the first proposition is, if you're in a world in which gross position costs are zero, then an equilibrium and zero spreads always exists, right? So the logic is, well, in this equilibrium, hedge positions, as I said, net out risk. And so if there's no gross position cost, it's costless to do these hedge positions. And so you do infinite amount of it and you sort of arbitrage these spreads down to zero. And I think this helps clarify the rule of thumb that I started this presentation with. Well, essentially, if you're seeing these no arbitrage spreads widen, yes, you're picking up capacity is limited, but particularly because of position costs. And I think the second proposition clarifies and I think completes this logic. So what we find is that risk costs raise the variance of yields more relatively, whereas gross position costs relatively raise the variance of spreads more. And so what this means is that if you're in like in one of the corners, if you're in a gross position cost dominant world, then the rule of thumb works well. These spreads reveal the yield frictions we care about. Whereas if you're in a risk cost dominant world, well, then spreads can appear relatively calm, even though the yields are quite distorted. And so in this sense, spreads can mislead. So whether the rule of thumb works or not is ultimately an empirical question about which of these two costs is actually dominating. Right? So one way we could try to measure this, and I think sort of Amy's discussion sort of highlighted the issues with this approach, is we could try to go to holdings data. Now, our goal is to find these costs for the representative intermediary sector as a whole. Now, the issue is holdings data is often sort of incomplete. You don't observe, say, hedge funds, maybe you only observe banks. It's not clear who exactly the marginal agent is when you have to aggregate it up to the representative. The data is often lower frequency, so you can't observe these sort of fast trades relevant for these arbitrage spreads. And so we're going to sort of sidestep all of that by leveraging an equilibrium argument. So specifically, it turns out, and I'll explain this in a bit, but the initial decay of the price for impact following a demand shock reveals the marginal cost we want to measure. Now to see why, suppose there's a demand shock in the economy, so the intermediary is going to absorb this shock using their costly balance sheet space. And so as a result, there's going to be price impact. And then these slow-moving institutional investors are going to enter and take those positions off the intermediary's inventory, which is then going to cause that price impact to decline. Now, when I started this paper, I thought this would help us identify it, the price impact, but the issue with using the level of price impact to identify the cost is that it's really driven by two components. One part in red is a transitory component that reflects the intermediary's compensation. This is where the marginal cost we want to measure live. However, the intermediary internalizes that, well, they're going to be selling to long-term institutions eventually, and so their sort of eventual demand is also relevant for the price impact, so it mixes both, so we can't identify it just from the level. But notice that if you look at the decay of the price impact, well, that's nothing other than the expected return the intermediary is earning by selling the inventory positions to these long-term investors. Now, assuming the market is competitive, or at least Bertrand competition, the marginal revenue they earn is going to equal the marginal cost. And so essentially, it's going to reveal the cost we actually care about by looking at these expected returns. The only small niggle right now with this logic is that at any given point of time, this decay rate depends on the proportion of the demand shock that still sits on the intermediary's balance sheet. But if you look at time zero, essentially by definition, the entirety of the demand shock is going to be absorbed by the intermediary. So they hold 100% of it. So at T0, the expected return is exactly, or in other words, the initial decay of the price impact exactly reveals the marginal cost that we're after. Now, specifically what we're going to go and do in the data is we're going to measure two decay rates, one for the 5-year treasury yield and the other for the initial decay of the spread between the 5-year yield and the OIS rate. Now, to estimate this, we need demand shock. So for this, we're going to really rely on the state of the art in the literature, which is we're going to use the Ray, Dors, and Goranchenko treasury auction shocks. So if you're not familiar, essentially the idea is that the treasury pre-announces its supply. And so if you look at the yield change around the auction result release, well, that should purely reflect the unexpected change in investors' demand. And so once we have these demand shocks, we can then estimate the parameters. But now, what exactly is the identification assumption we need for this whole sort of exercise to work? We need that the price dynamics reflect only balance sheet costs after the demand shock. And this will be the case if the treasury demand shock that we're measuring is one, uncorrelated with fundamental information, and two, it's uncorrelated with direct demand shocks hitting the OIS market. We just want to shift demand in one market, essentially. And we think the high frequency window helps ensure both these assumptions are satisfied. So firstly, as far as fundamental information goes, well, there's no other news coming out in this window, and I think Ray and authors do a lot of work to show this is quite robust. And the second is with regards to orthogonality to OIS demand shocks. Well, okay, so I'll try to make this logic clear, which is that auctions essentially reveal the demand of agents that are constrained to participate in primary treasury markets. And the logic is, well, if you're learning about someone's demand in the treasury market, it means in the primary treasury market, it wasn't already public in other markets. And so it must be coming from investors that are not actively trading this, at least that type of demand in the secondary market. And so in this sense, we're picking up the demand that is uncorrelated with the OIS shocks. So given these assumptions are satisfied, we then go actually estimate it in the data. We want to estimate that impulse response to price impact, sort of the plot I showed you earlier. We're going to do this using local projections, and once we have that IRF, well, we can then back out the initial decay rates from that. We're going to estimate two initial decay rates, as I mentioned. The first is going to be the decay of the yield following the demand shock. That's going to be equal to the marginal cost of these market positions. These are the ones relevant for level mispricing. And then the other one is going to be the initial decay of the spread impact, and that's going to reveal the marginal cost of these hedged positions. Okay, so that's the machinery. Just one caveat to mention. So if you saw a couple of slides ago, I told you that I measure the demand shock using the yield change rather than the quantity surprise. This is necessarily predominantly because of data limitations. But a consequence of this is that we lose a degree of freedom. And so as a result, we won't be able to estimate the level of these costs, but rather their relative importance. So specifically what we're going to measure is the contribution of risk costs to these market position costs. And the way you should interpret the thing we're going to estimate is that when this is 0%, that means position costs dominate. When it's 100%, basically risk costs dominate. Okay, so we then take this to the data. So what do we find? So here, what I'm plotting is the impulse response of the treasury yield to the demand shock and the level of the OIS rate to the demand shock. And so what you can see is when the demand shock occurs, both of them jump on impact, and then they slowly decay back down, sort of consistent with what our theory predicts. But importantly, what you see is they jump in lockstep, and then they go down in lockstep. And the consequence of this that you can see on the right is that the spread essentially stays flat in response to the demand shock. And so sort of at a very high level, if you're seeing very large responses in the level of these prices, but not much in the spread, the only way you can really have that is that if risk costs are the dominant cost in this economy. And then when we go to the data and actually use sort of a risk contribution measure, it's essentially 100%. The 90% confidence interval somewhere from like 67% to 100%. And this is quite robust to various specifications. You can sort of expand the number of tenors you use and so on. Now, you might be thinking, well, okay, great, risk costs do matter on average, but we know in crises these spreads are going up, so at least in some sense these position costs should be mattering. And so that's the next thing we look at. So we zoom in to crisis periods, specifically the GFC and COVID. Just as a caveat here, we left with very few auctions when we zoom in here. So power is a lot less here. So I would interpret this more as sort of telling us the direction of cost changes and like a very serious quantification exercise. And to help with this sort of assessing the direction, we also look at two additional measures to our risk contribution. The first is the variance of the yield relative to the variance of spread, which proposition 2 tells us should decline when gross position costs rise. And the second one is the price impact of the spread, which, assuming long-term investors' demands not shifting too much, should also rise if gross position costs go up. Now, what we find is that all three metrics, especially in COVID, indicate that position cost became more important in the crises. These variance ratios decline, the spread response increases, risk shares go down. And I think sort of as a validation exercise for us, I think it's particularly stark that most of the COVID effect is like very sharp in between Feb and March of 2020. So this is the period that we think the supplementary leverage ratio was binding, and this is sort of a textbook gross position cost. And then what we find is once you go to April, and then the Fed basically says treasuries are exempt from the supplementary leverage ratio, essentially removing this gross position cost, all the metrics reverse. Okay, so this tells us that it's true that spreads capture rising gross position costs during bad times, which is helpful, of course, but but you could still ask the question, well, quantitatively, do they really capture the amount of yield distortions out there? And to sort of answer this, at the end, the last thing we do in the paper is we calibrate our model to the level of gross position costs that we see during COVID. And what we find is that the variance of spreads increased by 81%, so very large, consistent with what I showed you in the first figure, but the variance of yields did not rise as much, around 9%. So in other words, spreads significantly overstated the relative rise in yield distortions during this episode. In the paper, additionally, we do other calibrations looking at how different regulations would impact the market. What we find is risk-type regulations naturally, like stress tests, are more important for price levels, whereas regulations such as SLR are more important for spreads. So to conclude, here's sort of a high-level summary of the paper, but like the one key takeaway that I want you to have is that spreads reflect position costs predominantly, whereas yields are mostly distorted by risk costs. And so what this means is that spreads tend to understate distortions in normal times, but tend to overstate them in crises. Okay, great. Thank you so much.
The discussant is Jonathan Wallen.
Thank you so much for having me to discuss this paper. It was a pleasure to read the paper. I want to start by giving a little bit of an overview as to what type of intermediary is being modeled here. I'll start describing specialized risk bearers, how they differ from toll takers, how arbitrageurs kind of look somewhere in between. I'll go through the model, I'll give a few comments, and then I'll discuss the empirics, how large these noise shocks are, and how they play out. So, first, the classic intermediary that we talk a lot about is a specialized risk-bearing intermediary. And to define that, think of this as someone that has an expertise in holding a narrow type of risk, and crucially is segmented from the household's balance sheet. There are a lot of empirical papers that study these types of intermediaries. One of my very favorite papers is looking at a Fruit's paper looking at catastrophe insurance. So there's a rare disaster in nature, there's a special type of intermediaries that can price that risk, they lose a lot of money, and then the price of that insurance jumps up in this market. There's a bunch of theory work that also thinks about internal capital to that specialized intermediary versus uninformed external capital. What are the frictions that prevent these specialized intermediaries from raising more wealth in these bad states? By contrast to this specialized risk bearer, you also have a toll taker. Think of a classic intermediary and define it as a market maker, someone that makes profits from volumes and spreads, but crucially doesn't take directional risk. The most extreme version of a toll taker is a broker. Their role is a special technology in matching buyers and sellers. They match the buyers and sellers and they earn a spread. A dealer, they may bear some inventory risk, they may partially hedge that inventory, and they'll be compensated for bearing the inventory and maybe trading against an informed trader. Now the model's going to think of an intermediary and call them an arbitrageur, but what is this arbitrageur doing? You can do an extreme version of risk-free arbitrage, textbook definition up there, or you can do like riskier arbitrage, which is like relative value trading. And why is this relative value trading risky? Well, it's because of the limits to arbitrage in the real world. The hedges are imperfect, there's basis risk, there's margin calls. Across the board, you see a lot of these spreads between derivatives and cash assets, which is their empirical application as well. And the general constraint is that you can't pledge the cash asset as collateral for the derivatives trade. And then finally, during crisis times, it's obviously counterparty risk. Anytime you're trading a derivative, you're taking on counterparty risk to some degree. A striking feature of this type of arbitrage is that since the GFC, we've learned, whoa, there seem to be near risk-free arbitrage spreads that are striking and have something to do with balance sheet constraints or gross position constraints. This is one of my favorite figures that shows for CIP. There are quarter-end spikes in these spreads that correspond with European banks having regulatory balance sheet constraints. Now, in the model, what type of intermediary are we modeling? Well, I'm going to show you a series of pictures. They're going to look really similar to Manav's figures. It's nice that we interpreted the simple toy version of the model similarly. We've got a cash asset and a synthetic asset, and without any frictions, they would both just be worth the fundamental value V.
but we're going to partially segment this market such that local demand shocks matter. They're going to call these noise traders. And there are going to be two types of intermediaries that integrate this market. First is a reduced form intermediary. This is going to be the slow-moving institution. Then the slow-moving institution, they'll have a portfolio, they'll have some preference portfolio, and they're going to respond to price deviations from the fundamental value with some elasticity there. There's also going to be a more interesting intermediary that they'll focus on, which is going to be their constrained intermediary, and this constrained intermediary is going to have a risk constraint and a balance sheet constraint, and that'll slow down their intermediation and integration of these two markets. How does this model play out? You can see it in the dynamics. So there's a figure 1 of their paper, which I loved, which was very helpful for me in understanding the model. If there's a noise demand shock in the cash market, instantaneously, the arbitrageur takes the opposite side of that position. And then gradually, as the arbitrageur offloads that position, they offload it to the partially elastic institution. So the noise trading in this model is perfectly persistent. So you have a noise shock and that persists forever, and then they gradually offload it to the institutional investor. Crucially though, they're not perfectly hedged. This isn't an arbitrageur in that they've hedged their position in the synthetic asset. If you see the blue line here, the position of the arbitrageur in the cash asset, and the blue line here, the position in the synthetic asset, they're immediately in response to shock, actually quite unhedged. And that's because the institutional investor is inelastic and it's very costly for them to hedge. So they're thinking of an intermediary sector where the arbitrageur, the intermediary, is doing some mix of hedged and unhedged trading, earning both a directional return and a spread. What happens to prices? Y-axis here we have prices, x-axis here we have time. So there's a positive demand shock for the cash asset, and you see that price jump up here. The pass-through to the synthetic asset happens because the intermediary is hedging in the synthetic asset, and they both decay over time over here as the intermediary offloads it to the institution. And the green line is just the blue line minus the red line, which is the spread. So I resolved their model for different parameter values to think about their proposition 2, but figuratively. So suppose I jack up balance sheet constraints and then lower risk costs. What's going to happen? Well, the green line is going to move up. The blue line responds much more than the red line. The localized demand shock is more local to the cash market, and there's less cross-intermediation because there are gross position constraints. If you do the reverse, if you relax gross position constraints but make risk constraints buying the lot, you're going to get this shape here, where both asset markets both jump up, there's very little bit of a spread here, and they decay quite quickly. Why do they decay quickly? Well, it's because the institution, it's slow moving, but it's slow moving in elasticity space, meaning that if there's a big jump away from fundamentals, they're going to be able to offload to the institution faster because the institutional investor is waking up in response to this price movement. So effectively what the paper is going to do is they're going to think about this model that says, oh, we can learn about what matters more, risk constraints or balance sheet constraints, depending on whether spreads move more or price levels move more in response to shocks. Now, where I worry a little bit about this sort of integrated intermediary approach is if in the real world you have quite different types of intermediaries doing different trades. So think of a class of intermediaries that are relative value arbitrageurs that really don't like to bear risk, and another group of intermediaries like hedge funds that can take directional risk. The OFR has some really nice statistics showing that the relative value arbitrageurs run around with a leverage of about 25 times. While if you look at hedge funds that are sort of macro or credit hedge funds, they're running around with a leverage of about 2.5 times. So the spread traders take a ton more leverage. Why? Because they have a balance sheet constraint, but they're not able to bear a lot of directional risk. And then when you look at crises, here's where I worry a lot about sort of lumping this intermediary sector as like an integrated sector that can share capital between these two types of intermediaries. A worry that I have is that if a crisis is featured with near arbitrage becoming less arbitrage-like, in other words, if margin calls or counterparty risk, if arbitrage becomes less perfect in a crisis, it may not reflect gross balance sheet constraints, but rather that arbitrage has become riskier. And that these specialized intermediaries that are really good at doing relative value trades are really bad at bearing risk. So when you see spreads blow out, it's not that SLR was really, really tight for the dealer banks, but it's that hedge funds that were running around with a leverage of 25 times suddenly had to make large margin calls, and tail risk VARs jumped up, and they're delevering during this period. So when you start segmenting the equity capital between specialized risk bearers and more pure play arbitrageurs, you're going to have a harder time separating the effect of risk price levels versus spreads nicely into balance sheet constraints versus ability to bear risk. Next, and this is an area where when I was reading the paper, before I got to the empirical exercise, I got really excited because I thought they were going to do this. They ended up not doing this and doing something else in the treasury market, but something that I would really love if the authors tried to do with their model is answer the question of, suppose I shut down balance sheet costs. What's going to happen? Well, the derivatives traders are going to be more willing to bear interest rate risk because they're earning more for it. So across the board, across a whole bunch of these trades, cash assets yield more relative to derivatives. So yeah, we can think about shocks and perturbations, but in terms of a level effect empirically, intermediaries are doing a lot, go long cash and sell derivatives. And then the investors who are willing to bear interest rate risk in the derivatives market are being undercompensated for the term premium risk that they're bearing because of this wedge. Suppose I get rid of this wedge, we're going to see a lot more interest rate risk being borne by these derivatives traders, and that may move the pricing of risk premium in the cash market. And if the cash market is what we care about in terms of price levels, that may matter. Well, crucially, you need two elements for this to work out. One, you need the derivatives markets to be large enough. In the treasury market, are they? Well, we've got about $1 trillion of treasury futures arbitrage and $300 billion of swaps arbitrage, and they've been growing quite rapidly in the past few years. So maybe, especially against longer-term treasuries where we don't have that much quantity in it. And then the second part is how elastic are these derivative traders? Are they going to respond to earning higher term premium? These are some really cool questions that could be answered in a more structural setting with this type of model, thinking about if there is a persistent directional need for intermediation that's restricting the ability of a class of investors to earn compensation for risk. If I get rid of that friction, how much more will I change price levels? In other words, if I shrink the spread, how much will the cash yield move down versus the derivative yield move up? What they actually do instead is they look at sort of, can we find a noise shock that creates a need for intermediation? And let's look at spillovers. So they're going to define the price level as a treasury yield. They're going to measure a spread as treasury yield minus an interest rate swap. And I can be nitpicky and say, oh, these two things are like green apples and red apples, not exactly the same. But I'll put that aside and I can talk to authors about that later. But the crucial thing here for identification is that this is a noise shock and it's not information. Meaning that this shock, we demand 5-year treasuries more and intermediaries are compensating and there's no simultaneous noise shock or no simultaneous shift in demand for term premium more generally. So there are two questions. One, is this shock large enough? So in terms of price space here, this is the auction tails. So they're going to just look at the yield space. They're going to look at what was the change in yields narrowly over that auction. One standard deviation is about 2 basis points, and this is for the 5-year. They're not going to try size this, but you could. And there are 2 ways you could try size how big these demand shocks are in quantity space. First, how big is an auction? About 40 billion. Okay, and then the yield change is about 2 basis points. The most naive way of doing this is just look at bid to cover surprises. How many more bids were there than previously relative to how much you're trying to auction? A standard deviation to bid to cover is about 0.26. If you multiply this by the quantity offered, that's a shock of about 10 billion. But that's sort of an R²1 relationship between yield changes and quantities. Suppose you do this very endogenous regression, how much of a coefficient would you get? It'd shrink it quite a lot to about 3.2 billion. So that's telling you about how large we think this noise demand shock is for the 5-year treasury market. You could do something way more sophisticated. You could look at the actual demand schedule curve of bids, and that would give you an estimate of 7.5 billion. How I do that is here, from publicly available data, you can measure the slope of the bidding schedule, and you see that the difference between the offer amount and half the offer amount on average is about 5 basis points. So for a standard deviation shock in yield space, that's about half of that. And if you multiply that by offer amount, you're getting about 7.5 billion. So this noise demand shock for a 5-year treasury auction is somewhere between 3 billion and 7.5 billion. and that's the size of the shock, that seems really small to have this type of intermediation effects, especially over the course of multiple weeks that they're looking at. Right? Dealer inventories of just treasuries, not thinking about all of their other fixed income instruments, is about 250 billion. But sort of maybe small things do matter for the dealers. One other way of looking at this is, if this is information and not intermediation effects, we would expect to find it in places that seem far away in a hedging space. So the way that I'm going to look at that is look at spillover effects, where I'm going to use these yield changes here, and on the left-hand side, I'm going to have other yield changes. What other yield changes? Well, let's go first for the US and the entire term structure. This tells you that for the on-the-run 5-year, how they respond to the auction shock is a 1 basis point auction shock is 1.3 basis points in the on-the-run 5 yield. That's not statistically different from 1. So it could just be a full pass through the secondary market on the run yields. But what's more striking is that the 30-year also has the same effect. And the 1 year, it's smaller, but there's there as well. And if you start extending and reaching, you're going to see spillovers where places where you think it's unlikely that dealers are doing hedging. So in other words, when the dealer sector has a noise demand shock for our 5-year treasuries, is it likely that they're going to G10 yields and hedging that $5 billion shock in German bunds or French oats? Unlikely. But you're seeing spillover effects in the yield space for the G10. One of my favorite ones is if you go to the Swedish kroner, an interpretation of the noise effect is that you'd have intermediaries hedging their position in Swedish kroner government bonds from this $5 to $10 billion shock. Seems unlikely. It seems much more likely that at auction, when we're learning about investor demand for treasuries, it's not just US investors, they're global investors. And we're learning information about term premium demand in common. And what that would tell you is that when we're seeing the spillover from treasuries to OIS, it's likely not due to an intermediation channel, it's rather due to an information channel. So, to wrap up, what I think is really cool about this paper is that it provides a very nice framework for thinking about risk constraints and balance sheet constraints, and then the relative importance for the two of them. I think it'd be really helpful if we also separated these two different types of intermediaries, because equity capital is partially segmented between these two intermediary types. Back in time in history, when you had large dealer banks that did both of these types of trades, equity capital may have flown more easily between the two. But now we have hedge funds that do relative value and hedge funds that do not take directional risk. And crisis periods, large spreads may not tell you that SLR is really tight, but rather that relative value hedge funds are now trying to bear a bit of imperfect arbitrage risk, and that's causing them to massively delever. Second is, I think that the empirical exercise, more structurally thinking about, suppose we shut down balance sheet constraints, what would happen to the level of price levels, because these spreads are restricting the quantity of risk that derivative traders can bear, is a super interesting question. I think a more suited empirical exercise for their model. And the idea here is that there's a persistent directional need for intermediation that may impact price levels, rather than these sort of local perturbations and noise shocks that are going to be really hard to find for markets as large and liquid as treasury markets. I really enjoyed reading the paper, and I encourage you to do the same. Thank you so much.
Very interesting paper. I have 2 questions. So first, how did this relate to, say, consumption-saving decisions versus portfolio choice decisions? Say, if you take a GE model, think of consumption-saving decisions as driving the yield levels. Think of portfolio choice decisions as driving the spreads. Then if you have separate fractions in these 2 margins, the yield is not gonna, the level is not gonna inform the spread. So I wonder, to what extent is this isomorphic to the 2 types of costs you're describing, or is there something like different and unique? And then a related question, I wonder how fragile is the identification scheme to the assumption that you're saying the cost is on intermediate arbitrageur balance sheet. If I think about slow-moving arbitrageurs coming at different speed to trade against levels versus spread, are you saying like this is also a reflection of 2 types of cost?
You have a question on gross margining.
So the question is, so in the olden days, you could not cross margin, so the risk was on it. So it would be a little bit like your holding cost, but once you can cross margin, it's essentially then it's like a risk aspect. But both the holding costs, I mean, if you can't cross margin, it's a little bit, it's also risk related. So how do you handle that in a sense?
Yeah. So here the separation, as in the model, it's just a one period. But when the dealers are doing this swap treasury arbitrage, they are actually doing the longer maturities as well. As also in your data, it's 5 years. Now, if you build a term structure model incorporating the both, actually at a 5-year horizon, the risk part, is very dominant at the 5-year because, you can't hold it for 5 years. A lot of dealers, they have to offload the treasury swap. Even if it's 5-year maturity, they might offload in the middle. So there's a divergence risk they have to bear. So that would feature into the risk aversion part. Now, the second comment is that, if you think about the balance sheet cost, it's highly nonlinear. If the dealers hold a relatively zero balance sheet cost, then in a quadratic time cost setup, its marginal cost is 0. But when the dealers are pushed to hold more and more, the marginal costs start to shoot up. Now, I think that would help you to give us a sharper test. For example, if you look at how much imbalance it absorbs, use that as a conditional variable to look at the response of the spread to identify this balance sheet cost parameter.
Very nice paper. A bit of a technical but not quite question about your fundamental postulate for the gross position is psi times cash holding square plus synthetic holding square. But maybe a more natural version would be the penalty for your total, let's say, duration risk. So it will be XC plus XS, the total duration risk square, and a separate penalty with psi prime for the residual, this little spread risk, XC minus XS square. And so that seems like a much more natural, but then you have two parameters, psi and psi prime. To what extent are your results sensitive to that, and why don't you do it this way?
Super interesting. I want to echo a point Jonathan made about your conglomerate or integrated balance sheet view with different types of costs versus an alternative view of really unpacking the intermediation chain of some particular trades. I think one example, maybe actually quite relevant context is treasury basis trades, because you are also looking at treasury market, in which case they're really about a tale of two intermediaries, mutual funds plus hedge funds. In that mutual funds, I mean, they face some constraints. They want durations, but they cannot do that easily. So they just buy treasury futures versus hedge funds can help them shorting treasury futures by long treasuries. In that case, if you look at basis spreads, that's not going to directly suggest anything about duration risks. I think that's some nice separation you also highlight, but you may want to extend your model. But I think it's also related to the idea of, in the end, you make the argument of maybe those spreads during crisis times are overestimating the true risks. But I guess in that particular context, right, so that could serve as an early warning sign, because if it's really about those hedge funds unwinding those treasury basis trades, then I can generate some spillover to the underlying treasury markets. So I think that could be also something interesting to explore.
I'll start and we can add later on. Well, first of all, thank you, Jonathan, for a very nice discussion. All the points are well taken, and we'll think a lot more about them in the paper. So let me take some of I'll group the questions a little bit and try to answer them. If I miss anything, my co-authors can add, and we can talk afterwards. So on the consumption and saving part, on the first question, it's actually very related to the second paper we see. In our paper, we focus more on the intermediary asset pricing tradition and focus on the type of frictions that the intermediaries have. So there's an analog there in terms of consumption saving, but we look within the intermediary sector, there's these two types of cost. One matters more for the level, and one matters more for the spread. And so what we're really trying to learn is about the frictions that the intermediary sector is taking. There's a question about identification and the speed of arbitrageurs coming in. I think one nice thing about our identification is we look at time zero what the decay rate is, and we know at that point the intermediary, by definition, absorbs the entire demand shock. The speed of the arbitrager matters for the convexity of that price impact curve, how fast that slope changes. But if I just look at time zero, then if I'm close enough at time zero, that's all absorbed by the intermediary, and the slow-moving capital doesn't play a role at that point. And on the cross-margin question, I think there's an interesting question. We separate the cost into this risk cost and the gross position cost. But in some sense, the gross position cost, like margin constraints, is related to how risky the underlying asset is. And so there's an interesting question of you can right-size the gross position cost as a function of the risk in the model, which is also endogenous. I think that's very interesting to think about what's driving the time variation in this gross position cost. So far, we haven't done that. We thought it's interesting to first separate out the term through portfolio variance risk cost versus gross position cost. Then we can think about in the background what's generating the gross position cost. And let me maybe try to take the question on, y'all brought this up and also during the discussion on the segmentation versus integration of the intermediary sector. I do think it's a very interesting question to study the heterogeneity of the intermediaries, who does what, and how different their costs are. But to our question, which is what do we learn from spreads about distortion at the price level, the connection from spreads to the price level, for that question, I think what matters is the representative intermediary sector, whether this representative intermediary sector composed of different intermediaries in the background taking different roles, to some sense is not too crucial to the question that we are interested in. And our approach, identifying from the prices and not using quantity data, exactly lets us back out the marginal cost of the representative intermediary sector. So I agree for future work we can take more into the heterogeneity, but I think for our question, the representativeness is actually crucial for our question. I don't know if I think I missed something, but maybe you can add.
Let me quickly add on the point about how to different kinds of constraints, for example, the one proposed by Xavier and margin call constraint map into our framework. We take a particularly intentionally make the constraint more stylized and reduced form so that we can easily take the data. But of course, in real world, the constraints can be in multiple forms. And the way we think about these two constraints is that the risk cost or the risk constraint is a constraint about the whole portfolio risk. It's about the covariance matrix. Now, of course, there are lots of other types of costs that are related with risk, like VAR constraint, for example, and say the risk-based capital constraint, these kind of constraints. How do they map into our model? It depends on whether it's kind of imposed on the total portfolio risk or the individual specific asset risk. If it's about the total portfolio risk, then actually it can enter the risk constraint. But if you take the margin constraint as an example, if it does have the risk weighting in it, but it does not factor in your total portfolio composition, in our framework, it kind of map into the second position cost. The way we think understand about these two constraints is that, particularly in the long-short position case, the risk constraint integrates the market because it encourages you to take long-short positions, while the position cost segments the market because it discourages you to take these kind of long-short positions. Now, to get in a little bit more detailed, technical on, for example, the constraint Xavier proposed, we actually did one example in the appendix like that. And that one, if you think about if you put constraint on like the long-short position with square root, what it does is that actually it even discourages you from taking a long-short position further than what we have here, because if you increase your holding in one position, the marginal cost for taking the short position in the other market will even be stronger. So it's kind of mapped into our framework as it goes the other way of the risk constraint.
Maybe just one more thing to address on the 5-year Treasury and OIS has a lot of duration risk. That's actually exactly why we picked that setting to study, to give this risk cost a decent channel. So that this convergence risk and potentially in underlying the duration risk is all part of the model, and that does constrain the intermediaries' activity, whether they do more level mispricing trade or arbitrage trade, depends on the pricing of those risks. So that is incorporated into the model. Interestingly, it's not in the paper, but we did look at shorter, like Treasury bills, the same analysis there, where the risk component is much smaller, it's less duration risk, and there we actually find a larger role for gross position cost compared to the risk cost.
Yeah, and actually just one small thing to add to that. We also looked at the cash future basis as well, and there also you sort of end up getting very similar results actually in both the gamma and psi decomposition too.
It's very interesting to look at returns after event as a measure of intermediation costs. This pops up in other places actually. I remember some work on shorting by Kent, and there's other work on intermediation, but I really like how you make it more structural. I was wondering if there are settings where the evidence is a little bit sharper. So for example, in the literature on QE, people have documented pretty sharply, like for kind of macro event studies, you see smaller response but very persistent, versus when you get event studies where it's clearly a relative shock, where it's about thresholds of assets being included or not. Then you get big short-term response, but they disappear very fast. And I wonder if maybe speaking to that kind of evidence would be helpful, because that's something the literature has struggled with.
A suggestion for this paper, maybe somebody else in this room. I think a deliverable in this literature would be, suppose there's a big distortion, a big panic in the market or whatever, and we see fairly divergent prices in the cash market and the derivatives market. It could be a corporate bond and the CDS, and there's a huge inconsistency between the corporate bond and CDS. Which price should we trust more? Or maybe with the fancy things you have, looking at the decay in one or the other, you can say it will be some weighted average of the two. Something like that would be a very useful deliverable.
I don't know if this one is on. Oh, so I guess Jonathan kind of said he was letting you off easy when you, like, in not questioning you on the basis risk, but I think actually that's an opportunity to get some more cross-sectional power, because there would be trades with more and less basis risk, and so that also could help you distinguish between this risk constraint and a gross position constraint.
Sure. So I think the QE shock is very interesting. We should look more into that. There's a lot of different ways the shock plays out in the data. One challenge is I think there we probably do need quantity data, because sometimes it's announcement shock, and then the quantity dynamics is less clear compared to our micro sense, where we know that the intermediary have to absorb the quantity at the moment. But I think that's something we're thinking of doing anyway in follow-up work, to think about the dynamics of quantity changes, and there we can bring in these macro shocks more. In terms of which price we should trust more, I think it's a tough question. What we define as price level is the average of the two, but I think what we can use from our model is to try to get at how much distortion there is of the price level, defined as the average of two, from the fundamentals. So that is something we can do through the lens of the model, and I think it's a good idea. The cross-sectional idea is good. We haven't done that either. I think it's an interesting exercise to compare in different settings, where do we see gross position costs matter more, which market do we see the risk costs matter more, and then map it maybe back to the institutional details of those markets. And this paper sort of make a first attempt of bridging the two, but there's a lot of more work to be done to understand the market structure better. Thank you.
Maybe I can just add one. This is more a speculative thing to Xavier's question a bit. I think, actually, when we presented this paper at central banks, I think that's a version of a question that does come up. And I think one thing in particular that we want to think a bit more about is what's like a low latency variable for price level distortion like itself. Because it seems like we have like pretty good low latency measured spread distortions. Our approach works, but it takes a bit of sample to estimate it. And that's, I think, one thing we want to look a bit more at. And I think one idea we have is that if you go to holding space, I think the model is often less noisy, the data there. Of course, you have all the issues I told you about holding, but maybe you can like look at the cross-section of holdings to measure at a higher frequency. But
Okay. Thank you, guys. Thank you, everyone. I think we restart at 1, and we'll pass the baton on to Andrea and Sydney.
Yeah, let's go fast to not have a queue of 50 people. I agree. No, that would be, but they don't. But,
No, it's because the dimensions of this line, I want to make sure that it's like, they're all going to change. Sometimes it gets distorted. And don't put these ones there yet because I'm going to make some small changes. But I just want to check whether the format works. Okay, seems to work. Let me just make sure that the... Okay. Alright, here we go.
And so do you want me to put it on?
No, I'll bring it again tomorrow because I'm going to make two small modifications. I just wanted to make sure that the format works. Sorry, a little bit... sorry. I just forgot to check whether the page numbers were showing up. And we don't have... Oh, sorry. Actually, we don't have an alternative to this, right? We have to be here.
Yeah, you can't, unable to move. Okay, yeah.
Egypt, actually, Belgium has a Egypt. It's not like Egypt and Morocco both quite good. I can see how 4 years from now, I feel like they're going to get. Although obviously now you have most of the European teams left, so maybe I'm contradicting myself. I feel like the gap between Germany and the rest of the world is growing. Well, Europe, Latin America, yeah, actually, too, a couple of times. Yeah, I know. Totally. Actually, he kind of, I think he lit a fire on the Belgian That's not just
Yeah, I wrote this, I think I wrote this down. All right, welcome back from lunch and a great morning meeting. We are going to start the asset pricing section of the day. I wanted to remind you that we do have a code of conduct, so we appreciate you guys abiding by the code of conduct. We also would like to do introductions, so we can go ahead and get started with that.
Sydney Ludwigson, NYU.
Harvard.
Jay, Utah. Here in Oregon, Illinois.
Junior Silva, Purdue.
Rodrigo Salvo, Ohio State. Gautam Gopalakrishna, Toronto.
Hannah Lustig, Stanford.
Tarek Hassan, DU. Morris Leno, Princeton. Raymond Ferrani, Jonathan Parker, MIT.
Which one, MIT?
Eric Valish, Minnesota.
Indira Puri, NYU.
Alex Michaelides, Imperial. Evan Lazarus, Berkeley.
Sam Huntsmark, BC.
Lars G.
John K.
Okay, welcome everyone. So we're really excited to have Juliana present the first paper, which will be intangible capital around the world. And I think Sydney's telling me to remind you that we will have a 20-20-20 format. And when you're answering questions in the last 20 minutes, please do not respond to the discussant unless asked to, and take it away.
So thank you so much for including this paper in the program. This is joint work with Hugh Lee, Federico Bello, and Mariana Vitorino, all in the audience. So firms increasingly rely on intangible capital to create value. In our previous work, Federico, Mariana, and I have shown that for US-listed firms, about 75% of their market value was attributed to intangible capital. Natural question is this a global phenomenon or a US one? We're going to answer this question by two driving questions. We're going to say, how important is intangible capital around the world, and what may drive potential differences that we're going to be observing? Before I go into how we answer these questions, let me show you our main results in a map. So here we show in this map the estimated share of intangible capital in each country. This is one of the main outputs of our paper. And the darker shades imply that countries rely, more of their value of their firms are coming from intangible capital. These shades go from 90% to about 30%. And we see two patterns. First, intangible capital is the dominant source of value, not only for the US, for a number of countries. And we also see that there's a lot of heterogeneity on how important intangible is. So we're going to use the rest of the talk telling you how we get here and also why these might differ. So how do we get to these shares? So we're going to go from standard literature, and we're going to think, we're going to first measure quantities of intangible capital, just looking at book stocks. And then we're going to think about also the prices of this capital. We're going to rely on the neoclassical model of growth with both physical and intangible capital. And this is going to allow us to calculate what is the shadow price of accumulating these capitals. What are these prices might be capturing? They're going to be capturing what we call adjustment costs. These adjustment costs are going to be varying cross-country. We're going to estimate them. And we're going to try to start thinking about what may be driving this variance. This is going to be the beauty of doing this across countries. We're going to see that these estimates are going to vary a lot, and we're going to link them to institutional characteristics of the cross-country. Let me give you a preview of our results. First, we're going to show you that intangible capital is crucial to understand firm dynamics, for this model to match the fit or the value of the firm. Actually, intangible capital is going to be crucial. Once we add intangible capital, the model fits the data in the range of countries really well. We have high R-squares. We also see that this capital, intangible, is going to be much more costly to adjust than physical capital. The estimated parameters for intangible capital is going to be about 6 times the ones for physical capital. And that's going to lead to significant costs of adjusting, of investing on intangible capital. We calculate about 0.9% of sales if you do a 15%. And for physical, this number is much larger, 4.5% of sales. We also find that because this is going to be costly to adjust, these costs are going to lead to a high value being attributed to intangible capital. So the medium level for the countries that I just showed you in the map of intangible value is going to be, the market value is about 60% on the medium. So the median country has about 60% of their value being attributed to intangible capital, 40 to physical. And we're going to see that there's a lot of variation in these adjustment costs. And we're going to show that this variation is not really coming from industry composition, but it's going to be coming from the country variation. So because we're doing these cross countries, we're going to re-estimate the model, and instead of calculating these parameters varying across countries, we're going to allow them to vary across country characteristics. And our estimations show that there are 3 things that really are driving these adjustment costs. We show that countries with stronger intellectual protection is going to have a lower cost of adjusting intangibles, so these lower costs are going to lead to a lower price. And stronger shareholder rights also affect intangible capital. Both of these are not going to be affecting physical capital as much, but creditor rights do really play a role in how big these adjustment costs have. What this is telling you is that if we think that intangible capital is important and we think that countries should be accumulating it, institutions really matter on how they accumulate it and the overall value of their market. So let me help you place this paper in the literature. We're going to relate to 4 strengths of literature, thinking about the literature that thinks about the quantity of intangible capital. We're going to take that literature global. Most importantly, we're not only going to be thinking about quantity, we're going to also be thinking about price. So it's going to allow us to think about what is the market value of intangible capital. The market value of intangible capital, like any other asset, is going to be prices times quantities. And we're going to show how important this is across countries. We're also going to provide measures of the size of the adjustment costs for a wide range of countries and relate these adjustment costs to country characteristics. So we're going to show how important are institutions for that. So let's dive into the model. We're going to have the standard neoclassical model of investment. Our model is going to have two inputs, physical capital, just PP&E, plants, machinery, and we're going to have a broad measure for intangible capital. We're thinking that our measure is going to be capturing R&D, brand, organizational capital, and these two inputs are going to be costly to adjust. What are these costs coming from? We think about, you're going to release a new brand. Maybe this brand is going to cannibalize another brand you have, or this brand might even fail. Think about all the changes you have in your R&D production, how some of your projects might start failing. But we also think that these adjustment costs might be capturing something more broad, like the pledgeability or the ability to collateralize these assets, and they might differ between physical and intangible capital. We're going to assume a quadratic specification for our adjustment cost that is going to have two key parameters, theta p and theta I, and these are going to be estimated from the model. The firm model is going to be quite straightforward. Firms are going to maximize their value by choosing stocks of physical and intangible capital, and their payout is going to be dependent on operating profits minus the investments, and where the investment in intangible capital is going to be expensed, so it's going to have a different tax treatment. We're going to have the two law of motions that are going to lead to the standard Euler equations. These Euler equations are going to be marginal benefit equals marginal cost. Notice that the marginal benefit is kind of a big animal. You need to think about what is your SDF, what is your continuation value. But the beauty of the neoclassical model of investment is that you can ignore all that. What we're going to be focusing on is going to be this marginal Q, which is going to be the shadow price of one additional unit of intangible investment. And the shadow price actually only depends on the adjustment costs and the stock of investment. So even though these adjustment costs are going to be estimated country level, the price of the intangible capital is going to be varying across firms. How they vary is going to be very intuitive. If you're investing more in intangible capital or in physical capital, it's because you believe that those capitals are important and they add a lot of value. So a high Q is going to be a high price and a high value. How are we going to tie the value of these inputs to the value of the firm? We're going to use the standard Hayashi result that tells you that under homogeneity of degree 1, the value of the firm, the equity value plus the debt value is going to be equal to the value of each input you use for production. In our case, the value of physical and intangible capital. And we're going to this is going to allow us to decompose and show the output that I just showed you in the map a couple of slides ago, which is that the value of intangible capital is going to be Q times K over the overall value that these two inputs provide. So here's going to be the formula for what I displayed in the map, which is the share of intangible capital inside the firm and the share of physical capital. They're just going to add up to 1. And this is going to be one of the key outputs of the model, and they're going to depend on the adjustment costs, on the stocks, and on the investment rates. So let me tell you how we take this model to the data. So first, we're going to make one adjustment. We're going to scale both sides of the Hayashi output equation by total assets, which is going to give you this valuation ratio, which is going to be the market to book value, so it's akin to a doping skew, and it's going to be a function under the quadratic specification of investment rates, capital, stocks, and also adjustment costs. Both of these adjustment costs are going to be the parameters that we're going to estimate from using data, and they're going to be at a country level. We're going to estimate this for all the major economies we have enough data to do so, and for the other economies for which we don't, we're going to aggregate them across regions. Because valuation ratios or even the market value of the firm is going to be a noisy object, it's going to be a noisy object for the US, but can you imagine doing this for 80 economies? When you work with Compustat Global, it's just a complete mess. You don't even have the price of each security. You need to actually go for security level to find out, add stocks A plus stocks B. So we do that. But to attenuate in the time that we go for the estimation, to attenuate any type of noise in this valuation ratio, we're going to estimate these using portfolios. We're going to use old trick from asset pricing, and And we're going to use these 9 portfolios sorted across lagged investment rates on each input. So that's going to lead us to, in our estimation, to match the valuation ratio between the data and the model implied. And this is going to be the estimation here, which could be estimated using a nonlinear least squares or a GMM. But actually, we show in the paper that using a quick trick, you can actually just estimate this with a standard OLS. So it's quite a simple thing. We're going to do these for using CompuStat Global and CompuStat North America. We're going to have a sample between 2007 and 2023. We're going to have 80 economies, 77 countries, and 3 territories. And I'm going to tell you how we're going to calculate the stocks of these inputs, of intangible and physical capital. So intangible capital, we have this broad measure. Notice that a lot of the times, intangible capital is not capitalized in the balance sheet of firms. Most of the times, these things are expensed. So we're going to use the standard trick in the literature to use 30% of SG&A expenditures and 20% of depreciation rate, which would lead to an average maturity or duration of 5 years. We're also going to do a bunch of robustness here. And we're going to capitalize off the books intangible coming from SG&A, and then we're going to add this to whatever the firms are going to be reporting on their books. Notice, I'm going to show you in the descriptive statistics in a minute, the majority of firms, when they're doing tangible investment, they do it off the books. So this is going to be a small share, but it's also there in case, for some firms, it is important. So we're going to add both on the books and off the books intangible, both stocks and capital. I'm going to do PP&E, physical capital, just the traditional PP&E. The only thing we're going to do here is that instead of just using CapEx for investment, we're going to follow the law of motion for capital, because many times when firms do acquisition, it's not counted on CapEx. So this allows the model to really use the best case scenario of physical capital that really matches what firms are doing. We're going to have 80 economies. There are going to be 42 major economies for which we have enough data, and then 5 remaining areas. Notice that when we do the estimation per area, we remove the major economies so that they dominate the statistics. They don't dominate the statistics. We have about 430,000 observations between 2007 and 2023. And we're going to estimate country and area-specific parameters. Just before I go there, I'm going to show you what happens on the medium, right? Because this is going to be a lot. So many times I'm going to be aggregating these across regions. However, everything is done at a country level when we have enough data. So for the 42 major countries, this is done at a country level. So here we show the first statistics, which are going to be the descriptive statistics. We see that first, intangible and physical capital investment, they have some independence. They're positively correlated, but this correlation is way below 1. So they have some independence, some independent movement that's going to help us estimate the parameters. Furthermore, you see on the column here that intangible capital is not the dominant source of capital on the books. There is an average of 42% of total capital of the firms is coming from intangible. But remember that the baseline share that I was telling you in terms of market value is 60. And most of this intangible capital is going to be internally accumulated, so not coming from on the books. They're mostly happening off the books. Only about 2% of the overall intangible capital stock is coming from on the books at a medium. So I'm going to show you now the parameter estimation, but here I'm going to show you just for the world. In the next, this is not a world estimation, it's going to be the medium across all the 47 estimated parameters we have. What is the medium? In a minute, I'm going to show you what happens for each country, but it's not very easy to see, 95 different estimates. So here we see that intangible capital is much more costly to adjust than physical capital. The parameter for intangible capital is 11, where the physical capital is about 2. This leads to significant adjustment costs. So as a share of sales, when firms are doing their realized investment rates, they spend about 8% of their overall capital stock of their overall sales in physical capital, but in intangible is about 6.9. So this is already telling you the story that, as I showed you in the descriptive statistics, the intangible capital is important, but it's not coming only from the fact that firms accumulated. A lot of it is coming from the fact that it's much more costly to adjust than physical capital. Let me show you now the estimates per country. On the top graph, you see the intangible capital estimates. On the bottom, the physical capital estimates. These are estimates for the parameter theta that drives the adjustment costs. And what we see, these are color-coded by regions, is that intangible capital is much more costly to adjust overall. not only on the medium cross country. So we see that the top graph, these are going to be in the same scale, so you can compare them. It's much more costly to adjust intangible capital than physical capital, and this is true for the majority of the countries, with some country heterogeneity. In a couple of slides, I'm gonna start trying to see what is behind this country heterogeneity that we observe. But before we do that, let me show you how the model fits. So in the first table, I have the model with only physical capital, and in the second table, the model with both physical and intangible capital. And what we see is that, for the model to do a good job across all regions, we do see that it's important to include intangible capital to capture the dynamics of firm value. Now we compare just the two-input model with both physical and intangible capital, and we see that it fits well both across all regions. You have a medium cross-sectional times R square of 0.82 with a time series of 38, but there are some major economies like the US, the model does a particularly good job. We have a cross-sectional times series, cross-sectional R square of 93 and a time series 1 of 77. So the model is doing a good job. So now we can go in and see what are actually the value or the importance of intangible capital across these countries. So this is what this table here is showing you. Remember the formula that I told you right after I gave you the Hayashi result, that intangible capital market value is just gonna be the shadow price, depending on the adjustment cost, times the stock of capital, as a share of total explained. We know that the model does a good job of explaining the value of the firm overall. So we look here and we see the highlight result that I showed you in the preview of the results is that intangible capital is the major source of value across all regions, with some regional variation. Being about the medium across all the countries that we have is about 60%. But for some countries like the US and the UK, this number is much higher, it's about 84. Now we can connect to those estimates of adjustment costs. This is not coming from the fact that these countries hold a lot of intangible capital only, right? Maybe they hold, but this is not the only source. So in the second column of each graph, we have this mu bar, which is going to be the importance or the share of the value attributed to intangible capital if we assume that these adjustment costs are zero. So it's just kind of what we call the book share. And what we see is that this book share is pretty much almost half what we have in terms of the market share. This is coming from the fact that intangible capital is much more costly to adjust than physical capital, which makes them have a higher price and therefore a higher value. So now for the rest of the talk, I'm going to start to think, why is there some heterogeneity on the importance of intangible capital? And the first natural candidate is going to be, is this the industry composition that these countries have? So what we do is that we re-estimate our adjustment costs and our values using these adjustment costs being country industry level. So we're going to use FAMA Friend 5 industries, and we re-estimate the adjustment costs both for physical and intangible capital, and then we decompose the variance that they have. And what we see is that, especially for intangible capital, most of the variation is coming from the country. Some of it comes from industry. Sure, industry is important, but most of it is coming from country characteristics. Similar patterns come at the side of physical capital, but it's a bit more muted, where industry may have importance. So now that we know it's not industry, we're going to start thinking about country characteristics, because after all, we do have, doing this across many economies, the benefit is that we can tie that down to fundamentals. So we're going to think about the determinant of adjustment costs. We have a broad idea of what these adjustment costs are capturing. We think that intrinsically these may be capturing also some ability to collateralize or pledge or even investor frictions or financial frictions that these might happen. Actually, in the paper now, we have a small toy model that connects these connect these frictions to these adjustment costs. Instead of just doing correlations, which would not make sense across many variables, what we're going to do is that we're going to re-estimate our models, and instead of allowing the data to be country specific, the data is going to depend on country characteristics. So it's going to have a constant, or it's going to have a global parameter, plus something that depends on these country characteristics. I'm going to show you, we're going to use three main country characteristics that are inspired by our model that tells you that it's coming from intellectual protection, investor equity protection, and creditor protection. Let me show you the estimates. What we observe is that as it would be expected, we see that the adjustment cost global for physical is much smaller than the one from intangible, pretty close to what we see overall at a global average. But that IP protection really matters for adjustment cost of intangible capital, not so much for physical. Equity investor protection really matters a lot for the adjustment cost of physical, where it allows for lower adjustment costs, where creditor rights is going to light up, is going to highlight the adjustment cost for physical investment. So let me tell you, kind of put these numbers in perspective. So here, what we do is that we split our countries between low, medium, and high levels of IP protection. And we're going to be plotting what is the adjustment cost of intangible capital at a 15% investment, and also physical capital at a 15% investment. And what we observe is that if you're a country with high investor protection, you're going to pay about 4% of your sales to invest 50% of your intangible capital, or if you're in a country with low investor protections, this is going to be much more costly, about 7%. This is going to have an impact on the market share of intangible capital relative to your book share, which would assume these costs to be zero. This is exactly what we plot in this last graph. So here in a darker shade, you see the market share of intangible capital for each group, and in the lighter shade, you see the market share of intangible capital if you assume zero adjustment costs. Because if you're in a country with low IP protection, you're going to be much more costly to adjust intangible capital. What you're going to see is that the market share of intangible capital is going to be much higher than the book share. And that's what, oppositely, if you're in the high, this is going to be much closer because these costs are smaller. We're going to see similar things for equity investor protection, because they also impact intangible capital, not as much the adjustment cost of physical capital. And we're going to see these differences being different. Now, when we look at creditor protection, this is going to be the last plot, what we see is that physical intangible capital adjustment cost is going to be overall kind of flat, similar across these characteristics. But then if you want to adjust physical capital, it's going to be more costly if you don't have as much credit rights protection, and then less costly the higher you have. And that's going to have the opposite. The market to book share of intangible capital is going to become farther apart, right? And this is going to be done at the realized investment rate, not at the 15%. We also do a number of robustness checks. We here list some of them instead of doing a portfolio level at firm level, instead of doing local currency and US dollar, incorporation versus headquarters. We play around with the depreciation of intangible capital that we use for inventory methods. And overall, these plus a million more that we have done shows that our key results are quite robust. So let me conclude. What our paper has shown is that intangible capital is a very important source of value and very important to understand firm dynamics. It's going to be central to understand, for the model, for a neoclassical model of investment, to explain firm value. It's going to be the dominant source of value for firms, about 60% of the market value across countries, much above the 34% of book share. It's going to be costly. This cost is going to vary across countries. It's going to be much more costly to adjust intangible than physical, and these costs are going to be associated with institutional characteristics. We have two lessons from this. One, if you want to value intangible, not only you look at quantities, but you also need to look at their prices so that you have an idea of their market value. But most importantly, if we think these things are important, institutions matter, so we need to go back to fundamentals. That's it. Thank you.
Great. Thank you. And our discussant is Luigi Zingales.
Anyway, first of all, I want to thank Andrea and Sydney for inviting me to discuss this paper. I'm an older member of the profession, and I'm not invited even to discuss paper in corporate finance, so it's a pleasure to be invited to discuss an asset pricing. Even if this is not really an asset pricing paper, I find very at home here because it's very much, at least I see it as a corporate finance paper. So Juliana did a fantastic job at summarizing the paper, so let me just dedicate one slide to tell what the paper is about, refreshing what she just said. So this is basically a model with a two capital Q theory, where the value of the firm is a combination of physical and intangible capital. And there are quadratic adjustment costs, and adjustment costs are really the central parameters of the investigation. And the valuation ratio I regress on physical and intangible investment rates. There is a little bit of an econometric aspect in which they aggregate at portfolio level, but this is basically an OLS regression. They don't need a profit function because they assume homogeneity, and there are some estimated shadow prices that split the value between physical and intangible component. And really, the bottom line is that these adjustment costs are related to country characteristic, and they derive some sort of broadly policy implication from that. Now, before I discuss the paper, I want to sort of give you a framework that is useful in this paper. It's useful, I think, in a lot of discussion. And you know, tomorrow the Christopher Nolan Odyssey is coming out, so everybody's talking about Greek mythology. So I'm going to go to Greek mythology. And I don't know if you ever heard the myth of Procrustes. I think that's the name. I don't know how to pronounce it exactly in English. But the story is the following. This was a host that had a bed, and every guy that was going there as think about the Airbnb at the time, every guy that goes to the Airbnb goes into this bed, and this bed has a particular characteristic that either shrink a person or enlarge a person in order to fit the bed. Okay? So if your legs are too long, they cut your legs to fit the bed. If the legs are too short, they stretch them so that they fit the bed. And you say, wait a minute, what this has to do with anything that we're doing? I think that this is a bit what models are about. It says, I'm the first one to say you have to interpret reality through models, but sometimes models are a bit too forced into forcing things. And if you don't let sort of data speak, you're going to find what you want to find because you're forcing, like a Procrustean bed, your data into something. Okay? So let's apply this into this paper. So the key regression of this paper, the key identification, is this linear regression, where on the left-hand side you have the market value, and on it's excess market value. It's basically market value. On the right-hand side you have the investment rates in physical and intangibles, and multiply by the two adjustment parameters. Okay, now, what is interesting is those adjustment parameters are whatever makes value above the book value co-vary with investment rates country by country. So this regression is kind of a Procrustean bed that forces to confess every deviation must be into adjustment cost. So you're putting a lot into that. And basically they identify really through this characteristic, and so I can repeat in the same stuff. Any misvaluation, omitted value component, etc., is interpreted as adjustment cost. Now, what is missing completely from this paper is the two most important words in the English language, which are market power. Okay, so market power is not mentioned once in 81 pages. Rents is mentioned once as a reference, and markup is mentioned in the literature review. Okay? And this is by assumption. Again, the Procrustean bed, you are maintaining a profit function homogeneous to degree 1, and this is not a technicality. This is saying that basically no listed firm in 80 countries earn any rent. Okay? That's a bit extreme. I understand that this is the model under sort of the famous Hayashi paper. The question is, do we actually believe that? And most importantly, what are the consequences of this assumption? Assumptions are necessary in economics, so the question is how important they are. So at some moment I say, oh, maybe and by the way, in case you have any doubt about the market power, there was this beautiful paper presented by some Chicago colleagues in accounting at the corporate finance, They look at acquisition where people disclose how long customers are locked in a firm. Okay, these are self-reveal indication of basically market power of customers. And look how this stuff went up from 2000 to 2025 is a straight line up. Okay, and this doesn't suffer of all the account the lock and account sort of markup stuff and etc. etc. This is pure evidence of basically market power. Okay, so then I said, oh, maybe I actually am not doing justice to this paper because maybe that's exactly what intangible capital is about. Okay, so let's do the simplest case, which is the case of a patent that at least I understand. So can we think about this as the intangible capital as a patent? And my understanding, as I said, I'm very happy to be proven wrong here, is that when you consider a patent, the value, the present value of the patent is of course the present value of the monopoly rents. But this value is almost by construction disconnected from the cost to produce it. Okay, because if you are lucky, that becomes a patent, but people a lot, and so in here, the model basically price install intangible capital at replacement cost plus a marginal installation premium, and under the assumption of cost of return to scale and price taking, you are forcing what is the intangible capital to be the accumulated R&D or the accumulated expenses, and is not really the value of the patent. So there is something missing here, and I think that there is a paper that analyzed this. So the solution, thank God, is very simple because you just add a term in the equation. So they add the physical capital, the intangible capital, and if you look at the Crozet and Eberly paper, there is the present value of the rents, which multiply by mu minus 1, where sort of 1 over mu is the degree of homogeneity, and basically this paper assumes a mu equal to 1, so that term disappears, but you can actually extend that. Now you're saying, okay, is missing that important? And to some extent, yes. Why? Because by missing that term, you are loading on the adjustment cost, you're loading the part of rent that is correlated with whatever you care about. So because you have no intercept, and so you are really forcing this component here onto the estimated adjustment cost. And then there are some minor issues that when you form the portfolio based on the physical and intangible capital, you are basically, to some extent, maximizing the error that might derive from this omitted stuff. So the other thing is that when you look at their results are observationally equivalent to a world in which there is actually rents, and those rents load on the intangible adjustment cost in a particular way. Why? Because in a world where you have this missing rents, you expect that because of this correlation, that the adjustment cost of intangible is much larger than that of physical. That's exactly what I find. You expect them to have more dispersion on the theta of the intangible than on the theta of the physical. That's exactly what you find. And you expect a lot of variation across country and not industry, and that's exactly what I find. So this is not saying that their results are not true. I say that the results are observationally equivalent to a world in which there are rents, and these rents are loading up particularly on their measure of intangibles. Okay, here I did a back of the envelope calculation. I don't know how valuable this is, but this is saying that with reasonable parameter value, you can attribute to intangible capital a lot of the stuff that actually is really rents. So I'm not saying tangible capital does not exist, is to say it could be, most of it is rent. I think that the sort of paper really push everything in the direction of frictions. Here you can think about that this is most of it is rent. And then there are some minor other concerns. The first one is that you really assume, and this is probably necessary, but one recipe for all the 80 economies, and these are minor quibble, but you have the same perpetual model of inventory with 30% of SG&E are assumed to be sort of capitalizable, and the depreciation is 20%. And this is true for every country regardless of anything. That's a bit of a stretch. But the more important thing is that intangibles are likely to be mismeasured, okay? And I think that the problem is that capital, intangible capital enter on both sides of the equation, so this mismeasurement can lead to a overestimate, again, of the intangible adjustment cost. If the true investment share is, for example, bigger than 30%, that will lead the capital, intangible capital to be understated, and so the theta I bias up. If you have that a depreciation that is larger, depreciation is smaller because you think about brand, Coca-Cola brand does not depreciate a lot, then you have the intangible capital understated, and then you have, again, the adjustment cost bias up. And then you expect that countries with a shorter history, they have a bigger measure of, bigger noise in the intangible capital at the country level, and that noise is worse in emerging economies, which is exactly what they find. So I think that there is an important component. And again, think about this. You are forcing the market value to capture three things. One are the adjustment friction, the other the rents, and the third is the mismeasurement. And by eliminating the two in red, you're really forcing everything on the theta. Once you decompose, you might have different results. Now, the good news is a lot of this stuff can be relatively easily tested and simplified. So if you remember what I put up, the Crozet and Eberle regression, there is a fixed term. So they have a OLS with no intercept. You can actually put an intercept in that regression and test whether the constant is zero or not. And so we see whether the model is appropriate or not. You can try to control for markups. You could test investments separately with the Euler equation, or you can, or in addition, you can derive some estimates of the adjustment cost of the intangible with some reasonable range of parameter value of mu that will allow for some market power. Now, the last point is that the paper concludes pretty, in my view, aggressively that stronger intellectual property protection, shareholder rights, and director liability each lower the cost of adjusting intangible capital, while stronger creditor rights lower the cost of adjusting physical capital. And because we normally interpret adjustment cost as deadweight loss, so the lower is the better. Now, if they are rents, do they want them to go to zero? I think this depends upon where they come from, because some of the stuff might be returned from R&D, and you don't want to bring the return to R&D to zero. Other, think about the lock-in of customers, might actually be really some wasteful activity. So again, in another paper presented in Corporate Finance, they were showing that whenever the federal fund rates is high, and so the value of the deposit franchise is very strong, banks spend an enormous amount of time marketing in order to attract depositors. And all the money spent in marketing is not really adding any value because you're subtracting a customer from one to the other. So from a societal point of view, there is no benefit, but all the marketing costs are a dead weight loss. So all this intangible capital, some of it has positive welfare implication, some of it has negative welfare implication. So when you think about the institution, a change in the institution in order to fit, I think that you need to be very clear about what kind of channel is about. And I think that also for different companies and different countries, what is the prevailing intangible capital may be dramatically different. I encourage everybody, especially in light of the picture I show you, to think about how strong this lock-in effect, because these lock-in effects are not due only to the fact that the quality of the product is good, it's the fact that it's almost impossible to get out. You know, it's much easier to get divorced than to change your bank account these days. And actually, this is proven in the facts because people are more likely to divorce than to change a bank account. And this is not an indication of the quality of the bank, because they all suck, is that you are trapped in, and they maximize the chances to trap you in. Okay, so concluding, I think that the paper needs to be praised to build a global, internally consistent map of the wedge between the market value and the measured capital. So I think that that's a very valuable exercise. I think that they label everything as adjustment cost. I think that this is more an assumption than a finding. I think that that should be fixed. If you don't fix it, then you're not sure that some of the results are not the effect of something else. But the good news, I think, is that there is a simple way to verify whether what I'm saying is a source of concern or not. And if it is a source of concern, there is a very easy way to fix it. So I really look forward to see the next version of this paper. Thank you.
All right, thank you so much. So if you guys have questions, you can raise your hand, and then I think we would like you to step up to the microphone if there's not one near you.
Questions? Yeah.
Yeah, please, you can go ahead and just get up to the microphone too.
So maybe I'm not interpreting broadly enough or correctly, but the cross-country sort of calling this, even the things you say, adjustment cost, maybe I'm not in this field enough, but I don't understand that aspect. That's where you have bad legal protections. I would think about that more as like a potential depreciation rate of your capital rather than an adjustment cost. And maybe somehow that's isomorphic. It doesn't seem like it. It's not like if you have a certain amount of it and you want to install more, that's much more problematic. It's just that once you have it, you might lose it. And so it's risky or depreciative or something. So that, I wanted some clarification on that.
Yep. Any more?
Yeah. If I think about a variable that you can measure internationally, and you had to guess, like if you have a map of that, what does that variable look like? My very strong guess is the following. It's going to be very high in the US, it will be high in Australia, it will be high in Western Europe, it will be high in Canada, it will be a little bit lower in Southern Europe and in China and in South Korea. It'll be lower again then once you get to Eastern Europe. It will then next go down once you go to South Asia, then Southeast Asia will be lower again, then North Africa and the Middle East and Central and South America, and then Africa at the bottom will be extremely low, if not missing data. And that's for almost anything you measure. And so if I think about, or at least that's the first principal component of what you measure. And so if I think about that, your map is believable, but it's believable because every map looks like this. And so I'm just wondering how you think about this. You can think about this first in terms of like the left-hand side variable. But there's another, it becomes even stronger on the like decomposition part, because I actually think you might genuinely struggle to construct placebo variables that do not also explain variation in intangible capital because of this first principle component part. So I'm just kind of wondering how you think about that.
Yeah, so I want to give you a chance to respond to Idamar's question as well, and think about the relationship between your results on institutions, which seem, very interesting that there is this correlation between the cross-country variation in, what you call adjustment costs, because that's what it is in the model. But empirically, it's just the responsiveness of investment to valuation. So you can think of it as an elasticity if the model was all in logs, which it's not quite, but let's think about it that way. And then what it's telling you is that countries that have stronger institutions give a stronger investment response to valuation. And so maybe you could talk about why that comes out of the data, and because there are models that sort of map properties of intangibles into institutions. If you think that, intangibles are less collateralizable, that they're more difficult, that they're easier to scale, and that they have other growth properties that might influence these outcomes. So maybe you could talk a little bit more about that connection.
Okay, maybe I'll just
So
ask
maybe
a couple of questions, and then if there are more, you can answer those too. So I had a different question about the identification, because this is a hard question. It's hard enough to measure book values of intangibles, and then to go and measure their contribution to market values is a really hard question. So I applaud you for not only doing it, but doing it across countries. When I was spending time with your original US paper, the issue I had was with the identification of the adjustment costs versus just the expenditure measure versus the actual investment rate. So I don't think you have identification between the theta adjustment cost and this 30% assumption that you have on the part of the SG&A expenditure that is investment in intangibles. Since this is asset pricing, I do have to say that measure did originate in asset pricing, though it got promoted much more incorporated. It's actually attributable to Mindy Xiaolan, the 30%. And then the last thing I would say is, with regard to industries, I think that also is super, super tricky, just because the industry seems to have the same global SIC code. It doesn't mean the production function is the same. So someone could be in IT and they're whatever, answering phones or something like that, and someone else is making chips and someone else is writing the software. So I'd just be a little careful about that result, but that's sort of more nitpicky.
Okay, well, thank you very much for the questions, and thank you, Luigi, for the discussion. I think I start with Jan's comment because it's related with Mars as well. I think, so clearly we have, and we discussed this in the paper, we have a broad interpretation of adjustment costs, right? Adjustment costs in our models, they can reflect many different frictions, and we might want to specify and microfound the friction in different ways. So in the paper, when we link Jan's to the point about the elasticity, the link to institutionals and the elasticity of some of the institutions. So, for example, IP protection affecting the adjustment costs. What we actually have in the paper is a toy model. Now, Juliana didn't present the toy model here because we already have one model. Presenting another one would be bad, and we might have. So basically, we have a toy model where basically we link the adjustment costs on physical capital intangible to the collateral constraints. So one thing we know is physical capital is more pledgeable than intangible capital, and Bianca Jock Market show that when we know that as a fact. And in fact, in that toy model, we can illicitly say that if it's more pledgeable, the adjustment cost, that's equivalent in that toy model to lower adjustment costs. Through the lens of that model, we think that we have a link to institutions that comes through the fact that relax some financial constraints more for physical capital than intangible. For example, IP protection affects, we say, lowers the cost of adjusting. What it means is that if it's a brand or some intangible is protected, it's more easy to use as collateral. Banks will use it as collateral, so it will more easily finance the investments, right? So in countries where IP protection is bad, that doesn't happen. So it's really a financial friction that's coming up, which manifests in our estimation in an adjustment cost form. Okay, that's one thing. So Itamar, I think this is kind of related also to your question. I think, so in terms of any variable, I mean, we can, any variable, okay, we have many variables in Compass that we can do with random variables, the estimation. I doubt that we're going to have nice and clean setup, but that can be addressed, right? So I guess the comment that any variable that varies across country will generate a good fit, I think it's, I mean, it's testable, so we can test it. Last question, you mentioned the separate identified depreciation rate and this 30% rate. I mean, the two, whether we can separately identify the adjustment costs.
Three things, right?
Three things at the same time.
Adjustment cost, the kind of fraction of spending that's investment, and
Yeah.
this adjustment.
Correct. So they are jointly determined. So here's our experience with this, and maybe since you experimented with this, it's true, as we change one, things adjust. Meaning, for example, let's suppose we change the 30% to 40%. Okay, just let's say we do that. Of course, the point estimates will change. What we see typically is that the adjustment cost parameter will change in the direction that we expect. So it's the stocks will be higher, the adjustment cost will be lower. So that's okay, so it's not identified. But when we translate it to meaning in quantities that we can interpret, okay, let's say so we have a different estimate for the adjustment cost parameter, but for example, the share that the firm value that is attributed to fees to intangible capital will not change. It's like they will not change much. So it's very, very similar. So through all our robustness check, when we changed all of these parameters, because we verify, I mean, we think we have a set of parameters that we think are calibrated the most, that make more sense, but when we deviate a little bit from that, the key results, meaning that the size of the adjustment cost and the fraction of sales, the fraction of the firm value that is attributed to physical capital, to intangible capital, those are very robust. Now, the point estimates do change. They adjust in a way to make these numbers.
So just for the stock. So if you change the stock, the parameter is going to change a bit, but the overall share will stay the same. We have done, R&D, SG&A minus R&D plus whatever is left over 30%, which is some other measure that they have used. They stay robust. We have tried different shares. They stay robust. I think we follow the literature on the 30%, which says that it's what gives the best fit to the model.
Just the depreciation from 10 to 40%.
Depreciation
all of
from
the points that,
yeah.
It's more of a question, it's the same comment as Luigi, just a different parameter not being identified, because the cross-sectional variation in how much of SG&A is actually spending on intangibles could be very correlated with everything else that differs across the country. It's just something to think about, yeah.
And I don't know, I wanted to say two things. One, you said about the industry, Andrea said about the industries. We have done it at a more granular level, more than 5, 10, 15, which would capture the heterogeneity that you're capturing well, and the results are robust. And I wanted to add to Itamar, he says, why does the ability of you to get credit is going to affect the way you adjust? Think about this. If I want to adjust my investment, I want to invest in some R&D or change the brand, I may need to borrow against that. If I can't, or if it's harder to borrow against it because it's less collateralizable, and you have a situation where your equity investors don't trust you because you have low protections, then they're going to charge you more. You're going to have to deliver them a higher return. That's a little bit what these things are capturing. So you can think about the same way for physical capital as well.
Yes.
Just wanted to give you a chance to respond to Luigi's comment about market power.
Absolutely.
I'm sure you thought about this.
Thank you.
Sure. No, I mean, thank you for bringing that. So we don't have in this paper the word market power. I didn't notice. We had it in a previous one. So basically, I mean, it's homogeneity of degree 1 is operating profit function. So, for example, in a previous paper we show that you can have that case could come from a production function that decreasing returns to scale. And for example, in that paper we have brand. So brand capital is a good example here. So we don't think brand produces anything. It's not generating output. So it's not an input in the production function. Well, how it shows up in operating profit function is because exactly brand affects demand through market power, increases investors' willingness to pay through market power, and that translates, it's going to be affected, shows up in operating profit function. So what we say is that in the previous paper we show that homogeneity of degree 1 of the operating profit function is, I mean, we can microfound it. We have, it's consistent with a setup where you have production function with decreasing returns to scale, demand that is depends on the brand capital stock, and firms have market power. So so that is there. So it's not no, we don't explicitly back out the market power, but it's in there. We have the way we measure the marginal cost in the equilibrium is equal to marginal benefit. The marginal benefit in Euler equation, the right-hand side that was there, is the marginal, how much the profits will increase in the future, and that could come through market power, and indeed it comes. It's just that we don't separately identify that parts that is attributed to rent, but it's in there. When the firms are investing in rent, they are investing because it's going to increase investors' willingness to pay for their products, and therefore their profits in the future. So it's in there indirectly through the investment Euler equation.
Yeah. Okay. And there we had also done some analysis, and you can see that if you split the firms across, you know, the Locke et al. Market power into low and high market power, you're going to see that intangible capital is going to be higher at firms at high market power. We never wrote that. We just tested it because we thought about it. But, you know, we can always write that paper too.
No, but sorry, but the capital as you measure, the intangible capital, is measured at cost. So take Coca-Cola. It's true that they spend advertising, but the value of the rent produced by the brand Coca-Cola is not measured there. Because it's not in the accumulated expense.
Of course, yeah, but that's not our measure. Our measure is quantity times prices. What you're talking about, the book value, the accumulated past expenditures, that's the quantity. And we think it underrepresents the quantity of the value of intangible. That's our key headline result. Why? Because then you need to multiply that quantity, which is the past expenditures, to how the value of each installed unit of capital. How do you get that measure? If Coca-Cola is investing a lot in intangible, it's because they perceive that the measurable benefit in the future is high, so the installed value is high.
The reason why you can measure the stuff
Why it is priced.
at replacement cost is because you're a price taker. Otherwise,
but we don't measure at replacement cost.
The capital, intangible capital, is measured as accumulation of past investments.
That's the stock, the quantity in the balance sheet. That's not the value. I think Juliana mentioned the point is that we try to measure the values, quantity times price, and the price is what the model is telling us. Quantity we can all measure through the perpetual inventory method. That's it. But that's vastly undermeasures the importance of intangible, because then you need to multiply by the value, and that's what the model is giving us. The reason why we have a model is because we want the price, which is through the investment Euler equation.
And this price maybe.
And the intuition is in this class of model is always the same. If you see a firm investing a lot, it's because, I mean, the assumption here is that the firm managers are doing the right thing and optimizing firm value. That's a question that we can debate. But here the point is that the firm is investing a lot, it's because it says the high value. That's it, one-to-one. High investment rate, high marginal Q, high value. So you might have a small stock of installed capital, but if that firm is investing a lot, that installed capital is valued a lot. And that's the value. That's our point. Okay, and we think it's important. The market values are, we always know, previous work has found that intangible is important, but most of the time they look at book values, like accounting, past expenditures. What we're saying is that even though already found this important, is even more. Because when you look at the valuation of this object, it's even higher. So I think that's the point of our analysis.
Okay, perfect. So we'll end on that note of the, why this is in asset pricing. It's because of market values, explaining market values. All right, so 15-minute break. We'll see you at 2:15.
you're all set up, I was going to put some slides on, but is there a break between the next one? Yeah. There's another break. Then I'll just do it now.
Okay, we're about to get started, so if everyone wants to come in and enjoy this next paper. All right, I'm so glad the coffee breaks are so good. But we will get to the next excellent part of the program. We are excited to hear about expectations and inelastic markets by Francesca. Take it away.
Great. So thank you very much for including my paper on the program. So while traditionally asset pricing models were mostly evaluated on prices, in recent years there have been two important new research programs that have brought in new data and facts to our understanding of asset pricing fluctuations. One program has focused on expectations and on how investors form beliefs, and another program has focused on quantities and how investors form and adjust their portfolio holdings. And so in this paper, I'll start thinking about how these two programs can inform one another by studying how modeling beliefs can help us in an understanding of inelastic markets. So prior work has shown that markets seems to be surprisingly inelastic, meaning that investors don't seem to adjust their portfolio holdings much in response to price changes. And this has been framed as an important puzzle, as empirical estimates of demand elasticities are several orders of magnitude lower than what can be achieved via frictionless theoretical models. And so this has raised two sets of questions. First, to what extent can at least part of this gap be attributed to some discrepancy between the theory and empirical objects that are being compared? Or in other words, what exactly are empirical estimates able to identify, and what is the theoretical objects that we should be comparing it to? And second, once identification is taken care of, what contributes to markets being so inelastic? In this paper, I'll show how modeling expectations will be central to answering both of these questions. First, I'll show that once we depart from the full information rational expectations benchmark that has been used in prior work, we'll gain further clarity on what empirical estimates are able to identify and what theoretical objects we should be comparing it to. And second, I'll show how demand elasticities themselves depend on the information environment and on how investors form beliefs. So let me just spend some time explaining why expectations are central to answering these questions, and then I'll preview results more fully before jumping into the model. So empirical estimates of demand elasticities are generally recovered from inverse price impact or the inverse multiplier of shocks that shift the supply curve while leaving the demand curve unchanged. However, identifying these types of shocks in the context of financial markets can be especially challenging because asset demand is forward-looking and depends on investors' expectations of future resale values. What this means is that if a supply shock is persistent, investors might realize that that will lead not only to higher prices today, but to higher prices tomorrow as well. This will affect their expectations of future resale values and shift the demand curve itself. This, of course, then poses a challenge to identification, as the estimated price multipliers will then confound a movement along the demand curve with a shift in its intercept. But crucially notice that whether these demand curves shift or not depend on expected future resale values. But despite the central role of expectations, prior work has mostly focused on the full information rational expectations benchmark. And so in this paper, I'll relax the assumptions both of full information and of rational expectations by importing tools from the information economics literature. And with this added structure, I'll uncover three sets of results. First, once we allow for incomplete information, the identification requirements for shocks to only shift the supply curve without shifting the demand curve become substantially weaker. Very intuitively, if a shock is unobserved to the investors whose demand curve you're trying to estimate, then that shock will not shift their expectations of future resale values, therefore it will not shift their demand curve, allowing for identification. Second, I'll show how demand curves themselves depend on the information environment and on how investors form beliefs. Learning from prices contributes to making markets more inelastic, and the more so, the more informative prices are. And third, once we turn to biased beliefs, I'll show how mislearning from exogenous fundamentals only affect the intercept of demand curves, while mislearning from prices also influences their slope, meaning that only mislearning from prices can help us in jointly understanding the evidence on excess volatility and inelastic markets. But so overall, this analysis will show how we can learn in both ways. By modeling beliefs, we can learn to better understand the evidence on inelastic markets, and vice versa, the evidence on inelastic markets can help us in distinguishing between different models of belief updating. So in the rest of the presentation, I'll start by revisiting the Gebeck-Huygens framework and highlight where the assumptions of full information rational expectations come into play. And I'll then relax those assumptions by allowing for both incomplete information and ultimately for biased beliefs. So I'm going to start from the framework that Xavier and Ralph introduced in their paper. So assume that investors are solving a portfolio choice problem between a single risky and a riskless asset. And following that framework, I'm going to assume that linearized asset demand is given by the following expression and is effectively decreasing in the current price and increasing in investors' expected returns. We can then use the definition of linearized expected returns to obtain a demand function which is decreasing in the current price and increasing in investors' expectations of future payoffs. Now, for us to make any further progress in specifying investors' demand functions, we need to specify what determines investors' beliefs about expected future payoffs. And so let me start from the full information rational expectations benchmark, and then I'll gradually relax that. So under the full information rational expectations benchmark, investors perfectly observe flows and dividends, meaning that they also perfectly observe all shocks. They also know the data generating process, and they understand market clearing. What this implies is that investors understand that prices reflect the present value of all expected future dividends and flows, meaning that if shocks are persistent, they understand that those shocks will affect both prices today and prices tomorrow, meaning that persistent shocks will affect their expected future resale values. And so to illustrate this while sparing you the math, I'm going to denote investors' expectations of future payoffs as a function capital Pi of current and observed flows and dividends. So now that we have a sense of how investors form expectations of future payoffs, we can go back to our asset demand function and notice that because investors' expectations of future payoffs purely depend on exogenous fundamentals which they observe, expectations of future payoffs are going to enter the intercept of this demand curve if we plot it in QIT PT space. From this demand curve, we can then start thinking about what are the demand elasticities and price multipliers. So the demand elasticity, I'll define it as being the response of asset demand to an off-equilibrium change in prices while holding fixed everything else that is an investor's information set. And so according to this definition, the demand elasticity is simply going to be the slope of this demand curve. We can then also look at what determines price multipliers in the settings, because remember that ultimately price multipliers is what we're able to estimate empirically and from which we recover our demand elasticities. So price multipliers are going to be the equilibrium response of prices to exogenous flow shocks. And as you can see from this expression, they have two terms, which I'll break down for you graphically. So the first term in this expression illustrates that if we have an exogenous inflow, think for example an index inclusion, this will automatically reduce the residual supply that's left for that investor, meaning that we have a mechanical increase in price coming from a movement along the demand curve. But we also now have a second term, which is coming from the fact that if the supply shock is persistent, investors understand that that will also affect prices tomorrow, so that will affect their future resale values. It affects their willingness to hold the asset at any given price, shifting the demand curve, and the price multiplier now confounds both a movement along the demand curve and a shift in the intercept. And crucially, as long as investors have full information rational expectations, we will always get this shift in the intercept unless shocks are fully transitory. If these supply shocks are fully transitory, then it will not affect your expectations of future resale values. But as long as shocks are persistent, we will have price multipliers confounding movements along the demand curve with a shift in its intercept. And of course, this is a pretty stringent requirement to identify shocks that are fully transitory. So in what follows, I'm going to think about, well, if we relax the assumption of full information rational expectations, first, how does that change the requirements on shocks needed to identify these demand elasticities? And second, once we relax full information rational expectations, how does that also change the slope of the intercept in and of itself? How does it change the demand elasticity in and of itself? So to do so, I'll start by introducing incomplete information. And effectively, I'm just going to assume that investors no longer perfectly observe all flows and dividends. Instead, they receive noisy signal of dividends, and there's also an unobservable residual supply shock, which in standard Grossman signal side of types of models also ensure that prices aren't fully revealing. So to understand how investors then form expectations in this environment, I'll then import tools from the information economics literature and distinguish between two canonical concepts: the competitive equilibrium, which assumes that investors only form expectations based on exogenous signals that they receive, and the rational expectations equilibrium, which instead also assumes that investors can also learn from prices. And so in what follows, we can see how demand elasticities and demand multipliers teach us different things under these two concepts. So starting from the competitive equilibrium, under the competitive equilibrium, investors only learn information from their exogenous signals, meaning that expectations of future payoffs still only depend on exogenous fundamentals. They do not depend on the current price, meaning that once again, expectations of future payoffs only enter the intercept of this demand curve. What this means is that the demand elasticity is going to be exactly the same as what we had under the full information rational expectations benchmark, but what changes is that we can now think about the price multiplier with respect to both observed and unobserved shocks. So for observed shocks, we have exactly the same result as we had before. These shocks are in investors' information sets, and so as long as they're persistent, they're going to shift to the demand curve, and so we're not able to identify demand elasticities from these price multipliers. But if instead shocks are unobservable, meaning that they're not in investors' pre-price information set, then they cannot affect investors' expectations of future payoffs directly. And so we will not get a shift in the demand curve. And so these shocks can instead be used to identify demand elasticities. And so notice that by just allowing for incomplete information, we've been able to substantially weaken the requirements needed for shocks to identify demand elasticities. We no longer need shocks to be completely transitory, but rather we just need shocks to not directly affect investors' expectations of future resale values, which will occur if those shocks are not in investors' information sets. So to see how this distinction might actually be empirically relevant, we can use it to try and reinterpret some of the multipliers that have been used to identify demand elasticities in prior work. And crucially, the shocks that have been used to identify demand elasticities in prior work do differ in their information structure. So some shocks, like index inclusion events, are pretty public, pretty observable, and so it's pretty reasonable to think they are in investors' information sets, and so they will lead investors to update their expectations of future resale values. But other shocks are instead perhaps closer to being unobservable, especially shocks that use designs on flow-induced trading. So, and as an example, we can go back to the granular instrumental variable approach that Ralph and Xavier use in their paper. And in their paper, they effectively try and estimate the demand curve of a given sector or a given group of investors by using residualized flow shocks from other sectors. Now, under full information rational expectations, those shocks will not identify the relevant demand elasticity unless they're fully transitory, because investors would recognize that those shocks are persistent and therefore affect future resale values, shifting the demand curve itself. But if instead we allow for incomplete information, then there is hope for identification. The reason for that is that if the investors whose demand elasticity you're trying to estimate do not perfectly directly observe those residualized flow shocks from other sectors, then they do not enter their information set, they will not affect their expectations of future resale values directly. And so we will be able to identify demand elasticities from these type of designs. And so once again, incomplete information effectively allows us to weaken the requirements that are needed for shocks to identify the relevant demand elasticity. What I want to turn to next is how departing from full information rational expectations doesn't only change the requirements for identification, but it also changes what the demand elasticity looks like in and of itself. So to do so, we can move to the rational expectations equilibrium, which assumes that investors don't only learn from their exogenous fundamental signals that they receive, but they also learn from prices. So their expectations load on the current price. If we now put these type of expectations back into our demand function, we see that since investors learn from prices, we now have a different slope v-intercept decomposition. Another way of saying that is that learning from prices makes markets more inelastic. Very intuitively, prices now have a dual role. On the one hand, they have a scarcity role. If the asset price goes up, it becomes more expensive, we want to hold less of it. But on the other hand, it now also has an informational role. If the asset price goes up, it tells us that other investors had good news about it, and therefore this will lead me to want to buy more of the asset, therefore dampening the original response. So learning from prices makes markets more inelastic, and the more so, the more I load on prices. The more informative prices are, the more I'll load on prices, and the more inelastic markets are. And of course, in the limit, when prices are fully revealing of fundamentals, demand elasticities are actually perfectly inelastic. But overall, demand elasticity depend on how investors form beliefs and on the information environment. Now, crucially in the paper, I also show that this is in fact the demand elasticity that we would recover with unobservable shocks in the rational expectations equilibrium. So the demand elasticities that we recover isn't just capturing the scarcity role zeta, it's actually capturing the full term zeta minus kappa mu p. And if you just do some simple numerical simulations, allowing for learning from prices can actually be quantitatively meaningful in that it helps us reduce the gap between theory and empirical estimates of demand elasticities by about an order of magnitude, therefore suggesting that this channel might actually be important. Before briefly mentioning biased beliefs, I also want to make a quick note on counterfactuals. What I've shown you today is that demand elasticities depend on the information environment and they depend on how investors form beliefs. Now, crucially, this does not mean that we can't do counterfactuals. But what it does mean is that to do counterfactuals, we should use demand elasticities that are estimated in similar information environments. And the flip side of that story, of course, is that if we're also interested in aggregate outcomes and multipliers, we then also need to think about how certain shocks affect expectations, as shifts in the intercept can be just as meaningful as the slope of the demand curve in and of itself. But if anything, this reinforces even more the need to jointly study quantities and beliefs. Finally, I just want to very briefly mention results on biased beliefs. And to study biased beliefs in the paper, I relax rational expectations along the same two dimensions that were captured by the competitive equilibrium and the rational expectations equilibrium by studying mislearning from exogenous fundamentals and mislearning from prices. Now, when we only look at price data, these two classes of biases are often quite hard to tell apart because they can both lead to large multipliers. But the picture looks quite different when instead we look at elasticities and quantities. While mislearning from fundamentals only affects the intercept of the demand curve, mislearning from prices will also affect the slope, meaning that only mislearning from prices can actually contribute to both more excess volatility and more inelastic markets. And so this last result kind of highlights how looking at data and quantities can actually also be informative in helping us in distinguishing between competing models of belief updating. So just to conclude, in the paper I'm interested in understanding how modeling beliefs can help us in understand the evidence in inelastic markets. To do so, I relaxed the full information rational expectations benchmark by borrowing tools from the information economics literature, and I uncovered 3 sets of facts. First, once we allow for incomplete information, the identification requirements for shocks to identify the relevant demand elasticity become much weaker, as unobserved shocks no longer shift investors' demand curves, therefore allowing for identification, which wouldn't have been possible under full information rational expectations. Second, I showed that demand elasticities depend on the information environment and on how investors form beliefs. Learning from prices makes market more inelastic, and the more so, the more informative prices are. And finally, when we turn to biased beliefs, I showed that while mislearning from fundamentals only affects the intercept of demand curves, mislearning from prices also affect their slope, meaning that only mislearning from fundamentals can help us in jointly explaining the evidence on excess volatilities and more inelastic markets. But overall, I hope the message from the paper is that by jointly studying quantities and beliefs, we can learn lessons in both ways. Modeling beliefs helps us in understand the evidence on inelastic markets, and the low levels of demand elasticities can actually also be informative in distinguishing between competing models or belief formation. That's all I have, and I'm very much looking forward to Daniel's discussion. Thank you.
The discussant is Daniel Graves.
Hi everyone, special thanks to Andrea and to Sydney for inviting me here to speak. I'm very excited to talk about Francesca's paper, Expectations in Inelastic Markets. So just to give you an overview of what I'm going to do today, I'm going to give a brief overview of the paper, kind of give you a few of the highlights up front. Then we're going to think about generalizing this paper to have constraints. We're going to very briefly spend one slide talking about censoring. I promise very little censoring today. And then we're going to talk about a many asset environment and how this paper's main statements generalize to a many asset environment and how our interpretations might shift even if the paper's main ideas are still conceptually the same there. And then I'll try to put it together at the end. So to start with, kind of a lot of text on here, but to sum up the paper in basically one slide, what is this paper doing? Among several of the things it does is an identification theorem. If we want to go ahead and look at a shock to prices and look at that price multiplier, we have a flow in, how does the price shift, and then back that out to get somehow the slope of demand, this elasticity parameter, then if the shock does not directly shift expected payoffs, then we're going to ride the curve and we're going to get this to back out. If this holds, belief effects have to be limited to price-based updates in order to actually have this condition hold. That's sort of this sufficient condition in the paper, is that being outside investors' pre-price information sets is going to give us this condition for free. Essentially, if the investors at the time did not have this information, then they're not going to adjust their cash flow expectations about it. They're just going to ride the curve, essentially, and we'll see that visually in another slide. And so 2 simple examples of what Francesca talked about at the very end of her talk about mislearning is that if we mislearn about fundamentals, this is fundamentally an intercept story. For instance, there's some cash flows, you think they look stellar, it turns out they're not. You're going to shift your demand at any level of price up because you think the company's doing great when it's not. If you mislearn from prices, then you're actually just changing the slope of how you react to price wholesale. You're changing that, so you're basically riding the curve differently. As prices rise, you might be more willing to hold on if you're over-inferring from people driving the price up. And this model is a single asset environment. It's a frictionless portfolio, and you fully observe the quantities, and we'll talk about each of these pieces as the talk goes on. This paper strongly connects to the information economics canon and some microstructure literature, and the paper's contribution is this information set identification criterion and the endogenous slope it produces, and this kind of taxonomy of biases that I just mentioned. And this connects to the slope-intercept split that's been addressed recently in the literature, but I won't have too much time to go into today. And so the paper's main equations, just to briefly explain them, the first equation is the demand equation. You have the quantity on the left, we've got the elasticity here where you're moving along the curve right over here, and then over here you've got this belief term. The cap is kind of important. It's how much you're loading your quantity on your beliefs about future prices and dividends, and then there's these latent flows. And the price multiplier that we get is going to be this total derivative of price with respect to a flow. And what you're going to get here is this ratio of 1 to this stuff in the denominator. This is the belief fixed slope, the elasticity object that we're kind of after. And phi f here in one of this paper's model sections is basically persistence. Think of it as like the opposite of an AR1 coefficient. So if phi f is 1, this thing is sticking around, it's fully persistent. So in that case, if it's fully persistent, this thing is going to kind of cancel out. Sorry, phi f is, yeah, got that backwards. Phi f is 1, this thing is going to go away. That's a transitory shock. It's going to disappear. If phi f is 1, it's going to stick around. Sorry, 0. The main decomposition here in the paper is the total derivative of price with respect to a given shock z. You have the direct flow f into here and how that changes as a function of this shock. Then you have the belief shift from the intercepts. And the bottom, you have the belief fixed slope that we've already talked about and some kind of learning from prices. And this is kind of natural. You have things that are going to shift your perception of future flows. You have your belief getting shifted. And then you also have the curve getting bent because you might be learning from prices somehow. And in the paper with rational updating, you're going to set this learning from prices piece to be equal to this Kalman gain times the inelasticity parameter. So the submitted slope is going to look a little different. You're actually going to be more inelastic. Why are you going to be more inelastic? Because you're actually picking up something from prices, kind of in the standard RE framework mindset. So what does this look like visually? We already kind of saw this in the talk. You're just going to kind of ride the curve if you have this hidden flow shock. Hidden flow shock, you don't know what's going on, flow comes in, you're riding the curve. On the other hand, if you have this observed and persistent shock, you're going to both get an intercept shift and you're going to ride the curve also. And these two effects of shifting the curve up and riding the curve are going to get conflated into the multiplier that we actually recover from the data. So now to kind of talk about where I want to go today. So empirical researchers, what are empirical researchers really interested in here? We want to estimate elasticities, we want to conduct some counterfactuals, we want to maybe analyze some policies, something like that. But what if we inhabit a world where there's actually constraints, where the data is actually sometimes censored, and where we actually have a many asset environment instead of just a single asset? Which results in the paper are unchanged, and which interpretations are going to actually shift? And in the empirical data, what do we see? We see hedge funds, banks, various institutions. Some of them have short sale constraints. Some of them are leverage constrained, as we heard about earlier today. You've got zeros in the 13F filing data that are implicit, and you have a cross-section of assets instead of a single asset. And what's interesting is this paper's main information set logic remains, actually, as we'll see, in all of these different extensions, which is quite nice. What's going to change, however, is what we're recovering. Our interpretation of what we're recovering is going to change quite significantly. Instead, the multiplier is actually going to become basically a state of the world in the presence of constraints as opposed to a universal object. It's going to be differentially useful for applications, as Francesca was talking about with the counterfactuals, and it's actually going to become a direction instead of a single scalar, and we're going to have to think about the geometry of these shocks as opposed to just the magnitude. So just to start with kind of constraints and level shares, this is a very standard way to set things up. You have some, short sale constraint. Quantity has to be positive. Let's assume the asset's in positive supply. And then you also have a margin requirement. So 1 over m is just how much leverage you're going to be permitted. If m is super small, you're able to lever up massively and buy a ton of the asset. And this is the single asset environment. And none of this, I'm not going to do any of this in the paper's log deviations, with log linearization, you're not going to get things to bind. So what happens here is demand with your usual caret utility type setup, you're going to get something very simple. There's going to be 3 possibilities here. Either you're going to be stuck at 0 and on the sidelines because you're short sale constrained, you're a pessimist, you can't get in the game, you can't bet against it, or you're at the interior solution where you actually have the slope B, or you're capped. You love this thing so much you want to leverage up, but you can't because you're capped by that 1 over m limit on your leverage. And so what's going to happen actually is the slope that you're going to recover is going to be this mass-weighted average of these different arms of the slopes. The extensive margin is going to be people coming in off the sidelines, off that kink, and you're going to have that the extensive margin here is not really a local slope object anymore. So what does this look like visually? This is the pessimist. They're just not going to hold much of this thing no matter what. This is the median person, and these are the optimists who kind of want to hold a lot at any price. What's going to happen is, depending on what the price is, and what the environment looks like, with lambda equal 1, lambda here is the fraction of people who are in the game, who are actually participating. What if everybody's in the game? Then we get the elasticity as 3 times zeta, so like pretty elastic market. What happens when we get all the way over here and the only people in the game are the extreme optimists? Then all of a sudden we get the elasticity as 1/3 lambda, if there's only 1/3 of them left. Everybody else has left, all that's left are the optimists. The slope looks different. Now, lest you think I had any kind of original insight here, this idea of the slope being a state is a very old thing in the literature. You can think of the leverage cycle of John Giannakopoulos, the margin liquidity-related work of Brunemeyer and Peterson. You can think, if you like the crash and multiplicity, crash of 1987, you can look at Janot and Leland. This kind of intuition has existed in the literature for a while. So what changes here? What happens is that the inverse multiplier really is recovering a state of the world. So if we make some basic assumptions that I don't need to go into that are all pretty standard, like marking things to market, what you're going to get is the actual zeta hat that you're going to recover is going to be a combo of these two things. The zeta is going to get scaled by the interior pool. So we get kind of this mass time slope channel. You could think of this as it's actually zeta scaled by how many people are in the game versus on the sidelines. Then you have the leverage pool. Omega is the fraction of shares held by these leverage-constrained investors who wish they could lever up even more, but they can't because they're stuck at their max. And M, again, is the margin. So 1/m is the leverage that those folks are allowed. So I just explained those terms. So moving on, what the zeta hat gives us is a local aggregate elasticity, a combo of how these individual beliefs react to different states of the world. So what is zeta hat as opposed to the zeta that we're offering trying to recover? It's history dependent. It can be asymmetric because as you get outflows, you might actually tighten these caps and force sales on some of these folks. Omega might change. And then it actually turns out to be shock size dependent as well because both lambda, the people on the sidelines, and omega, the mass of shares held by the levered up people, are both going to change. So you can actually get things that are locally unstable. You can have global multiplicity. Again, that's more of the Janot-Leland style idea that's been around for a while. So what happens if we invert the slope and we really want to get zeta? If we want to get zeta here, you're going to have to deal with this ratio. So we're actually going to have to figure out the inverse multiplier, which we can go ahead and that's the thing we can estimate. But then we have to figure out kind of the people on the sidelines. We have to figure out that zeros in incidence term. We also have to go figure out the balance sheets, which are not found, for instance, in 13F filings. And it might be that zeros can help us determine who's on the sidelines, so we might be able to take that to the data. We might be able to use balance sheets to go think about who out there is at their maximum leverage amount and what those maximum leverage amounts are. And, these are some various forms that you might try from SEC filings to try to decipher this, even though I think it might be challenging. And between the prices and the constraint incidence, we might be able to recover zeta. But I think this points to a way of doing research that I don't see having been attempted before, which is, as a field, we might try to put all these pieces together to try to recover this object. And so you also have indexing effects and the active versus passive balance that you can see in some of the recent literature as well in benchmarking intensity. And this is going to complicate things because estimates from different decades where you have different fractions of people who are kind of rigidly locked into their mandate versus who are actively managed are going to lead to these zeta hats being different states of the world for that reason as well. So basically the paper's observable intuition, however, remains completely the same. There's no shift in the basic information story, but other interpretations are going to change. First of all, intercept attribution is going to change significantly. If we introduce some kind of funding wedge, then this is going to be observationally equivalent to a shift in belief. And in my job market paper, there's a similar concept that works out in a static model where it's impossible to kind of separate out the shadow value of relaxing a leverage constraint versus just being bullish dogmatically about all the different stocks. Those two forces get lumped together. There's also dispersion changes in the spirit of Miller once we have short sell constraints. So the Miller 1977 story of people on the sidelines leading to overvaluation, that's going to start to pop up here as well. In the frictionless environment, some kind of mean preserving spread is going to make this story irrelevant. But here, that lambda, the people on the sidelines, is going to matter a lot. And also, that's going to mean that the gain from learning is also kind of basically a state of the world where how much we should get out of prices should be a function of who's on the sidelines. If there's a lot of smart, informed people on the sidelines, their beliefs are not being impounded in prices because of those short sell constraints. So now we're asking that the individual investor not only map things back to figure out information, but they filter that through the lens of who's on the sidelines, which is quite important. And so, what might we estimate instead? One potential quick example is if M naught is kind of this observable shock multiplier and MU is this unobservable shock multiplier that Francesca's paper does a really nice job of explaining, then basically we could think about creating a ratio conditional on doing everything in the same state of the world and try to force those lambdas, those people on the sidelines ratio thing, to cancel out basically. And that would leave this, where G is the gain, zeta we know, kappa is based on, like you saw earlier, on how you kind of adjust your quantities relative to your expectation of prices and dividends. And then phi f is this persistence parameter. So leverage here, however, will enter additively. So unfortunately, even this ratio that cancels out the lambda is going to get contaminated by leverage entering here. And so one idea on how to do at least this ratio test, if we found the right data, is you could use dividend reinvestment flows in the spirit of Hartzmark and Solomon, and you could also use GIV from Göbek's and Koyen, and then you could try to match all the different elements so you could actually get this ratio and cancel the lambdas. That's one way forward. And briefly, I wanted to mention why censoring does and doesn't matter here, since I've written about this before, and here it turns out to not matter that much. So there's censoring implicit in 13F filings. They report the long positions only, and this can alter how we recover demand estimates, basically how we go about doing demand estimation. And there's two types of censoring. You've got economic censoring, where you're basically stuck at a short sale constraint. You're stuck at a corner solution. That's one type of zero. The other type of zero is a statistical zero. It's actually, there is a negative value in there, a short position, and we just can't see it. And so that's going to be missing data. And it turns out that for flow-based price shift designs, like this paper's applications or Göbek's and Koyen, these are going to be less impacted by this type of statistical censoring. It turns out that what's going to matter is economic censoring, because what you're going to get is that the estimand is actually an average of local multipliers over the different states that the instrument visits. It's not one thing, it's an average of over a bunch. And that in the IV case, you can get that intuition from Angus, Grady, and Immons, or in the OLS case from Yitzhaki from like 1996. So for cross-sectional holdings designs, it's going to be different. So what you're going to have happen there is actually the statistical censoring is going to lose your ability to point identify things. You're then going to have set identification, and you're going to have to think very carefully about how you construct these beliefs or make assumptions about what these distributions of beliefs look like, what lambda and omega look like. And what I'll do in this last part of the talk, in my last 4 minutes, is let's go ahead and introduce some matrices, because that's what everybody's looking for late in the afternoon. So let's go ahead and stack all the scalars into matrices, and so now we are dealing with n assets. And the equations all start to look the same. But what changes is now, instead of getting a single multiplier, we start to get kind of directions of shocks that percolate all throughout a bunch of different stocks. And you think about this, you buy Coca-Cola, do you think Pepsi's going to stay still? No, Coca-Cola and Pepsi might co-move a little bit because they're both soft drink companies. And so what happens is that a lot of this paper's results generalize really nicely to an arbitrary n-asset environment, essentially unchanged. Hidden shocks still invert to the, this, if PR is partially revealing and Z is like zeta, it's just, in English and capitalized, then if you have this unobservable hidden shock, you're going to still just be able to take the inverse. Great. But what's going to happen? Learning now changes how elastic the market is. It also changes which directions are elastic. It actually kind of rotates your coordinate system, basically, with the matrix. This wasn't talked about in the talk, so I'll skip that. And fundamentals mislearning basically moves the observed multiplier only. Price mislearning, moves both. That's exactly like in the paper. It generalizes very nicely. What changes is what we back out of this. So if you do in the scalar case the simple, like we have the perfect kind of shock, let's take zeta, let's do 1 over zeta, and that's the multiplier, and we're good if we have the exactly right shock. Here it turns out you get something a little different. Yes, M equals Z inverse in the right case, but 1 over the specific element of the diagonal is no longer the same thing. You get a Schur complement by matrix inversion. So what you get now is you get the partial equilibrium effect as if other prices are fixed, and then you get this feedback that percolates, the general equilibrium effects. You drove Pepsi up. Now Coca-Cola goes up. But now because Coca-Cola went up, because Pepsi went up, it feeds back into demand for Coca-Cola. And all these effects have to be accounted for, and that's what this does over here with the matrix algebra. And so ZNN is the partial equilibrium counterfactual, and 1 over MNN is the policy counterfactual, where you let the market re-clear. And so this equilibrium feedback is actually very important for things that are close substitutes, where this thing starts to become very big on the right-hand side. So you can imagine twin shares, you can imagine on-the-run, off-the-run treasuries, or other similar objects. And it turns out that the full spectrum of directional elasticities that we get out of this is the spectral theory of the elasticity matrix Z. And you can already see how this might connect to like Admati's job market paper and published eventually in Econometrica in the 80s. There's a lot of that comes into play, this multidimensional thinking about directions of learning that comes into play here. So in summary, what I would say is elasticities essentially contain multitudes. This paper's core ideas remain even if we generalize to constraints in many assets, but elasticities become difficult to interpret and state dependent basically when we do this. And one thing that we should all think about is how common are flow shocks that do not enter participations information sets, which is one of the core insights of this paper. We should be looking for those and figuring out where they hold and for whom they hold, and that's a big agenda item. And empirical researchers need, I think, to determine what it is that they're actually recovering when they go out and run the regressions. Are we in a constrained world? Are we in a many asset world? What does this object actually map to? And this is a paper I really enjoyed reading. It basically adds this nice information set criteria to the demand system asset pricing literature and elasticity research. And I'll conclude with my last 30 seconds with the empiricist checklist. What would I do if I were thinking about elasticities and multipliers? I would first check in the paper's taxonomy whether the information is hidden and observed. I would check the state, who is constrained, how levered, like in this talk. I'd think about the direction, like we heard about last year with the causal inference paper, relative meso versus market. I treat every estimate I get as a local estimate. I would also think about ratios potentially to see what I can get to cancel from some of these ugly terms that pop up in the analyses. I try to understand what the zeros really mean, and I'd want to potentially look at balance sheets to go a step beyond and do that for the leverage analysis. And thank you so much for your time.
Thank you for a nice talk and a nice discussion too. This is really interesting. In our paper with Paul and Derek a couple of years ago, we were interested in passive investing. And we thought, well, when there's passive investing, people have different information, we have less information in the market, and we wrote a Grossman-Stiglitz model. Not quite the same as the one you do, but well, much of these concepts show up. And something that came out of this was a little bit like you mentioned, that changes in information environments are going to change the whole demand system. People's elasticity will change depending on what other people do, and there's kind of equilibrium in this market. And I'm wondering if you could elaborate a little bit more in this direction in a way to tell us more what kind of changes in the information environment, more so than specific shocks, would help us know what are the right foundations for beliefs and so on. Thank you.
Is it done? Okay. Francesca, thank you for the nice paper. I agree with almost everything you have to say. I have one comment when you said, we like unobserved hidden shocks for measuring elasticities. And I think we have this tendency nowadays to look at all the instruments we have and say, oh, this one doesn't satisfy this criteria, etc. Now, that's all good from a theory perspective. From an empirical perspective, it's already extremely difficult to find any instrument. With a few decades of work, we found like 3 or 4 instruments. If we strike most of them out, we will soon be on one particular end of the bias-variance trade-off. You can make your instrument cleaner. As you make them cleaner, your bias goes down, hopefully, but your variance blows up. So for people who want to do something empirical and do something counterfactual, I think we have to, at some point, live with dirty instruments that give us more power.
Very nice paper. I understand for now it's a theory paper, but I have a question about R square in the sense that once we get outside of the benchmark model of Gabek's cohesion, there are different factors that affect the stock price multiplier. There's expectations. In the morning we saw there's endogenous interest rates, there's other stuff going on like leverage constraints, zeros and stuff. Given all of these potential explanations, there's an empirical question of how much. And now we have data on expectations, say, of different investor sectors, and we have data on shocks, GIVs, and other shocks. I wonder if like you have any thoughts on sort of, because this one seems to be particularly quantifiable using expectations data, and that might help highlight the importance of this channel and also sort of is it probably good to the whole literature.
I have a comment on the motivating slide and a question. So there you had this motivating slide where you showed that the elasticities estimated in the literature are really low on, let's say, the market elasticity, let's say, call it 0.2 or something like that, and that is to some extent a puzzle. In the paper with Jules, we're showing that, you know, if you have fully irrational, you fire investors, and they're seeing that the price is persistently shocked, that you naturally get this type of number out of a rational investor. So I'm not sure you need any additional frictions on that, or I don't see it how you would. The second point I want to more clearly understand, and maybe you can help me with that, is your uninformed or the flows that are hitting that people don't observe and are not aware of. So can you walk me through the belief set here? So suppose we have this hidden shock. Everybody sees the price goes up, but they don't know it was due to a hidden flow shock that hits both today's price and future prices. So if we now poll these investors, they see the price go up. I think what you're saying is they're thinking tomorrow's resale value has not changed, so that they behave as if they're responding to a fully transitory shock, so that we don't need to debias. Because they need to be nudged with something that looks like a fully transitory shock, so that they're thinking, okay, I need to respond, maybe then they're inelastic and they're not actually responding to it. So just to walk me through that experiment.
Okay, let's take these two questions and then you can respond. So the two people standing.
Yes. So my question is just if there's a tension of pushing for these types of hidden flow shocks. So typically we want the shock to be very publicly known that it's pure noise, so that the market maker knows that she's not facing an informed trader. So typically we really push for pure noise shocks. The moment we start pushing for hidden information shocks, we then start mixing in again this idea that you're unsure that you might be facing an informed trader. So maybe to put it more directly, it seems like the benefits of hidden flow shocks only really come to bear once we've gone pretty far towards this not learning at all from prices. If we're somewhere in the middle, then it seems like maybe I should just go with the well-known noise shock and not have to deal with this whole thing of potentially informed trading.
Right, very nice paper. You mentioned that when we learn from prices, this essentially changed the elasticity. You can explain the elasticity. I wonder whether you really need to assume that you're learning from prices at all. As long as like the expectation about future prices is omitted, what you're going to estimate is going to be like biased depending on the correlation between future.
Can you say that again? I didn't hear. As long as you're
as long as the expectation about future prices is not directly on your regression, it's basically on your error term, what you're going to estimate is going to depend on the correlation of the price today and the price tomorrow, right? So pretty much very similar to what you actually would do when you learn for prices. And I was wondering whether that happens more generally as long as you're not directly controlling for the expectations. I guess this is a bit related to Christian's point about persistence.
Can I try and do this round? So a few of the questions were actually related, and that's something that I didn't touch in my presentation, but I discuss in the paper. So what exactly do I mean by an observed shock? I simply mean a shock that isn't part of today, like the investors' information set of the investors whose demand curve you're trying to estimate. So effectively, like if you think we live in a world where we don't necessarily understand where every single price change comes from, or we don't have precise data on quantities of everyone else in the market, then we'll observe price movements but not necessarily know what to attribute that price movement to. Now this comes to some of the other questions that were raised. What I show in the paper is that once you have learning from prices, that weakens the identification requirements in two ways. First, we no longer need shocks to be purely transitory, but also, once you learn from prices, you can also have that shocks that allow you to identify demand elasticities actually can affect your expectations of future payoffs, as long as that works through prices. So we no longer need that shocks don't affect your expectations of future resale values. you just need that if they do affect those expectations of future resale values are coming from the fact that you're conditioning on prices rather than from the fact that you're directly observing those flow shocks in the first place. So I think that also addresses your point, Christian, of if you're just responding to prices, that's now part of your slope, and that's fine. What we want to rule out is shocks that you observe and they directly affect your expectations of future payoffs rather than affecting your expectations of future payoffs through prices. And I don't think that's too implausible. Like, we often, when people trade, they don't necessarily know where every single shock comes from. They don't necessarily know quantities from all other market participants. So I think the requirements are probably less stringent than one might think. I think a lot of the questions actually were around that. One thing that I also want to say, I think there's kind of two parts of the paper. One is on identification, and the other is what contributes to markets being inelastic. So step one is to figuring out, well, what exactly are we identifying? Are we identifying the slope, or are we identifying a slope and intercept effect? And that's why thinking about what different types of shocks give us is kind of important. And I think, Jack, that kind of comes back to your question of like, we kind of care about understanding which shocks we're using, and that different shocks will map onto different quantities, which will then require different types of interpretations. But going back to the 2 points of the paper, one is what are we identifying, and this observed versus unobserved type of shock is important for that. And the other question is then, conditional on now knowing what we are identifying, we can then start thinking about, well, what exactly determines that object that we're identifying? And this also comes back to Daniel's discussion. In this paper, I was exploring the role of beliefs, but it's, I think, perfectly plausible to start then thinking about what are the sources of the values of the slopes that we're actually able to obtain. Yeah, so I'm happy to take more questions. Xavier, you had...
Okay, I think you can take like really 1.5 questions, so just be quick, we'll do 2.
Round up to 2. No, okay, very nice paper. I would just say, some people maybe here a bit demoralized with all those objections, or not objections, but difficulties. Another way to measure, to get an estimate for those elasticities is via surveys. And I like a lot, there's a paper by Dahlquist and Ebert, I don't know if one of the authors is here, I'm not flattering explicitly. Basically, they asked fund managers, given your, and there's a related paper by Giglio, Maggiori, and Strobel. You ask people, given the equity premium has increased by 1 percentage point, how much do you change your allocations? And often they say like 0, I don't change my allocation, I just stay the course. Or you see how much they change, and they change just a little bit. I think that's a very, very productive way to get at the fundamental rules that they follow. They could be derived from fine beliefs, or there could be some cruder rules like they have a mandate or something. And that would be, I think, a way, for me, I'm much more persuaded by thought experiments like that. If you ask a trader, what would you do? And the trader says, I do almost nothing, than very complicated instrumentation strategies. So anyway, so these kind of surveys for individual stocks, what currencies, etc. Suppose the dollar goes up by 20%, how much do you change your allocation? Maybe people, lots of institutions will say, I do almost nothing. That's, I think, a very productive way to get at least the order of magnitude of those elasticities. And then you can do more refined things with, is it known by everybody, not known by everybody, that sort of thing.
Okay, so very quick. So if I think that the world is heterogeneous, right? Some investors are smarter than others. It seems that what you're telling me is that if I go to estimate a demand system, for the smarter the person is, the more biased my estimate's going to be. So there's going to be heterogeneous biases on the cross-section. And I wonder what are the implications of that when we try to do counterfactuals, right? Because then I'm estimating really well the investors who are not smart at all and they have low elasticities. But I'm estimating pretty poorly the ones that have full information, for example, or are close to full information. So I wonder what the implications are.
Yeah, so first, to Xavier's point, I mean, I'm fully on board on a program that combines survey data with quantities. I think that's the sort of really exciting research agenda, and I hope we'll see a lot more of that work going forward. And I think then you can also use models of beliefs in terms of starting to think about dynamics as well. And again, I'm all for using the combination of survey data and holding state. I think that's a really exciting agenda. As to your point, what you're basically saying is sort of perhaps for some investors it's harder to find hidden shocks than for other investors. Is that what you're kind of saying?
In a sense, normally we take a single shock and try to use that same type of shock to everybody, right? So that means that the cross-section is going to have different levels of biases. And then the counterfactuals are going to be affected by that different level of bias that you have, because the flows are going to go to investors more or less biased.
Yeah, I mean, I think that's an interesting question and sort of something that I think we can think more about. Yeah, thank you.
Perfect. Coffee.
Yeah, in Boston.
So, you want it here? You want it on this one? Oh, okay, desktop? Yeah. Okay. All right. So Campbell is already up there, right? Yeah.
do it. Yeah, there's cool.
We don't have other people on here.
All right, I think we should get started. We have one last paper today, and then I think Jim may be saying some words, and John may be saying some words. So we will go ahead and get started with the last paper as soon as you guys sit down. And close the door behind you. All right, we're happy to have Actively Passive, the Rise of Market Volatility, presented by Tyler.
Thanks so much. Thanks so much, everyone, for being here. Thanks very much to the organizers for putting us on the program. This is joint work with Lars, sitting somewhere. Let me get right into kind of the main fact that we're looking at in this paper, which is that stock market volatility has roughly doubled in the last 70 or so years. So what this picture is doing is it's just plotting the 5-year rolling standard deviation of the daily crisp valuated return. So it's just data from Ken French. You can see this increasing from somewhere around 10% to a bit over 20% from about 1955 until now. I showed a linear trend line just to say this has gone up and it's easier to visualize. We're not claiming that necessarily this is increased linearly. And what the paper is going to be about is in documenting this and kind of understanding what's driving this rise. Okay, and so what we're going to argue is a big part of why the stock market is more volatile is because we trade the market index far more than we used to. So think of using index futures or index ETFs, and because we just trade a lot more than we used to. Basically, we trade around the clock. Okay. I'm going to start kind of piece by piece on this. I'm going to show you suggestive evidence of a trading story. That you might have a lot of reactions to the first plot of stories you might have in mind. I'm going to discipline those by showing some more patterns on this volatility. And then I'm going to zoom in on some kind of natural experiments. So I'll look at shifts in the NYSE trading hour changes, the launch of overnight futures, changes in futures hours, and changes in the way they allow trading on holidays to get at this. Then we'll show a little model of index demand shocks that rationalizes some of these patterns. So let me start right away and say one of the key things in terms of understanding this pattern is looking at this across different return frequencies. Okay? So on the y-axis, I have how much volatility has increased over that sample period that I showed you. And on the x-axis, I'm doing return frequency from daily returns to cumulative weekly returns to 2-week returns and so on. Okay? And what you can see is that the increase in volatility that we're documenting is really concentrated at the daily horizon. It's less there. There it's, it more than doubles over the sample. At a weekly horizon, it's about 75% increase. Monthly is about 40%, and then you can see the pattern kind of decaying down. Okay? So right away, stories that you have in mind, any story about fundamentals can't explain that because that would increase the volatility at all the different horizons. Okay? It has to be something that changes the short-term mean reversion or autocorrelation of returns. To show that a little bit more, this is plotting along with the volatility, the variance ratio of daily to monthly returns in the blue. Okay, and you can see the variance ratio starting below 1 and then increasing along with volatility to being well above 1. Okay, so again, that tells you you need some kind of increasing short-term mean reversion, or you need autocorrelation to decay. That's consistent with kind of trading-induced price pressure type of stories. Okay. I won't spend much time on robustness of the main fact. I already told you why fundamentals are a good explanation. We look into all sorts of things of whether or not this is driven by, you know, outliers like the 1987 crash or those types of things, and find that it's not that. One thing I do want to highlight is we find that this isn't about stale prices. Okay, so it's not, you know, stuff just not trading at all in the early part of the sample. If we, instead of doing value weighted, if we do volume weighted returns, so we're only using stocks that trade and weighting those that trade the most, we find the same results, or conditioned to just on the top 100 stocks. Okay, so what do we think is going on? I'm going to tell you this kind of trading story. The first thing to show you here is that volume and volatility sort of move together in this more recent sample. So I'll say two things about this graph. One is now we're doing this 5-year annualized volatility over a longer sample going back to the 20s. You can see high volatility early in the Great Depression, that sample. There we actually find most of that is there's higher macroeconomic volatility. So volatility of industrial production or corporate profits or GDP being high during those. The macro volatility or fundamental volatility and the stock market volatility really diverge around the 60s and 70s when this is trending up and the other ones are trending down. Okay? We see this happening with a big explosion in trading volume that matches the trend and even, you know, a little bit some of the wiggles there. One problem with this is that this is just overall stock market volume, and I kind of told you something about volume and market index products. So is there any evidence of increased trading of kind of the market portfolio? And there is. So we're going to say that trading increasingly looks like kind of index trading or trading the entire market. And the way that we're going to get at that is we're going to measure this market volume beta. So basically every day do a cross-sectional regression of all the top 500 stocks and regress their volume on that day on their market cap weights. Okay? So if it was just people trading in and out of the market, the volume should be proportional to market cap weights. Okay? And you would get a beta of 1 here. Versus if it was like, you know, you trade Tesla's volume's high this week and next week it's Apple or someone else, this slope is not going to be high. Okay? You kind of see this slope picking up. It looks like people are trading more in something that looks like a market portfolio over this period where volatility is rising. Okay. So all of this kind of shows some correlation between this market volatility and increase in trading volume. Can we zero in a little bit more and get some more precise evidence on that? That's what we're going to do next. So here, the main idea that we're going to use is this French and Roll 1986 paper, which if you don't know it is a pretty beautiful paper. What they basically did is in 1968, the NYSE closed trading on Wednesdays because of a paperwork backlog. So now Thursday is a 2-day return. Okay? Standard information story would say the variance of the Thursday return should now be twice what it was, since it's a 2-day return instead of a 1-day return. What they find is that the variance basically doesn't change. It goes up by a little bit, but nowhere close to doubling. Okay? We also show that the volume on Thursday, when Wednesday is closed, doesn't look any different than the volume on Thursday before the Wednesday was closed. Okay? So cumulatively over the week, you lose almost 20% of the variance when you cut one of the days, and you lose almost 20% of the volume as well. Okay, so those two things are closely linked. Okay, so we're going to exploit 9 changes in the NYSE trading hours, and we're going to look at trading volume and volatility. Okay, so again, null here would be like variance scales with calendar time. That's just information arrival. We're going to entertain variance scaling with trading time. That trading itself generates volatility. Okay? In both of these, what we're basically finding is something close to one-to-one. Okay, that if you, it's what I said before, if you close one full day, you're going to lose that entire day's worth of volume, and you're going to lose almost all the volatility that would have otherwise happened on that day. And same with if you make trading hours longer on a day, you'll increase volume and you'll increase volatility. Okay? We're doing this using daily returns. There you have to control for the calendar hours because those are varying as you change the hours. Or you could accumulate up to weekly returns, and then you don't have to worry about the calendar time. It's always 1 week. And we find basically the same results. We're also not saying that they change these trading hours randomly. We're using windows of about 6 months around when they introduce these. So we're saying they don't pick that particular day to change the trading hours because they knew volume the next day was going to pick up. Okay? Good. All right. Now, this is just about increasing trading opportunities or trading hours more generally, but for all stocks, including the market portfolio. Can we get at stuff that's more about the kind of trading the market story that we have in mind? There, one thing to show you already is a lot of the rise in volatility of the last 30-ish years is actually coming from overnight variance of the market, so from the close to the open. And we kind of also know that that's a period where trading index futures overnight started becoming possible. Okay? So we're going to try to exploit that in the similar spirit of the experiment that I just showed you. Now, this is sort of better in that we're getting more directly at, you're able to trade the market index more, not necessarily individual stocks, but we're going to have kind of fewer events to exploit than we did in the last case. Okay, so I'm going to look at the September 1997 introduction of the E-mini, which allowed you to trade futures kind of more cheaply, but also was available overnight. Okay, individual stocks still can't trade overnight, so now you kind of have this difference or comparison of the overnight market variance relative to overnight individual stock variance, and you could do relative to what's happening intraday too. Okay, and that looks like this. So we get a relative increase of about something like 40% in the relative variances of these things. That's the black line jumping up when the E-mini is introduced. And we get this similar increase in this futures volume. Okay? Making that a little bit more systematic, we're going to exploit all the different changes in futures hours. There's not really that many of them, so we're squeezing it a little bit thin. But there were further additions in expanding the overnight trading of futures that we're going to use. And so kind of as you fill in these gaps, you're allowing to trade the market during those gaps. And so you can affect, and so there's going to be an effect of volatility just for the market, but not the individual stocks during this. Okay? And basically, when we do this, given limited time, I'll skip to the kind of narrow identification one where we do the plus minus 6 months around the events. We get something like an extra hour of being able to trade translates to about 5.7% increase in the market variance relative to individual stock variance. And again, we're comparing overnight to intraday. So we're doing this triple difference thing here. We've got year-month fixed effects and all of that stuff as well. So it's a relative comparison of all these things. Okay, good. The last one we'll do is looking at holidays. So around 2004, you started being able to trade index futures on holidays like MLK or President's Day or Labor Day or whatever. And there, we see a similar finding that trading picks up on those days, and we see an increase in volatility on those days. Now, there's only like 6 of them, so we don't have that much data here to push on, but directionally the results are consistent with that. Interestingly, there's one, which is Good Friday, that's a placebo where the futures stay closed, and that's the only one where we don't see any major effect. Okay. Those were a couple of different experiments. I talked a little bit about the economic magnitudes. One way of just trying to size that up, this is, what I'm basically doing here is I'm taking the experiments that I showed you, I'm taking the estimates that we got from those coefficients, and I'm using the change in the trading hours over time, either coming from NYSE or the futures, and applying those coefficients. That's the red line, okay? So it's a little bit Frankenstein in that we're combining kind of different experiments. All I want this to show you is that quantitatively, the experiments are economically large. They would suggest they can explain kind of like 70% of the rise in volatility that we're seeing. So sizing those up, they look like they're economically fairly large. Okay. How many minutes do I have? Probably 2.
7.
7? Okay. Should I go back? Okay. I could have had a fuller version of the model then. I'm going to basically sketch the model here, okay? So the model that we're going to write down, it's going to be intentionally kind of stylized here. We're going to have n different stocks, and we're going to start with these behavioral investors. I'll tell you what makes them behavioral, if you want to think kind of noise trader type thing. But they're all going to be specialized, so they're each going to hold just one of the stocks, okay? There's going to be a rational arbitrager. That's going to have mean variance preferences. It's kind of similar to John's work with Grossman and Wang in the 1993 paper. But these behavioral investors, they're going to have persistent shocks to beliefs about expected returns, okay? And then we're going to make this kind of weird assumption that's going to match this trading evidence that I showed you, which is there's going to be S trading rounds per day, and when there's more rounds, there's going to be more demand shocks from these behavioral investors. Okay, so every time they kind of show up in the markets open, they're going to experience more shocks to the expected return. That's basically saying you cut the day up into a bunch of different sub-periods, their variance of their demand shocks doesn't scale with like 1 over square root of S or whatever. Okay? Good. So now we're going to consider 2 things in the model that are going to raise market volatility. One is switch everyone to trading an index. So instead of them being specialized, you let them trade all N of the stocks. And so they're going to be more diversified. When they're more diversified, that lowers the risk of their portfolio. And then they're basically more willing to trade on their beliefs about the expected return. Okay, so they'll be more aggressive. Now the arbitrageur has to absorb all of that demand. And what are they going to demand? They're going to demand a negative return autocorrelation. They're going to demand mean reversion in order to absorb all of that extra stuff. Okay? And then the trading time, so cutting it up into these additional periods, well, the volatility of the demand shocks is going to effectively increase over a cumulative day when you do that. And so volatility is going to end up scaling with this trading time and not just calendar time. Okay. So that's the model. I mean, there are equations and symbols and all that, but that's a sketch of the model. Now we're going to, and it's a bit of a stylized model, but we're going to slap some numbers on it that we think are somewhat reasonable and see what we can do with the data, okay? So this is going from the original economy where there's no index and there's only one trading period per day. This is if you add index trading, so this is just coming from them being more diversified, so they're more willing to trade on their shocks. And then this is what happens if you increase the number of trading rounds, and the last one is if you do both, okay? And so you can quantitatively get, reasonably close to what we're seeing in the data, and it's really coming from the same forces that I showed you empirically, okay? What's going to happen when you move there? You're going to get more negative autocorrelation in the market return. You're going to increase the volatility at short horizons because you're increasing this kind of mean reverting shocks, but at long horizons you're not going to increase it at all. And you're going to get a big increase in volume, okay? So the model is going to kind of predict directionally all of those things. Increased volatility with trading. Index trading is going to increase systematic volatility, but not the individual stocks. Decrease in return autocorrelation. This volume beta thing is going to increase a lot because you're trading the market index instead of the individual stocks. Okay. So with maybe even a minute to spare, I'm going to conclude there and say stock market volatility has roughly doubled. That's true at the short horizon, like daily returns. and that fades out as you go to longer and longer horizons. That's coincided with an increased variance ratio and more mean reversion in returns at relatively short horizons. We're going to argue in large part this is because we shifted from trading individual stocks to trading the market index in large volume and now kind of like around almost 24 hours a day, okay? Volatility and volume look more closely aligned with trade time than with calendar time. And kind of the effects that we saw in some of these experiments, even places where we're slicing a little bit thin, still economically look like they can account for a good chunk of this. So thanks a lot, John. Look forward to your discussion.
The discussant is John Campbell.
Okay, great. Thank you very much, Andrea and Sydney, for inviting me to discuss this very interesting paper. There's some fascinating facts in here, which you heard from Tyler. I'm going to argue that I'm going to challenge the framing and the selling of the paper, not the facts, but I'm going to suggest that some of the claims in the abstract don't really follow from the facts as given. So let me pick on the abstract. I'm quoting the first sentence and the last sentence of the abstract. So the first sentence says, US stock market volatility has roughly doubled since the 1950s, yet macro fundamentals have grown calmer. And then, of course, we have figure 1 from the paper, which shows really an important and striking uptrend. And then the last sentence of the abstract says, stock market volatility increasingly reflects how investors trade rather than economic fundamentals. Okay, let me present the same data in a different form. I have a paper in the Critical Finance Review with Lettow, Malkiel, and Shu from a couple of years ago. This was an update of our early 2000s paper on idiosyncratic volatility. But as part of that, we just updated various plots in that old paper. And here's the market volatility of the same index, the crisp value weighted index, over a somewhat longer period of time. It ends slightly earlier, but it goes back to 1927. And the key difference is, in this plot, we're averaging separately within each year, rather than smoothing over 5 years. Now, what does this alternative plot show? Well, first of all, the upward trend in volatility since the 1950s is certainly there. If you start in 1950 and you look to the right, you do see an uptrend. It looks much noisier, of course, because we're only averaging it separately within each year. And within the sample emphasized in the paper, the since 1950 sample, the spikes in volatility are associated with episodes of macro uncertainty. The Volcker recession in the early 80s, the tech wreck, the global financial crisis, the COVID-19 pandemic. And of course, as Tyler showed at one point, volatility was much higher in the 1930s than it has been subsequently. So when I look at the plot, I would argue that these features of the plot suggest that economic fundamentals are important for daily volatility, even if modern trading technology is also important. But we want to keep in mind that we're trying to extract the signal about trading effects from a very noisy time series. Now, to understand what's going on in the paper, I think it's vital to keep a focus on the fact that daily volatility is only one point on a term structure of volatility. And again, one of Lars and Tyler's figures shows that very nicely. As the return measurement interval increases, you move out along that term structure. And in the limit, as you go to an infinitely long measurement interval, volatility must approach fundamental cash flow volatility, because all the shocks to expected returns, they only have temporary effects, not permanent effects. Now, this volatility term structure is only flat in the special case where returns are IID and all the shocks are cash flow shocks. So that would be, the benchmark model, if you like, of IID returns, where whether you're looking at daily volatility at the left, or decadal volatility, or even fundamental volatility at the far right, it's all the same thing. Now, in the paper, the paper is essentially this sort of model where you have reversals. So daily volatility is higher. There's return reversals at all horizons in the model. And the gap between daily volatility and something out there at the far right, fundamental volatility, that's excess volatility. And then the paper shows that what's happened is that there's an uptrend in volatility, which is stronger at shorter horizons. That's going to imply a more steeply downward sloping volatility term structure with stronger return reversals at all horizons. So what about fundamental volatility? Now, you know, it's very challenging to measure fundamental volatility. We know that. We've been arguing about this for decades. And you need a very long sample of calendar time to get anywhere. So it's going to be very hard to be sure that fundamental volatility hasn't increased. We know that the near-term plot looks like that red line, but we don't really know what's going on out at the far right. It could be that fundamental volatility has increased, in which case we don't really have higher excess volatility. We just have a general shift up in the term structure. Now, the paper shows that equity volatility has risen over this sample relative to the volatilities of the annual growth rates of industrial production, GDP, and corporate profits. But these are short-run measures of volatility, and the stock market, the volatility of the stock market should be driven by longer-term forces, long-run volatility, if you like. So a famous example of that, which probably everyone knows in this room, is the long-run risk model, Van Saal and Yaron, where consumption is smooth, but there's this positive autocorrelation in consumption growth, and that makes stock prices very volatile. That model, by the way, also implies a negative bond-stock correlation because the shocks to expected consumption growth that are good for stocks are bad for bonds. Now, it's well known that the bond-stock correlation turned negative around the year 2000, and there's this paper by these three guys, one of them Lars Lochstauer, which document that the autocorrelation of consumption growth became positive around the same time. So the transient recessions that we lived with in the mid-20th century have been replaced by, perhaps, by shocks that shift growth rates persistently. Financial crises, climate change, AI, whatever you think of. And these shifts could easily have increased fundamental equity volatility. So on the left here, this is a plot from a review paper that I recently did with Caroline Pfluger and Luis Vicera, just showing the change in the sign of the stock-bond correlation from positive to negative, which suggests an increase in persistent shocks. And then the figure at the right is taken from the Chernoff, Lochstauer, and Song paper, showing how the autocorrelations of consumption growth in the 20th century are the blue bars, and then the red bars is the 21st century. And so it seems to me quite natural to think that fundamental volatility relevant for equities could have increased. Now, that's very speculative. It's going to be hard to get any direct evidence. So maybe we should set that aside and focus on the short end of the term structure of volatility. The problem, I think, for the framing of the paper, the current framing of the paper, is that historically the short end has been upward sloping, not downward sloping. Short-run autocorrelations of index returns were historically positive, reflecting positive cross-autocorrelations of individual stock returns, lead-lag effects, pointed out, for example, by Andy Lowe and Craig McKinley in the late 80s. So the historical data look like this. There's an upward sloping term structure of volatility out to 1 year, and then a downward sloping term structure beyond 1 year. So Perturba and Summers' late 80s paper on the variance ratio showed exactly this. I updated their numbers in my textbook in 2018. This was the historical pattern. Now, what's changed? What's changed is that the volatility term structure is now slightly downward sloping at the short end, but it's flatter than it was before. So it's close to having gone from upward sloping to flat. So here's a way to look at it. I mean, a really simple way. Here's the first daily autocorrelation of the market index, again averaging separately within each year. So this is an update of another figure from my textbook, which in turn updated a mid-1990s paper by Ken Fruit and Andre Perrault. And you can see that there was this remarkable positive autocorrelation of daily returns in the early post-war period, the mid-20th century. You were getting index autocorrelations, daily autocorrelations, on the order of 0.2, something like that. And then in the 1970s, you began a downtrend which proceeded through the 70s, the 80s, to around the turn of the millennium. Since the turn of the millennium, the average is slightly negative, but not nearly as negative as it was positive before. And of course, also notice that the most negative numbers coincide with crises, the global financial crisis and the COVID-19 pandemic. Now, here's another way to look at it. What if you do the same sort of plot I showed you before from my updated paper with Letau, Malkiel, and Shu? You can plot the daily volatility and the weekly volatility. And for most of the 20th century, the weekly line is above the daily line, indicating that daily volatility was understated relative to a longer measure. And that's gone away in the 21st century, and if anything, has slightly reversed. But the big pattern is that daily vol in the 20th century was understating what you saw when you looked at weekly vol. So the paper argues that daily market vol has increased for two reasons. First, the advent of index funds and futures has led investors to trade the market more and individual stocks less. And secondly, increased trading hours have generated more price signals that investors can react to, and that further increases their desire to trade the market. Now, how important is index trading? I want to quarrel a bit with this volume slope measure, which the paper proposes as a measure of, quote, the prevalence for trading the market. And that's the slope in the cross-sectional regression of stocks' share of trading volume on their share of market cap. And it's true, as the paper says, that if all trading is index trading, that volume slope is 1. In the data, it goes up from 0.4 in 1960 to about 0.8 today. That's figure 6 in the paper. The problem, I think, is that there's lots of other things that could make the volume slope equal to 1. For example, if each investor trades only one stock, but the probability of selecting a stock is proportional to its market cap, then also volume slope equals 1. So the increase in volume slope could just reflect an increased alignment of market cap with investor trading interest. Perhaps in the old days, big stocks were boring dividend income generators that people didn't want to trade. You just bought IBM and got the dividends. Whereas today, big stocks are AI stocks. Everybody's trading them. So I just don't think that volume slope necessarily tells us that all trading is index trading. Now, I don't actually want to argue that index trading is no more prevalent than it used to be. It obviously is. But if we're to measure the extent of the change, we need detailed data, I think, on index fund flows, index futures arbitrage trading, and so forth. We actually have to look at positions and flows. And so I would say the volume slope is a shortcut that I find unconvincing. We're also going to need a model that allows investors to trade both in the market and in individual stocks, because there certainly is a lot of both types of trading. And then we should ask the model to capture trends in both market volatility and idiosyncratic volatility, which rose in the late 20th century to the late 90s and has come down a bit since then. So the model in the paper is very stylized. I understand that, but I don't think it meets the conditions that we really need. And finally, I would say it seems likely that the desire to trade the market, or the prevalence for trading the market, is itself endogenous to market conditions, which is suggested, of course, by the unusually low daily autocorrelations in the Great Depression, the global financial crisis, and the COVID-19 pandemic. These were years when investors were reacting to news about the aggregate economy. That's what they wanted to trade on. So it's endogenous. Now, what about the increased trading hours? This is a lot of what's in the paper empirically, and it's very interesting. So the paper convincingly shows that increases in trading hours are associated with increases in both turnover and volatility. And then the trading hours are used as an instrument to identify a causal effect of turnover on volatility under the assumption that the trading hours don't affect volatility other than through turnover. And there's a model, and in the model, investors respond to the signals that trading generates, so that longer trading hours increase the reversals that are caused by mean reverting investor demand shocks, essentially by amplifying these mean reverting demand shocks. I want to throw out a suggestion. I am not a market microstructure theorist, so I'm not going to be able to build the model, but this is a conjecture, a suggestion for you to think about. An alternative story would be that the effect of increased trading hours is actually really the effect of decreased non-trading hours, and the effect on the behavior of arbitrageurs, not the end investors. Why might that be plausible? Well, arbitrageurs, we know, dislike jump risk. So there's direct evidence from option prices, John Pan's work. There's the high returns on macro announcement dates when the market is going to jump when the announcement happens. Now, non-trading periods, nighttime periods, are equivalent to jumps because they create risk that you cannot manage through continuous trading. You're shut out of the market for a period of time, so it's as if you're exposed to a jump. So perhaps decreased non-trading hours increase the willingness of arbitrageurs, high-frequency traders and other market makers, to front-run serially correlated demand shocks that persist over several trading days. What will that do? It will reduce positive daily autocorrelation and increase daily volatility, which is exactly what we see in the data. And this mechanism, importantly, doesn't require outside investors to behave any differently when trading hours increase. It's just a matter of the extent to which arbitrage is functioning to eliminate that positive daily autocorrelation that we used to see. So, coming back to the striking claims in the abstract, from the first and the last sentence, you know, the basic fact is correct and interesting and important, and I'm glad to have read the paper, and you all should too. But it's just not clear that the relevant fundamentals have grown calmer. I mean, apart from anything else, the great moderation was perhaps not as moderate as it seemed at the time, and it ended almost 20 years ago. And then the claim that stock market volatility increasingly reflects how investors trade rather than fundamentals. I agree that trading behavior and the available instruments are important. The paper convincingly shows that. But it's not clear that daily volatility is more disconnected from fundamentals now than it was in the old days of positive autocorrelation and artificially low daily volatility.
All right, thanks a lot, and you can feel free to line up for questions or raise your hand, but you should go up to one of the microphones.
It's more of a clarification question, sense, because you went fast for the model without equations, and I think for equations. So, and I was just wondering, in the data, we know that the risk premium has not increased over this period, right? But in your model, there's an arbitrageur who's absorbing this extra volatility. So in your model, would risk premium have increased over the period in which volatility increased or not? And if not, why not? What is the mechanism in the model that makes risk premium to be more disconnected from volatility?
Very interesting paper and great discussion. So the rise of index funds and more access to trading, this is a global phenomenon. Even in the emerging markets, we see similar trends. So do you think that this trend in volatility is also something we should expect to see in other markets? Or if you think that there's something special about the US, such as the big AI companies or like Robinhood traders that will be, very unique in this market. Thanks.
You motivate the paper on the first slide talking about the relation between
market volatility and macroeconomic second moments. Could you talk a little more about the implications? Does this mean that that predictability goes away? Does it mean that we measure volatility a different way? Some of this analysis is in the appendix, and I was kind of struck by your description of the decoupling in 1980 between kind of the market vol and the macroeconomic volatility. 1980 seems a little too early in terms of index funds and trading times.
No, when thinking about those things, I think it's useful to think about other markets too. And if you think with the foreign exchange market, you know, trading volume has increased enormously. I was checking with Claude, maybe by a factor of 20 in the past, yeah, the research, by a factor of 20 times more trading volume. Basically, volatility is flat. Okay, so I think any long-run relation between volatility and trading volume has to be essentially zero, just as a matter of. And how is that consistent with the models that, say, Francesca presented and that Ralph and I like? If you say, okay, and it's consistent also with French evidence, if you say, look, the price change is the flow divided by zeta, some elasticity. So just by thought experiment, suppose somehow, because transaction costs fall, the volatility of flows is multiplied by 10, okay? The price volatility will not be multiplied by 10 in the long run. It's endogenously, the elasticity is going to be multiplied by 10 to roughly make sure that there's fairly little predictability in the market. So now this kind of view is consistent with, in the very short run, if you add one more trading, there's not enough, you know, one more trading day or a few hours, there's not enough arbitrage capital or whatever to come to elastify the market. But in the long run, I think there should be some no relation between trading volume and volatility. I don't want to be dogmatic, but looking at the few markets like that, like FX, etc., would put things in a broader perspective.
So I guess I can, I'll add one question while Leonid stands up. So I remember, I think Tano Santos' job market paper was about derivatives, introduction of derivatives and volatility. That was like kind of in the late 90s. I thought that was a pretty intriguing study. And then looking at the discussion slides and just doing the eyeball empirics that are so much fun, it seems also that it's like when the Fed became so active and Bernanke, or not Bernanke, Greenspan introduced the Greenspan put, and kind of we started doing central bank asset pricing, as Annette was talking about. That's really when a lot of these things change. So just food for thought.
So it's hard to draw inference from kind of just a trend, but nonetheless. During this period, interest rates also declined. So I wonder if this could partly reflect that as the distance between discount rates and growth rates shrinks, prices just become more volatile. What happened to discount rates during the same time period?
A very interesting paper. In view of one of the key points of the discussion, I wonder whether applying a new US correction would help resolve the puzzle when measuring the variance. If outcorrelation was positive, new US correction would lift the variance up in the early years, and if outcorrelation switched to negative, it would push it down for the recent years. Thank you.
Okay, this might be a good chance to give you guys a
Yeah,
chance to
a lot of
respond.
questions. Okay, let's start with a model question. In our model, actually, we have zero net supply, so there's no effect on the unconditional risk premium. It's just, when there's pressure in one direction, prices are moved in that direction, and so the risk premium is just sort of fluctuating more. You could imagine a model where volatility and risk premium are sort of tightly connected, and then, of course, the risk premium would go up. It's a question of, first of all, empirically, I don't think that's true, and it's a question of sort of who the marginal investor that determines sort of the level is. If that's more of a long horizon investor, then, long horizon model has not changed, so. Let's do global. that's a very good comment, of course, going globally. So there's a couple of things to say about that. So first of all, in the US, at least we understand the market relatively well. In some global economies, there's also a maturity level that things are introduced. But there's some evidence that globally, when you introduce futures, et cetera, that autocorrelations do decrease by Gida and some co-authors. I think the key thing that we use in our paper is that, in addition to an instrument being introduced, it needs to be traded. You need to have a first stage where people actually do trade the instrument. And in the US, at least we have sort of pretty good evidence that, when the SP 500 futures were first introduced, they weren't as heavily traded, but the E-mini was really associated with an immediate increase in trading. And so, the identification of the event is just pretty sharp in the US data, at least. I don't know if you have anything to add there.
Yeah, I agree with that. And same with we've been asked why don't you use the introduction of the SPY ETF or something like that. Where the kind of causal evidence is the sharpest is stuff that people were already doing, but you let them do it more easily or more hours. So people were already trading in stocks. You take a day away or add a day, they're going to trade more or less of it kind of immediately. Same with the futures when they're already doing it. You change the hours and they do more or less of it. When you introduce the new product, you can see, SPY has crazy volume now, but initially people weren't trading a lot of it. They didn't kind of know what to make of it. So it is hard to get events where you see, sharp uptick in trading activity in a narrow window and matching the volatility.
Yeah. So macro vol. So John is right and Cam are both right that it's hard to measure macro volatility in short run. It does look like macro volatility comes down pretty significantly from a certain date. I agree the exact timing. Maybe we could do more. It allows me to also address this long run. I think we sort of agree. It's very hard to measure that long run volatility. I think the key associated fact is that the variance ratio starts rising significantly above 1 to like 1.5, which means that you get this reversal in the price. That's not so easy to explain by just a macro volatility. Okay, so we sort of lean quite heavily on that one, I think, for the fundamentals. You want to talk about FX?
Yeah, well, I was going to comment on some of these, in other markets, again, I think to sort of do it properly, we would need some kind of experiments that look like that. I think the correlations between kind of volume and volatility are interesting, but the whole point is to try to look for some, more careful evidence where you let people trade more, they trade more, and you see more volatility. So I don't know about the correlation in FX markets. I haven't looked at it. But still there, I think I'd probably be more convinced by if we could find similar experiments to what we're doing here, that would be a good way for us to go. We have not done that.
Yeah, I think all those trend plots are just motivating. There's a lot of high frequency trading and all these type of things. And so when we do our identification, we look in sort of plus minus 6 month windows with event fixed effects exactly to sort of take away sort of these slow moving trends in the amount of trading. So sufficient, certainly, I don't think we're claiming that this thing is the whole effect. We can take, total volume and just say, okay, this affects volatility directly. Yeah. Okay, what else?
That's what I felt like there was a few other questions about, the Fed or interest rates changing, or there could be a lot of things. When you show a long-term trend, there could be a lot of things obviously going on that's driving that. And again, that's why we like trying to dig into these, natural experiments or causal evidence where, you have to have a much more specific story that's linking volume and volatility when you expand the trading hours.
And again, with the interest rates, this type of stories don't naturally give you negative autocorrelation. They don't naturally give you that price is sort of within a month or within 3 months, right? Might be in a very long run, but within a 1 month or a 3 month window, I think it's going to be hard to write up a story about fundamentals or, discount rates, like in the risk-free rate effects or something like that driving it. Standard errors. So that's always fun. So we do, of course, have all these lags. We do the key for Vogelsang, so we do correct for the lag, fixed B, p-values, okay? So that should account for small sample issues. We also have looked at other things to try to get at that. For instance, we don't necessarily rely on a trend. We do structural breaks. We do a lot of other things. I think we worried a lot about it, and I think the empirical fact about this increase is robust. So, yeah.
Yeah, this is all very interesting. I kind of wanted to circle back to Andre's question. Maybe it's, I would have expected some risk premium effects. Now maybe it's, there's none from the letter of your model, but the spirit of it, I would have thought, you have these arbitrageurs that are having to absorb all this additional systematic risk. You'd affect some, I would have expected, in the spirit of such a model to have some risk premium effects, but I guess I'm a little puzzled as to why you don't expect anything from the model that you have, or something similar to it.
We could get it. We could get it if you have a model with positive supply. You could get an increase in the risk premium, and it's true. I'm just not sure. These dynamic patterns. I'm not sure how we would make any difference to those patterns, but the risk premium probably would go up a little bit within the model.
Counterfactual, I guess, right? You wouldn't. Prices should be very low right now, or something, because systematic volatility is trending up. So I guess.
I mean, it's hard to measure risk premia in small samples, so we could try something like that for sure.
Well, we have an extra minute, so I guess I can.
Actually, let me, if you were to do, so the claim is that the information ratio, or the variance ratio of 1.5 is a lot of predictability. If you were to build a trading strategy based on the negative autocorrelation that you're seeing, what kind of information ratio do you get with that? Yeah. Have you looked at that?
We did do it, and it wasn't crazy high.
Yeah, it's in there somewhere. In appendix something.
It wasn't unbelievably high. It was like 0.5-ish, I want to say, but now I'm a little scared.
0.5 annualized.
Yeah.
0.5 annualized, something like that.
So like on the same order as the market?
It's on the same order as
a
bunch of different kind of trading strategies.
Yeah, because we worried quite a bit about whether it was plausible or it was just transaction cost within transaction cost. Yeah.
I just wanted to give you an opportunity to respond to the question about the zero correlation of consumption growth. How much would that change things if you incorporate a reasonable number from your previous work?
So the good news is I have the model, so we could look at this estimated. I don't know the answer off the top of my head. I will say that zero correlation we estimated wasn't like super persistent. It wasn't like it was 0.95 per year where it would really have a lot of kick. It was more like, I want to say 0.5, 0.7 per year. So it wasn't as high. So that makes me think maybe it's not a first order effect, but I have to go check, yeah.
So, I mean, this doesn't fit the part where it moves, but there's enormous innovation just in what mutual funds hold away from active towards more passive index. And there's a lot of now day-to-day rebalancing that happens very automatically from retail investors that didn't used to with the rise of these target allocation funds. So Vanguard has $1 trillion in these funds. 0.5% move in the market in one day is going to lead them to rebalance something like $15 to $20 billion in exactly the opposite direction of the market. And they hit their targets day by day. And they're just going to do the complete exact index trade. So there's a bunch of money that's now used to be very passive that is now trading exactly the ways you say. Now the rise in that volume up to $1 trillion just in Vanguard, there's a bunch of other them, but it's something that happens sort of not starting in when your trend started, it starts later, but it's got to be a big part of the daily volume, the daily reversal pressures today, and it's going to be index-based trading really by volume.
Yeah, I mean, I think we agree with that 100%. It's part of our underlying story, though none of our experiments actually precisely. Maybe we could do something there, yeah.
Yeah, maybe just quickly echo Jonathan's point about whether this is indexed by itself or indexing allowing more retail participation in stock trading, because there has been recent literature talking about things like fractional trading. Now, instead of just trading one by one shares, now you can trade cents or, I mean, even tiny bits of stocks, and also the rise of Robinhood. Also, I mean, those are, I guess, maybe you can use that to tease out whether this is about the whole market or about individual stocks, because you can pretty much get data to allow you separate institutional trades versus retail trades.
Yeah, I think that's a good suggestion.
So Golas and Kuders have this paper in which they argue that the more of the volatility of the market has been coming from discount rates than growth, but in the past was quite different. I wonder how that relates to what you're doing, because they're using 1 month predictability. And so if there's more from discount rates, you would see more volatility in the short term, but not in the long term, because you're going to see more mean reversion. So I think you are looking at, potentially, I don't know, but the different ways to look at the same type of effect. And I wonder what are the connections there.
Yeah, I mean, I think we agree with that, right? I mean, it has to be at some level. And our plots, the one that I showed you at the beginning where you go across the horizons, is saying there basically wasn't much change in the volatility of returns when you go at longer and longer horizons. All of the change is coming from these shorter horizons, so it has to be some kind of, whatever you want to call it, discount rate volatility, mean reverting, whatever. I think we're thinking of it as, it's at relatively short horizons here. So it's not the type of discount rate variation that I think we're normally thinking of in kind of the asset pricing models. We're talking about stuff happening between a day, a week, a month, and maybe a couple months. But yeah, it kind of has to be at some point.
That fact, the speed with which it reverts may actually be informative about what kind of discount rate shocks, right? Because right now we have their evidence, and that can be interpreted as macro discount rate shocks, but what you're showing is it's just harder to interpret the same way, right? So it actually qualifies how we think about that, I think, in some ways. Yeah.
So I think you have 1 minute if you want to do your quickest response to your discussant.
Thank you. That's not fair. Yeah, I don't know.
Yeah, thank you. Maybe I'll this is a great discussion. I'll maybe respond to one. I think we're in agreement with a lot of the things. I think we're in agreement that, measuring the long run fundamental volatility is clearly very hard. We should emphasize more what we are solid on is this relative change in the frequency of returns at, daily, weekly, monthly to longer horizons. You can't get those types of changes, or it's not easy to get them at least, with just a change in the long run fundamental volatility, even though that may have also changed. That's probably the right way for us to put it. That sounds longer than the number of words we had in the abstract, but still, I completely agree on that. Yeah. All right.
All right, thank you so much.
Thank you.
Before everyone leaves, we have our dear leader from the NBER is here to say a few words.
If I can try to hold on to everybody for just a few moments. I know it's been a long day. I'm Jim Peterba, and I wanted to join you because we have a couple of items of asset pricing program housekeeping to do. I'd like to, in order, thank Ralph for his service as asset pricing program director.